Welcome to Trading for Life, your go-to channel for mastering the art and mindset of trading. Today, I'm introducing you to a must-listen audiobook for serious traders, Reading Price Charts Bar by Bar by Al Brooks. Who should listen to this audiobook? If you are a day trader or swing trader looking to sharpen your edge. Someone who wants to go beyond indicators and understand raw price action, or even a beginner seeking to build a solid foundation in technical analysis, then this book is for you. It's especially valuable if you're tired of guessing and want to start reading the market like a language. Why you should listen to this audiobook: Al Brooks takes a deep dive into price action trading, teaching you how to read every single bar and candle for its true intent. You'll learn to spot real-time trading setups, understand market context and psychology, make confident decisions without relying on lagging indicators. Listening to this audiobook will train your eyes to read charts with precision, like a professional. So, whether you're trading stocks, futures, forex, or crypto, this audiobook will change the way you view the markets. Start listening to Reading Price Charts Bar by Bar today and take your trading to the next level. Don't forget to like, subscribe, and hit the bell so you don't miss more content like this on Trading for Life. Preface: my goals in writing this book are to describe my understanding of why the trades in figure P.1 offer great risk-reward ratios, and to present ways to profit from setups like these in both stocks and futures trading. The most important message that I can deliver is to focus on the absolute best trades, avoid the absolute worst setups, and work on increasing the number of shares that you are trading. I freely recognize that every one of my reasons behind each setup is just my opinion, and my reasoning about why a trade works might be completely wrong. However, that is irrelevant. What is important is that reading price action is a very effective way to trade, and I've thought a lot about why certain things happen the way that they do. I am comfortable with my explanations, and they give me confidence when I place a trade, but they are irrelevant to my placing trades, so it is not important to me that they are right. Just as I can reverse my opinion about the direction of the market in an instant, I can also reverse my opinion about why a particular pattern works if I come across a reason that is more logical, or if I discover a flaw in my logic. I am providing the opinions because they appear to make sense, and they may help readers become more comfortable trading certain setups, and because they may be intellectually stimulating, but they are not needed for any price action trades. The book is a comprehensive guide to understanding price action and is directed toward sophisticated traders and market professionals. However, the concepts are useful to traders at all levels. It uses many of the standard techniques described by Edwards and Maggi and many others, but will focus more on individual bars to demonstrate how the information they provide can significantly enhance the risk-reward ratio of trading. Most books point out 3 or 4 trades on a chart, which implies that everything else on the chart is incomprehensible, meaningless, or risky. I believe that there is something to be learned from every tick that takes place during the day, and that there are far more great trades on every chart than just the few obvious ones. But to see them, you have to understand price action, and you cannot dismiss any bars as unimportant. I learned from performing thousands of operations through a microscope that some of the most important things can be very small. I read charts bar by bar and look for any information that each bar is telling me. They are all important. At the end of every bar, most traders ask themselves, what just took place? With most bars, they conclude that it is just too confusing to understand and choose to wait for a pattern that they recognize. It is as if they believe that the bar did not exist, or they dismiss it as just institutional program activity that is not tradable by an individual trader. They do not feel as though they are part of the market at these times, but these times constitute the vast majority of the day. Yet if they look at the volume, all of those bars that they are ignoring have as much volume as the bars they are using for the basis for their trades. Clearly, a lot of trading is taking place, but they don't understand how that can be, and essentially they pretend that it does not exist. But that is denying reality. There is always trading taking place, and as a trader you owe it to yourself to understand why it's taking place and to figure out a way to make money off it. Learning what the market is telling you is very time-consuming and difficult, but it gives you the foundation that you need to be a successful trader. Unlike most books on candle charts, where the majority of readers feel compelled to memorize patterns, this book will provide a rationale for why particular patterns are reliable setups for traders. Some of the terms used have specific meaning to market technicians, but different meanings to traders, and I am writing this entirely from a trader's perspective. Uncertain TP at many traders already understand everything in this book, but likely wouldn't describe price action in the same way that I do. There are no secrets among successful traders, and they all know common setups, and many have their own names for each one. All of them are buying and selling pretty much at the same time, catching the same swings, and each has his own reasons for getting into a trade. Many trade price action intuitively without ever feeling a need to articulate why a certain setup works. I hope that they enjoy reading my understanding of and perspective on price action, and that this gives them some insights that will improve their already successful trading. The goal for most traders is to maximize trading profits through a style that is compatible with their personalities. Without that compatibility, I believe that it is virtually impossible to trade profitably long-term. Many traders wonder how long it will take them to be successful and are willing to lose money for some period of time, even a few years. However, it took me over 10 years to be able to trade successfully. Each of us has many considerations and distractions, so the time will vary, but a trader has to work through most obstacles before becoming consistently profitable. I had several major problems that had to be corrected, including raising 3 wonderful daughters who always filled my mind with thoughts of them and what I needed to be doing as their father. That was solved as they got older and more independent. Then it took me a long time to accept many personality traits as real and unchangeable, or at least I concluded that I was unwilling to change them. And finally, there was the issue of confidence. I have always been confident to the point of arrogant in so many things that those who know me would be surprised that this was difficult for me. However, deep inside I believed that I really would never come up with a consistently profitable approach that I would enjoy employing for many years. Instead, I bought many systems, wrote and tested countless indicators and systems, read many books and magazines, went to seminars, hired tutors, joined chat rooms, and talked with people who presented themselves as successful traders, but I never saw their account statements and suspect that most could teach but few, if any, could trade. Usually in trading, those who know don't talk and those who talk don't know. This was all extremely helpful because it showed all of the things that I needed to avoid before becoming successful. Any non-trader who looks at a chart will invariably conclude that trading has to be extremely easy, and that is part of the appeal. At the end of the day, anyone can look at any chart and see very clear entry and exit points. However, it is much more difficult to do in real time. There is a natural tendency to want to buy the exact low and never have the trade come back. If it does, a novice will take the loss to avoid a bigger loss, resulting in a series of losing trades that will ultimately bust his account. Using wide stops solves that to some extent, but invariably, a trader will soon hit a few big losses that will put him into the red and make him too scared to continue using that approach. I do so many business schools continue to recommend Edwards and Maggi when their book is essentially simplistic, largely using trend lines, breakouts, and pullbacks as the basis for trading. They do so because the system works, and it always has, and it always will. Now that just about all traders have computers with access to intraday data, many of those techniques can be adapted to day trading. Also, candle charts give additional information about who is controlling the market, which results in a more timely entry with smaller risk. Edwards and Maggi's focus is on the overall trend. I use those same basic techniques, but pay much closer attention to the individual bars on the chart to improve the risk-reward ratio, and I devote considerable attention to intraday charts. It seemed obvious to me that if one could simply read the charts well enough to be able to enter at the exact times that the move would take off and not come back, then that trader would have a huge advantage. He would have a high winning percentage, and the few losses would be small. I decided that this would be my starting point, and what I discovered was that nothing had to be added. In fact, any additions are distractions that result in lower profitability. This sounds so obvious and easy that it is difficult for most people to believe. I am a day trader who relies entirely on price action on the intraday E-mini S&P 500 futures, the E-mini charts, and I believe that reading price action well is an invaluable skill for all traders. Beginners often instead have a deep-seated belief that something more is required, that maybe some complex mathematical formula that very few use would give them just the edge that they need. Goldman Sachs is so rich and sophisticated that they must have a supercomputer and high-powered software that gives them an advantage that ensures that all the individual traders are doomed to failure. They start looking at all kinds of indicators and playing with the inputs to customize the indicators to make them just right. Every indicator works some of the time, but for me, they obfuscate instead of elucidate. In fact, without even looking at a chart, you can place a buy order and have a 50% chance of being right. I am not dismissing indicators and systems out of ignorance of their subtleties. I have spent over 10,000 hours writing and testing indicators and systems over the years, and that probably is far more experience than most. This extensive experience with indicators and systems was an essential part of my becoming a successful trader. Indicators work well for many traders, but the best success comes once a trader finds an approach that is compatible with his personality. My single biggest problem with indicators and systems is that I never fully trusted them. At every setup, I saw exceptions that needed to be tested. I always wanted every last penny out of the market and was never satisfied with a return from a system if I could incorporate a new twist that would make it better. I am simply too controlling, compulsive, restless, observant, and untrusting to make money long-term off indicators or automated systems, but I am at the extreme in many ways, and most people don't have these same issues. Many traders, especially beginners, are drawn to indicators, hoping that an indicator will show them when to enter a trade. What they don't realize is that the vast majority of indicators are based on simple price action, and when I am placing trades, I simply cannot think fast enough to process what several indicators might be telling me. Also, oscillators tend to make traders look for reversals and focus less on price charts. These can be effective tools on most days when the market has 2 or 3 reversals lasting an hour or more. The problem comes when the market is trending strongly. If you focus too much on your indicators, you will see that they are forming divergences all day long, and you may find yourself repeatedly entering countertrend and losing money. By the time you come to accept that the market is trending, you will not have enough time left in the day to recoup your losses. Instead, if you were simply looking at a bar or candle chart, you would see that the market is clearly trending, and you would not be tempted by indicators to look for trend reversals. The most common successful reversals first break a trend line with strong momentum, and then pull back to test the extreme. And if a trader focuses too much on divergences, she will often overlook this fundamental fact. Divergence in the absence of a countertrend momentum surge that breaks a trend line is a losing strategy. Wait for the trend line break, and then see if the test of the old extreme reverses or if the old trend resumes. You do not need an indicator to tell you that a strong reversal here is a high probability trade, at least for a scalp, and there will almost certainly be a divergence. So why complicate your thinking by adding the indicator to your calculus? Some pundits recommend a combination of time frames, indicators, wave counting, and Fibonacci retracements and extensions. But when it comes time to place the trade, they will only do it if there is a good price action setup. Also, when they see a good price action setup, they start looking for indicators that show divergences or different time frames for moving average tests or wave counts or Fibonacci setups to confirm what is in front of them. In reality, they are price action traders who are trading exclusively off price action on only one chart, but don't feel comfortable admitting it. They are complicating their trading to the point that they certainly are missing many trades because their overanalysis takes too much time to place their orders, and they are forced to wait for the next setup. The logic just isn't there for making the simple so complicated. Obviously, adding any information can lead to better decision-making, and many people may be able to process lots of inputs when deciding whether to place a trade. Ignoring data because of a simplistic ideology alone is foolish. The goal is to make money, and a trader should do everything he can to maximize his profits. I simply cannot process multiple indicators and time frames well in the time needed to place my orders accurately, and I find that carefully reading a single chart is far more profitable for me. Also, if I rely on indicators, I find that I get lazy in my price action reading and often miss the obvious. Price action is far more important than any other information, and if you sacrifice some of what it is telling you to gain information from something else, you are likely making a bad decision. There are countless ways to make money trading stocks and E-minis, but all require movement well, except for shorting options. If you learn to read the charts, you will catch a great number of these profitable trades every day without ever knowing why some institution started the trend, and without ever knowing what any indicator is showing. You don't need their software or analysts because they will show you what they are doing. All you have to do is piggyback onto their trades, and you will make a profit. Price action will tell you what they are doing and allow you an early entry with a tight stop. I have found that I consistently make far more money by minimizing what I have to consider when placing a trade. All I need is a single chart on my laptop computer with no indicators, except a 20-bar exponential moving average, which does not require too much analysis and clarifies many good setups each day. I sometimes trade even without the moving average, but it provides enough setups that it is usually worth having on the chart. Volume on 1-minute charts is also sometimes minimally useful when looking for a sign that trend reversal might be imminent. But I never look at it because I trade mostly off the 5-minute chart. Rarely, I will take an early 5-minute with trend entry off the 1-minute chart. An unusually large 1-minute volume spike often comes near the end of a bear trend, and the next new swing low or two often provide profitable long scalps. However, this is simply an observation. It is far too unreliable to be a part of your trading and should be ignored. Volume spikes also sometimes occur on daily charts when a sell-off is overdone. Even traders who base their trades on a collection of indicators routinely look at price action when placing their entries and exits. Who wouldn't feel better about buying a divergence if there was also a strong reversal bar at the low? However, charts provide far more information about who is in control of the market than most traders realize. Almost every bar offers important clues as to where the market is going, and a trader who dismisses any activity as noise is passing up many profitable trades each day. As a trader, I see everything in shades of gray and am constantly thinking in terms of probabilities. If a pattern is setting up and it is not perfect, but it is reasonably similar to a reliable setup, it will likely behave similarly as well. Close is usually close enough. If something resembles a textbook setup, the trade will likely unfold similarly to the trade from the textbook setup. This is the art of trading, and it takes years to become good at trading in the gray zone. Everyone wants concrete, clear rules or indicators, and chat rooms, newsletters, hotlines, or tutors that will tell them when exactly to get in to minimize risk and maximize profit, but none of it works in the long run. You have to take responsibility for your decisions, but you first have to learn how to make them, and that means that you have to get used to operating in the gray fog. Nothing is ever as clear as black and white, and I have been doing this long enough to appreciate that anything, no matter how unlikely, can and will happen. It's like quantum physics. Every conceivable event has a probability, and so do events that you have yet to consider. It is not emotional, and the reasons why something happens are irrelevant. Watching to see if the Feds cut rates today is a waste of time because there is both a bullish and bearish interpretation of anything that they do. What is key is to see what the market does, not what the Fed does. Never watch the news during the trading day. If you want to know what a news event means, the chart in front of you will tell you. If a pundit on CNBC announces that a report was bearish and the market goes up, are you going to look to short? Only look at the chart, and it will tell you what you need to know. The chart is what will give you money or take money from you, so it is the only thing that you should ever consider when trading. If you are on the floor, you can't even trust what your best friend is doing. He might be offering a lot of orange juice calls but secretly having a broker looking to buy 10 times as many below the market. Your friend is just trying to create a panic to drive the market down so he can load up through a surrogate at a much better price. There is one other problem with the news. Invariably, when the market makes a huge move, the reporters will find some confident, convincing expert who predicted it and interview him, leading the viewers to believe that this pundit has an uncanny ability to predict the market, despite the untold reality that this same pundit has been wrong in his last 10 predictions. The pundit then makes some future prediction, and the naive viewer will attach significance to it and let it affect his trading. What the viewer may not realize is that some pundits are bullish 100% of the time and others are bearish 100% of the time, and still others just swing for the fences all of the time and make outrageous predictions. The reporter just rushes to the one who is consistent with the day's news, which is totally useless to a trader. In fact, It is destructive because it can influence his trading and make him question and deviate from his own methods. So, if you really must watch TV during the trading day, I recommend cartoons or foreign language shows, so there will be no chance that the show will influence your trading. Friends and colleagues freely offer opinions for you to ignore. Occasionally, traders will tell me that they have a great setup and want to discuss it with me. I invariably get them angry at me when I tell them that I am not interested. They immediately perceive me as selfish, stubborn, and close-minded, and when it comes to trading, I am all of that and probably much more. The skills that make you money are generally seen as flaws to the lay person. Why do I no longer read books or articles about trading or talk to other traders about their ideas? As I said, the chart tells me all that I need to know, and any other information is a distraction. Several people have been offended by my attitude, but I think it in part comes from me turning down what they are presenting as something helpful to me when in reality they are making an offering, hoping that I will reciprocate with some tutoring. They become frustrated and angry when I tell them that I don't want to hear about anyone else's trading techniques. I tell them that I haven't even mastered my own and probably never will, but I am confident that I will make far more money perfecting what I already know than trying to incorporate non-price action approaches into my trading. I asked them if James Galway offered a beautiful flute to Yo-Yo Ma and insisted that Yo-Yo start learning the flute because Galway makes so much money by playing his flute. Should Ma accept the offer? Clearly not. Ma should continue to become better and better at the cello, and by doing so he will make far more money than if he also started playing the flute. I am no Galway or Ma, but the concept is the same. Price action is the only instrument that I want to play, and I strongly believe that I will make far more money by mastering it than by incorporating ideas from other successful traders. Yesterday, Costco's earnings were up 32% on the quarter and above analysts' expectations. It gapped up on the open, tested the gap on the first bar, and then ran up over $1 in 20 minutes. See figure P.2. It then drifted down to test yesterday's close. It had two rallies that broke bear trend lines and both failed. This created a double top, bars 2 and 3, bear flag or triple top, bars 1, 2, and 3, and the market then plunged $3, below the prior day's low. If you were unaware of the report, you would have shorted at the failed bear trendline breaks at bars 2 and 3, and you would have sold more on the breakout pullback at bar 4. You would have reversed to long on the bar 5 big reversal bar, which was the second attempt to reverse the breakout below yesterday's low, and a climactic reversal of the breakout of the bottom of the steep bear trend channel line. Alternatively, you could have bought the open because of the bullish report, and then worried about why the stock was collapsing instead of soaring the way that TV analysts predicted, and you likely would have sold out your long on the second plunge down to bar 5. Any trend that covers a lot of points in very few bars, meaning that there's some combination of large bars and bars with very little overlap, will eventually have a pullback. These trends have such strong momentum that the odds favor a test of the trend's extreme after the pullback, and usually the extreme will be exceeded, as long as the pullback does not become a new trend and extend beyond the start of the prior trend. In general, the odds that a pullback will get back to the prior trend's extreme fall substantially if the pullback retraces 75% or more. For a pullback in a bear at that point, a trader is better to think of the pullback as a new bull trend rather than a pullback in an old bear. Bar 6 was about a 70% pullback, and then the market tested the climactic bear low on the open of the next day. The only thing that is as it seems is the chart. If you cannot figure out what it is telling you, do not trade. Wait for clarity, it will always come. But once it is there, you must place the trade and assume the risk and follow your plan. Do not dial down to a 1-minute chart and tighten your stop because you will lose. The problem with the 1-minute chart is that it tempts you by offering lots of entries. However, you will not be able to take them all and you will instead cherry pick, which will lead to the death of your account. You will invariably pick too many bad cherries. The best trades often happen too fast for you to place your orders, and that means you will be choosing among the less desirable trades and will lose more often. When you enter on a 5-minute chart, your trade is based on your analysis of the 5-minute chart without any idea of what the 1-minute looks like. You must therefore rely on your 5-minute stops and targets, and just accept the reality that the 1-minute chart will move against you and hit a 1-minute stop frequently. If you watch the 1-minute chart, you will not be devoting your full attention to the 5-minute chart, and I will take your money from your account and put it in my account. If you want to compete, you must minimize all distractions and all inputs other than what is on the chart in front of you, and trust that if you do, you will make a lot of money. It will seem unreal, but it is very real. Never question it. Just keep things simple and follow your simple rules. It is extremely difficult to consistently do something simple, but in my opinion, it is the best way to trade. Ultimately, as a trader understands price action better and better, trading becomes much less stressful and actually pretty boring, but much more profitable. Although I never gamble because the odds are against me and I never want to bet against math, there are some similarities with gambling, especially in the minds of those who don't trade. For example, some traders use simple game theory and increase the size of a trade after one or more losing trades. Blackjack card counters are very similar to trading range traders. The card counter is trying to determine when the math has gone too far in one direction. In particular, he wants to know then the remaining cards in the deck are likely overweighed with face cards. When his count indicates that this is likely, he places a trade bet based on the probability that a disproportionate number of face cards will be coming up, increasing his odds of winning. A trading range trader is looking for times when he thinks the market has gone too far in one direction, and then he places his trade in the opposite direction, a fade. One unfortunate reality is that there are aspects of trading that are very similar to gambling. The most important one is that many losing games win often enough to make you believe that you will be able to find a way to win at them in the long run. You are fighting relentless, unstoppable math, and you will go broke trying to beat it. The most obvious example is trading off the 1-minute chart. Since it looks the same as the 5-minute, and since you can make many winning trades day trading it, it is logical to conclude that you can use it as your primary chart. However, too many of the best trades happen too fast to catch, and you will find yourself left with the second-tier trades. Over time, you will either go broke or make substantially less than you would off the 5-minute chart. One unfortunate comparison is from non-traders who assume that all day traders, and all market traders for that matter, are addicted gamblers and therefore have a mental illness. I suspect that many are in that they are doing it more for excitement than for profit, and are willing to make low-probability bets and lose large sums of money because of the huge rush they feel when they occasionally win. However, most successful traders are essentially investors, just like an investor who buys commercial real estate or a small business. The only real differences from any other type of investing are that the time frame is shorter and the leverage is greater. One final point about gambling. Monte Carlo techniques work well in theory, but not in practice, because of the conflict between math and emotion. If you double or even triple your position size and reverse at each loss, you will theoretically make money. Although 4 losers in a row is rare on the 5-minute E-mini chart, especially if you avoid trading in small sideways trading ranges in the middle of the day's range, they will happen, and so will 6, 7 or more, even though I can't remember ever seeing that. In any case, if you are comfortable trading 10 contracts and you decide to double and reverse with each loser, but begin with 1 contract, 4 consecutive losers would require 16 contracts, and it is unlikely that you would place a trade that is larger than your comfort zone following 4 losers. Also, if you like trading 10 contracts, you will not be satisfied with the profit from trading 1 contract, which is what you would end up trading most of the time. Lay people are also concerned about the risk of crashes, and because of that risk, they again associate trading with gambling. Crashes are very rare on daily charts but common on intraday charts. They are afraid of their inability to function effectively during extremely emotional events. Although the term crash is generally reserved for daily charts and applied to bear markets of about 20% or more happening in a short time frame, like in 1927 and 1987, it is more useful to think of it as just a simple and common chart pattern, because that removes the emotion and helps a trader follow his rules. If you remove the time and price axes from a chart and focus simply on the price action, there are market movements that occur on intraday charts that are indistinguishable from the patterns in a classic crash. If you can get past the emotion, you can make money off crashes because with all charts, they display tradable price action. Figure P.3 from TradeStation shows how markets can crash in any time frame. The one on the left is a daily chart of GE during the 1987 crash. The middle is a 5-minute chart of cost after a very strong earnings report, and the one on the right is a 1-minute E-mini chart. Although the term crash is used almost exclusively to refer to a 20% or more sell-off over a short time on a daily chart, and was widely used only twice in past 100 years, a price action trader looks for shape, and the same crash pattern is common on intraday charts. Since crashes are so common intraday, there is no need to apply the term because from a trading perspective, they are just a bear swing with tradable price action. Most traders only consider price action when trading divergences and trend pullbacks. They like to see a strong close on a large reversal bar, but in reality, this is a fairly rare occurrence. Most useful tools for understanding price action are trend lines and trend channel lines, prior highs and lows, breakouts and failed breakouts, the size of bodies and tails on candles, and relationships between the current bar to the prior several bars. In particular, how the open, high, low, and close of the current bar compare to the action of the prior several bars tells a lot about what will happen next. Most of the observations in this book are directly related to placing trades, but a few have to do with simple curious price action tendencies without sufficient dependability to be the basis for a trade. I personally rely mainly on candle charts for E-mini trading and bar charts for stock trading, but most signals are also visible on any type of chart, and many are even evident on simple line charts. I will focus primarily on 5-minute candle charts to illustrate basic principles, but will also thoroughly discuss daily and weekly charts as well. Additionally, I place intraday swing trades on several stocks each day and make occasional option purchases based on daily charts, and will discuss how using price action alone can be the basis for this type of trading. Most of the charts in the book demonstrate many different concepts, and I indicated key price action observations on most. Because of this, almost any chart could be on any page, but I placed them in the section where I thought they best illustrated a point. Many charts reference setups that are described later in the book, but when they are clear examples of important setups, I point them out, which should be helpful on a second read through the book. Also, almost every pattern that you see during the day can be placed into several categories in this book. Don't waste time deciding if a reversal is unfolding as a double bottom pullback or a spike in trading range low or a simple higher low. You are a trader, not a file clerk. When you see a reversal pattern, just take the trade and don't labor over which name most accurately applies. Also, not all chapters are created equal. Some are essential to your success, whereas others are included for completeness. If you are a beginner, focus on Chapter 15 because it describes the best trades, and then refer back to the appropriate earlier chapters to learn more. Don't spend a lot of time on concepts like magnets and measured moves, because that is not where the money is. They are included simply because they demonstrate aspects of price action, but do not offer reliable trading patterns. Since I trade in California, all of the charts are in Pacific Standard Time. All of the charts were created with TradeStation. Chapter 1: Price Action. For a trader, the fundamental issue that confronts him repeatedly throughout the day is the decision of whether the market is trending or not trending. If it is trending, he assumes that the trend will continue and he will look to enter in the direction of the trend, with trend. If it is not trending, he will look to enter in the opposite direction of the most recent move, fade, or countertrend. A trend can be as short as a single bar on a smaller time frame. There can be a strong trend contained within that bar, or on a 5-minute chart, it can last a day or more. How does he make this decision? By reading the price action on the chart in front of him. The most useful definition of price action for a trader is also the simplest. It is any change in price on any chart type or time frame. The smallest unit of change is the tick, which has a different value for each market. Incidentally, a tick has two meanings. It is the smallest unit of change in price that a market can make, and it is also every trade that takes place. So if you buy, your order will appear on the time and sales table, and your fill, no matter how large or small, is one tick. Since price is changing with every tick trade during the day, each price change becomes an example of price action. There is no universally accepted definition of price action, and since you need to always try to be aware of even the seemingly least significant piece of information that the market is offering, you must have a very broad definition. You cannot dismiss anything, because very often something that initially appears minor leads to a great trade. The broadest definition includes any representation of price movement during the course of trading. This includes any financial instrument, on any type of chart, in any time frame. The definition alone does not tell you anything about placing a trade because every bar is a potential signal both for a short and a long trade. There are traders out there who will be looking to short the next tick, believing that the market won't go one tick higher, and others who will buy it believing that the market will likely not go one tick lower. One side will be right, and the other will be wrong. If the buyers are wrong and the market goes one tick lower and then another, they will begin to entertain the prospect that their belief is wrong. At some point, they will have to sell their position at a loss, making them new sellers and no longer buyers, and this will drive the market down further. Sellers will continue to enter the market, either as new shorts or as longs forced to liquidate, until some point when more buyers come in. These buyers will be a combination of new buyers, profit-taking shorts, and new shorts who now have a loss and will have to buy to cover their positions. The market will continue up until the process reverses once again. Everything is relative, and everything can change into the exact opposite in an instant, even without any movement in price. It might be that you suddenly see a trend line 7 ticks above the high of the current bar, and instead of looking to short, you now are looking to buy for a test of the trend line. Trading through the rearview mirror is a sure way to lose money. You have to keep looking ahead, not worrying about the mistakes you just made. They have absolutely no bearing on the next tick, so you must ignore them and just keep reassessing the price action and not your profit and loss P&L on the day. Each tick changes the price action of every time frame chart from a tick chart or 1-minute chart through a monthly chart. And on all charts, whether the chart is based on time, volume, the number of ticks, point and figure, or anything else. Obviously, a single tick move is usually meaningless on a monthly chart unless, for example, it is a 1-tick breakout of some chart point that immediately reverses, but it becomes increasingly more useful on smaller time frame charts. This is obviously true because if the average bar today on a 1-minute E-mini chart is 3 ticks tall, then a 1-tick move is 33% of the size of the average bar, and that can represent a significant move. The most useful aspect of price action is watching what happens after the market breaks out beyond prior bars or trend lines on the chart. For example, if the market goes above a significant prior high and each subsequent bar forms a low that is above the prior bar's low and a high that is above the prior bar's high, then this price action indicates that the market will likely be higher on some subsequent bar, even if it pulls back for a few bars near term. On the other hand, if the market breaks out to the upside, and then the next bar is a small inside bar, its high is not higher than that of the large breakout bar, and then the following bar has a low that is below this small bar, the odds of a failed breakout and a reversal back down increase considerably. Over time, fundamentals control the price of a stock, and that price is set by institutional traders like mutual funds, banks, brokerage houses, insurance companies, pension funds, hedge funds, and so on, who are by far the biggest volume players. Price action is the movement that takes place along the way as institutions probe for value. When they feel that the price is too high, they will exit or even short, and when they feel it is too low a good value, they will go long or take profits on their shorts. Although conspiracy theorists will never believe it, institutions do not have secret meetings to vote on what the price should be in an attempt to steal money from unsuspecting, well-intentioned individual traders. Their voting is essentially independent and secret, and comes in the form of their buying and selling, but the results are displayed on price charts. In the short run, an institution can manipulate the price of a stock, especially if it is thinly traded. However, they would make relatively much less money doing that compared to what they could make in other forms of trading, making the concern of manipulation of negligible importance, especially in stocks and markets where huge volume is traded, like the E-minis, major stocks, debt instruments, and currencies. Why does price move up 1 tick? It is because there is more volume being bid at the current price than being offered, and a number of those buyers are willing to pay even more than the current price if necessary. This is sometimes described as the market having more buyers than sellers, or as the buyers being in control, or as buying pressure. Once all of those buy orders that can possibly be filled are filled at the current price, the last price traded, The remaining buyers will have to decide whether they are willing to buy at one tick higher. If they are, they will continue to bid at the higher price. This higher price will make all market participants reevaluate their perspective on the market. If there continues to be more volume being bid than offered, price will continue to move up since there are an insufficient number of contracts being offered by sellers at the last price to fill the requests to buy by buyers. At some point, buyers will start offering some of their contracts as they take partial profits. Also, sellers will perceive the current price as a good value for a short and offer to sell more than buyers want to buy. Once there are more contracts being offered by sellers, either buyers who are looking to cover some or all of their long contracts, or by new sellers who are attempting to short, all of the buy orders will be filled at the current price, but some sellers will be unable to find enough buyers. Bid will move down a tick. If there are sellers willing to sell at this lower price, this will become the new last price. Upside, and then the next bar is a small inside bar. Its high is not higher than that of the large breakout bar. And then the following bar has a low that is below this small bar. The odds of a failed breakout and a reversal back down increase considerably. Over time, fundamentals control the price of a stock, and that price is set by institutional traders like mutual funds, banks, brokerage houses, insurance companies, pension funds, hedge funds, and so on, who are by far the biggest volume players. Price action is the movement that takes place along the way as institutions probe for value. When they feel that the price is too high, they will exit or even short, and when they feel it is too low a good value, they will go long or take profits on their shorts. Although conspiracy theorists will never believe it, institutions do not have secret meetings to vote on what the price should be in an attempt to steal money from unsuspecting, well-intentioned individual traders. Their voting is essentially independent and secret, and comes in the form of their buying and selling, but the results are displayed on price charts. In the short run, an institution can manipulate the price of a stock, especially if it is thinly traded. However, they would make relatively much less money doing that compared to what they could make in other forms of trading, making the concern of manipulation of negligible importance, especially in stocks and markets where huge volume is traded, like the E-minis, major stocks, debt instruments, and currencies. Why does price move up one tick? It is because there is more volume being bid at the current price than being offered, and a number of those buyers are willing to pay even more than the current price if necessary. This is sometimes described as the market having more buyers than sellers, or as the buyers being in control, or as buying pressure. Once all of those buy orders that can possibly be filled are filled at the current price, the last price traded, the remaining buyers will have to decide whether they are willing to buy at one tick higher. If they are, they will continue to bid at the higher price. This higher price will make all market participants reevaluate their perspective on the market. If there continues to be more volume being bid than offered, price will continue to move up since there are an insufficient number of contracts being offered by sellers at the last price to fill the requests to buy by buyers. At some point, buyers will start offering some of their contracts as they take partial profits. Also, sellers will perceive the current price as a good value for a short and offer to sell more than buyers want to buy. Once there are more contracts being offered by sellers, either buyers who are looking to cover some or all of their long contracts or by new sellers who are attempting to short, all of the buy orders will be filled at the current price, but some sellers will be unable to find enough buyers. The bid will move down a tick. If there are sellers willing to sell at this lower price, this will become the new last price. Since most markets are driven by institutional orders, it is reasonable to wonder whether the institutions are basing their entries on price action, or whether their actions are causing the price action. The reality is that institutions are not all watching Apple or SPY tick by tick, and then starting a buy program when they see a two-legged pullback on a 1-minute chart. They have a huge number of orders to be filled during the day and are working to fill them at the best price. Price action is just one of many considerations, and some firms will rely more on it, and others will rely on it less or not at all. Many firms have mathematical models and programs that determine when and how much to buy and sell, and all firms continue to receive new orders from clients all day long. The price action that traders see during the day is the result of institutional activity, and much less the cause of the activity. When a profitable setup unfolds, there will be a confluence of unknowable influences taking place during the trade that results in the trade being profitable, or a loser. The setup is the actual first phase of a move that is already underway, and a price action entry lets a trader just jump onto the wave early on. As more price action unfolds, more traders will enter in the direction of the move, generating momentum on the charts, causing additional traders to enter. Traders, including institutions, place their bids and offers for every imaginable reason, and the reasons are largely irrelevant. However, one reason that is relevant because it is evident to smart price action traders is to benefit from trap traders. If you know that protective stops are located at one tick below a bar and will result in losses to traders who just bought, then you should get short on a stop at that same price to make a profit off the trapped traders as they are forced out. Since institutional activity controls the move and their volume is so huge, and they place most of their trades with the intention of holding them for hours to months, most will not be looking to scalp, and instead they will defend their original entry. If Vanguard or Fidelity have to buy stock for one of their mutual funds, their clients will want the fund to own stock at the end of the day. Clients do not buy mutual funds with the expectation that the funds will day trade and end up in all cash by the close. The funds have to own stock, which means they have to buy and hold, not buy and scalp. For example, after their initial buy, they will likely have much more to buy and will use any small pullback to add on. If there is none, they will continue to buy as the market rises. Some beginner traders wonder who is buying as the market is going straight up and also wonder why anyone would buy at the market instead of waiting for a pullback. The answer is simple. It is institutions working to fill all of their orders at the best possible price, and they will buy in many pieces as the market continues up. A lot of this trading is being done by institutional computer programs, and it will end after the programs are complete. If a trade fails, it is far more likely the result of the trader misreading the price action than it is of an institution changing its mind, or taking a couple ticks of profit within minutes of initiating a program. The only importance of realizing that institutions are responsible for price action is that it makes placing trades based on price action more reliable. Most institutions are not going to be day trading in and out, making the market reverse after every one of your entries. Your price action entry is just a piggyback trade on their activity, but unlike them, you are scalping all or part of your trade. There are some firms that day trade substantial volume. However, for their trades to be profitable, the market has to move many ticks in their direction, and a price action trader will see the earliest parts of the move, allowing her to get in early and be confident that the odds of a successful scalp are high. That firm cannot have the market go 15 ticks against them if they are trying to scalp 4 or 8 ticks. As such, they will enter only when they feel that the risk of an adverse move is small. If you read their activity on the charts, you should likewise be confident in your trade, but always have a stop in the market in case your read is wrong. Also, since often the entry bar extreme is tested to the tick and the stops are not run, there must be institutional size volume protecting the stops, and they are doing so based on price action. In the 5-minute E-mini, there are certain price action events that change the perspective of smart traders. For example, if a high too long pullback fails, smart traders will assume that the market will likely have 2 more legs down. If you are an institutional trader and you bought that high too, you do not want it to fail, and you will buy more all the way down to 1 tick above that key protective stop price. That institution is using price action to support their long. The big legs are essentially unstoppable, but the small price action is fine-tuned by some institutional traders who are watching every tick. Sometimes when there is a 5-tick long failure setting up, and the price just keeps hitting 5 ticks, but not 6 where you can scalp 4 ticks out of your long, there will suddenly be a trade of 250 E-mini contracts, and the price does not tick down. In general, anything over 100 contracts should be considered institutional in today's E-mini market. Even if it is just a large individual trader, he likely has the insight of an institution, and since he is trading institutional volume, he is indistinguishable from an institution. Since the price is still hanging at 5 ticks, almost certainly that 250 lot order was an institutional buy. This is because if institutions were selling in a market filled with nervous longs, the market would fall quickly. When the institutions start buying when the market is up 5 ticks, they expect it to go more than just 1 tick higher, and usually, within a minute or so, the price will surge through 6 ticks and swing up for at least many more. The institutions were buying at the high, which means that they think the market will go higher, and they will likely buy more as it goes up. Also, since 4-tick scalps work so often, it is likely that there is institutional scalping that exerts a great influence over most scalps during the day. Traders pay close attention to the seconds before key time frames close, especially 3, 5, 15, and 60-minute bars. This is also true on key volumes for volume bar charts. For example, if many traders follow the 10,000 shares per bar chart for the 10-year note futures contract, then when the bar is about to close, it closes on the first trade of any size that results in at least 10,000 shares traded since the start of the bar, so the bar is rarely ever exactly 10,000 shares. There may be a flurry of activity to influence the final appearance of the bar. One side might want to demonstrate a willingness to make the bar appear more bullish or bearish. In simplest terms, a strong bull trend bar means that the bulls own the bar. It is very common in strong trends for a reversal bar to totally reverse its appearance in the final few seconds before a 5-minute bar closes. For example, in a strong bear, there might be a high too long setting up with a very strong bull reversal bar. Then, with 5 seconds remaining before the bar closes, the price plummets, and the bar closes on its low, trapping lots of front-running longs who expected a bull trend reversal bar. When trading countertrend against a strong trend, it is imperative to wait for the signal bar to close before you place your order, and then only enter on a stop at 1 tick beyond the bar in the direction of your trade. If you are buying, buy at 1 tick above the high of the prior bar on a stop. What is the best way to learn how to read price action? It is to print out charts and then look for every profitable trade. If you are a scalper looking for 50 cents in Opal or $2 in Goog on the 5-minute chart, then find every move during the day where that amount of profit was possible. After several weeks, you will begin to see a few patterns that would allow you to make those trades while risking about the same amount. If the risk is the same as the reward, you have to win much more than 50% of the time to make the trade worthwhile. However, lots of patterns have a 70% or better success rate, and many trades allow you to move up your stop from below the signal bar extreme to below the entry bar extreme while waiting for your profit target to be reached, reducing your risk. Also, you should be trying to enter trades that have a good chance of running well past your profit target, and you should therefore only take partial profits. In fact, initially you should only focus on those entries. Move your stop to break-even, and then let the remainder run. You will likely have at least a couple of trades each week that run to 4 or more times your initial target before setting up a reverse entry pattern. Fibonacci retracements and extensions are a part of price action, but since most are just approximations and most fail, do not use them for trading. If one is good, it will be associated with a chart pattern that is reliable and tradable on its own, independent of the Fibonacci measurement or any indicators. Elliott wave theory is also a type of price action analysis, but for most traders it is not tradable. The waves are usually not clear until many bars after the ideal entry point, and with so many opposite interpretations at every instant, it requires far too much thought and uncertainty for most active day traders. Should you be concerned that making the information in this book available will create lots of great price action traders, all doing the same thing at the same time, thereby removing the late entrants needed to drive the market to your price target? No, because the institutions control the market, and they already have the smartest traders in the world, and those traders already know everything in this book, at least intuitively. The reason that the patterns that we all see unfold as they do is because that is the appearance that occurs in an efficient market with countless traders placing orders for thousands of different reasons, but with the controlling volume being traded based on sound logic. That is just what it looks like, and it has forever. The same patterns unfold on all time frames in all markets around the world, and it would simply be impossible for all of it to be manipulated instantaneously on so many different levels. If everyone suddenly became a price action scalper, the smaller patterns might change a little for a while, but over time, the efficient market will win out, and the votes by all traders will get distilled into standard price action patterns, because that is the inescapable result of countless people behaving logically. Also, the reality is that it is very difficult to trade, and although basing trades on price action is a sound approach, it is still very difficult to do real time. There just won't be enough traders doing it well enough, all at the same time, to have any significant influence over time on the patterns. Just look at Edwards and Maggi. The best traders in the world have been using those ideas for decades, and they continue to work, again for the same reason charts look the way they do, because that is the unchangeable fingerprint of an efficient market filled with a huge number of smart people using a huge number of approaches and time frames, all trying to make the most money that they can. Trend bars and doji bars. The market is either trending on the chart in front of you, or it is not. When it is not, it is in some kind of trading range, which is composed of trends on smaller time frames. On the level of an individual bar, it is either a trend bar or a trading range bar. Either the bulls or bears are in control of the bar, or they are largely in equilibrium, a one-bar trading range. For a trader, it is most useful to think of all bars as being either trend bars or non-trend trading range bars. Since the latter is an awkward term and most are similar to dojis, it is simpler to refer to all non-trend bars as Dojis doji bars, see Figure 1. 1. If the body appears tiny or non-existent on the chart, the bar is a doji, and neither the bulls nor bears controlled the bar, and the bar is essentially a one-bar trading range. On a 5-minute E-mini chart, a doji body is only a tick or two large. However, on a daily or weekly Google chart, the body can be 100 ticks $1 or more and still have the same significance as a perfect doji, and therefore it makes sense to refer to it as a doji. The determination is relative and subjective, and it depends on the market and the time frame. If there is a body, then the close trended away from the open, and the bar is a trend bar. Obviously, if the bar is large and the body is small, there was not much trending strength. Also, within the bar as seen on a smaller time frame, there may have been several swings of largely sideways movement, but this is irrelevant because you should focus on only one chart. Larger bodies in general indicate more strength, but an extremely large body after a protracted move or a breakout can represent an exhaustive end of a trend, and no trade should be taken until more price action unfolds. A series of strong trend bars is the sign of a healthy trend and will usually be followed by a further extreme, even if a pullback immediately ensues. An ideal trend bar is one with a moderate size body, indicating that the market trended away from the open of the bar by the time the bar closed. The minimum is a close above the open in a bull trend bar, indicated by a white candle body in this book. The bulls can demonstrate stronger control by having the body be about the size or larger than that of the median body size over the past 5 or 10 bars. Additional signs of strength include the open being on or near the low, the close on or near the high, the close at or above the closes and highs of several prior bars, the high above the high of one or more prior bars, and the tails being small. If the bar is very large, it might represent exhaustion or a one-bar false breakout that is trapping new bulls, only to reverse down in the next bar or two. The opposite is true for bear trend bars. Everything is relative and subject to constant reassessment, even to the point of totally changing your opinion about the direction of the market. Yes, every bar is either a trend bar or a doji bar, and a doji bar means that the bulls and bears are in balance. However, sometimes a series of dojis can mean that a trend is in effect. For example, if there is a series of dojis, each with a higher close and most with a high above the high of the prior bar and a low above the low of the prior bar, the market is displaying trending closes, highs, and lows, so a trend is in effect, see Figure 1.2. For trading purposes, It is useful to think of all bars are either trend bars or dojis or non-trend bars, shown in Figure 1.1 with a D, and the labeling is loose. One bar with a small body could be a doji in one area of price action, but a small trend bar in another. The only purpose for the distinction is to help you quickly assess whether one side is in control of the bar or if bulls and bears are at a stalemate. Several of the bars in Figure 1 could arguably be thought of as both trend bars and dojis. The 5-minute chart on the right of Figure 1.2 had 4 dojis in a row, starting at bar 1, each with trending closes, highs and lows. The 15-minute chart on the left of Figure 1.2 shows that they created a bull reversal bar at what was then a new swing low and a bear trend channel line overshoot, not drawn. Individual dojis mean that neither the bulls nor the bears are controlling the market, but trending dojis indicate a trend. Bar 4 was a doji, which is a 1-bar trading range, but it still can be a good setup bar, depending on context. Here it was a failed final flag and Roman 2 flag and an EMA gap bar short setup, and therefore a reliable signal. Just like dojis don't always mean the market is trendless, a trend bar does not always mean that the market is trending. Bar 1 in Figure 1.3 is a strong bull trend bar that broke out of a line of dojis. However, there was no follow-through. The next bar extended 1 tick above the trend bar and then closed on its low. The longs exited at 1 tick below this bear pause bar and new shorts sold there as well, viewing this as a failed bull breakout. No one was interested in buying without more bullish price action, and this caused the market to drop. The bulls tried to protect the low of the bull breakout bar by forming a small bull trend bar. Bar 2 was a setup for a breakout pullback long, but it was never triggered. But the market fell though its low, and these new early bulls exited again there, and more new shorts came in. At this point, after the bulls failed in 2 attempts, they would not be willing to buy without substantial price action in their favor, and both they and the bears would be looking for at least 2 legs down. Bar basics, signal bars, entry bars, setups, and candle patterns. Traders look for setups all day long. A setup is a chart pattern composed of 1 or more bars that leads a trader to believe that an order can be placed that has a good chance of resulting in a profitable trade. In practice, every bar on the chart is a setup because the next bar always can be the start of a strong move in either direction. If the trade is in the direction of the recent or prevailing trend, it is a with trend, and if it is in the opposite direction, it is a counter-trend setup. For example, if the recent trend is up and you buy, the setup was a with trend setup. If instead you shorted, the setup that you used as the basis for your trade was a counter-trend setup, and your short was a counter-trend trade. A signal bar is always labeled in hindsight, after the bar has closed and after a trade is entered. As soon as your entry order is filled, the prior bar becomes a signal bar instead of just a setup bar, and the current bar is the entry bar. A beginner trader should only enter when the signal bar is also a trend bar in the direction of his trade. For example, if he is shorting, he should restrict himself to signal bars that are bear trend bars, because then the market has already demonstrated selling pressure, and the odds of follow-through are higher than if the signal bar had a close above its open. Similarly, when a beginner is looking to buy, he should only buy when the signal bar has a close above its open. Almost every bar is a potential signal bar, but the majority never lead to an entry, and therefore do not become signal bars. As a day trader, you will place many orders that never get filled. It is usually best to enter on a stop at 1 tick above or below the prior bar, and if the stop is not hit, cancel the order and look for a new location for an order. For stocks, it is often better to place the entry stop at a couple of ticks beyond the potential signal bar because 1-tick traps are common, where the market breaks out by only 1 tick and then reverses, trapping all of the traders who just entered on stops. If the entry stop order is hit, you base the trade in part on the prior bar, so that bar is called the signal bar. It gave you a signal that you needed to place an order. Often a bar can be a setup bar in both directions, and you will place entry stops beyond both extremes and will enter in the direction of either bar breakout. Much has been written about candle patterns, and it feels as if their unusual Japanese names must mean that they have some mystical power, and that they are derived from special ancient wisdom. This is just what novice traders are looking for, the power of the gods telling them what to do, instead of relying on their own hard work. For a trader, the single most important issue is determining whether the market is trending or in a trading range. When it comes to analyzing an individual bar, the issue is also whether it is trending or not. If either the bulls or bears are in control, the candle has a body and is a trend bar. If they are in a state of equilibrium and the body is small or non-existent, it is a doji. Many candle traders use the term wick to refer to the lines that usually extend above and below the bodies, presumably to be consistent with the concept of candles. Others call them shadows. Since all of us are constantly looking for reversal bars and reversal bars look more like tadpoles or small fish, a tail is a more accurate descriptive term. You should only think of bars in terms of price action and not a collection of meaningless and misleading candle names, misleading to the extent that they convey imagery of a mystical power. Each bar or candle is only important in relation to price action, and the vast majority of candle patterns are not helpful most of the time because they occur in price action, where they have no high probability predictive value. Therefore, it will complicate your trading by giving you too much to think about, and they take your mind off the trend. Figure 1.4 shows a break above the bear trend line, and then a two-legged sell-off to a lower low below yesterday's low. The first leg was completed by the Roman 3 ending at bar 2. Bar 3 was a strong bull reversal bar that reversed both yesterday's low and a test of the bear trend line, setting up a possible long. A buy stop at one tick above this bar would have been filled, and then bar 3 becomes a signal bar instead of just a setup bar, and the bar in which the trade was entered becomes the entry bar. Bar 4 is an entry bar off of an Roman 2 setup for a second leg up. Bar 5 is an entry bar off of an inside bar breakout pullback. The market barely broke above the bar 2 Roman 3. The bodies of the two pause bars are each inside bodies, so this setup effectively was the same as in Roman 2 pattern. Bars 4 and 5 are also high 1 longs. Signal bars, reversal bars. The market can trend up or down after any bar, and therefore every bar is a setup bar. A setup bar becomes a signal bar only if a trade is entered on the next bar, the entry bar. A setup bar in and of itself is not a reason to enter a trade. It has to be viewed in relation to the bars before it, and it can only lead to a trade if it is part of a continuation or reversal pattern. Since it is always wisest to be trading with the trend, a trade is most likely to succeed if the signal bar is a strong trend bar in the direction of the trade. Even though you are entering after only a one-bar trend, you're expecting more trending in your direction. Waiting to enter on a stop beyond the signal bar requires the market to be going even more in your direction, increasing your odds of success. However, a trend bar that is in the opposite direction can also be a reasonable signal bar, depending on other price action on the chart. In general, signal bars that are doji bars or trend bars in the opposite direction of your trade have a greater chance of failure since the side of the market that you need to be in control has not yet asserted itself. It is always better to get into a market after the correct side, bulls or bears, have taken control of at least the signal bar. That trend bar will give traders much more confidence to enter, use looser stops, and trade more volume, all of which increase the chances that their scalper's target will be reached. However, a doji bar can be an excellent signal bar, depending on context. The best-known signal bar is the reversal bar, and the best bull reversal bars have more than one of the following: an open near or below the close of the prior bar and a close above the open, and above the prior bar's close. A lower tail that is about 1/3 to 1/2 the height of the bar, and a small or non-existent upper tail. Not much overlap with the prior bar or bars. The best bear reversal bars have an open near or above the close of the prior bar and a close below the open and below the prior bar's close. An upper tail that is about 1/3 to 1/2 the height of the bar and a small or non-existent lower tail. Not much overlap with the prior bar or bars. Reversal bars can have characteristics that indicate strength. The most familiar bull reversal bar has a bull body, it closes well above its open, and a moderate tail at the bottom. This indicates that the market traded down and then rallied into the close of the bar, showing that the bulls won the bar and were aggressive right up to the final tick. A reversal bar alone is not enough of a reason to take a trade. It has to be viewed in the context of the prior price action. When considering a counter-trend trade in a strong trend, you must wait for a trend line to be broken and then a strong reversal bar to form on the test of the extreme, or else the chances of a profitable trade are too small. Also, do not enter on a minute reversal bar since the majority of them fail and become with trend setups. The loss might be small, but if you lose 4 ticks on 5 trades, you will never get back to being profitable on the day. You will bleed to death from 1,000 paper cuts. Why is that test of the extreme important? For example, at the end of a bear market, buyers took control and the market rallied. When the market comes back down to the area of that final low, it is testing to see whether the buyers will again aggressively come in around that price, or if they will be overwhelmed by sellers who are trying again to push prices below that earlier low. If the sellers fail on this second attempt to drive the market down, it will likely go up, at least for a while. Whenever the market tries to do something twice and fails, it usually then tries the opposite. This is why double tops and bottoms work, and why traders will not develop conviction in a reversal until the old trend extreme was tested. If a reversal bar largely overlaps one or more of the prior bars, or if the tail extends beyond the prior bars by only a couple of ticks, it might just be part of a trading range. If so, there is nothing to reverse because the market is sideways and not trending. In this case, it should not be used as a signal bar, and it even might come into a setup in the opposite direction if enough traders are trapped. Even if the bar has the shape of a perfect bull reversal bar, since no bears were trapped, there will likely be no follow-through buying, and a new long will spend several bars hoping that the market will come back to his entry price so he can get out at break-even. This is pent-up selling pressure. If the body is tiny so that the bar is a doji, but the bar is large, it should not be used as a basis for a trade. A large doji is basically a one-bar trading range, and it is not wise to buy at the top of a trading range in a bear or sell the low of a trading range in a bull. It is better to wait for a second signal. If a bull reversal bar has a large tail at the top, or a bear reversal bar has a large tail at the bottom, the countertrend traders lost conviction going into the close of the bar. And the countertrend trade should only be taken if the body looks reasonably strong and the price action is supportive, like a second entry. If the reversal bar is much smaller than the last several bars, especially if it has a small body, it lacks countertrend strength and is a riskier signal bar. However, if the bar has a strong body and is in the right context, the risk of the trade is small, one tick beyond the other side of the small bar. In a strong trend, it is common to see a reversal bar forming and then seconds before the bar closes, the reversal fails. For example, in a bear, you could see a strong bull reversal bar with a big down tail. A last price the bar hasn't closed yet well above its open and above the close of the prior bar, and the low of the bar overshooting a bear trend channel line. But then in the final few seconds before the bar closes, the price collapses and the bar closes on its low. Instead of a bull reversal bar off the trend channel line overshoot, the market formed a strong bear trend bar, and all of the traders who entered early in anticipation of a strong bull reversal are now trapped and will help drive the market down further as they are forced to cover at a loss. A big bull reversal bar with a small body also has to be considered in the context of the prior price action. The large lower tail indicates that the selling was rejected and the buyers controlled the bar. However, if the bar overlaps the prior bar or bats excessively, then it might just represent a trading range on a smaller time frame, and the close at the top of the bar might simply be a close near the top of the range, destined to be followed by more selling as the I-minute bulls take profit. In this situation, you need additional price action before entering a countertrend trade. You don't want to be buying at the top of a flag in a bear or selling at the bottom of a bull flag. In Figure 1.5, reversal bar 1 largely overlaps the 4 prior bars, indicating a two-sided market, so there was nothing to reverse. This is not a long setup bar. Reversal bar 2 is an excellent bear signal bar because it reverses the breakout of reversal bar 1. There are trapped longs here off that bull reversal bar breakout, and it also reverses a breakout above the bear trendline down from the high of the day. The trapped longs will be forced to reverse to sellers as they exit. When the market is in a trading range in a downswing, it is forming a bear flag. Smart traders will look to sell near the high, and they would only buy near the low if the setup was strong. As trite as the saying is, buy low, sell high remains one of the best guiding principles for traders. Reversal bars with big tails and small bodies must be evaluated in the context of the prior price action. Reversal bar 1, in figure 1.6, was a breakout below a prior major swing low in a very oversold market. It reversed up from a breakout below the steep trend channel line of the prior 8 bars. Profit takers would want to cover their shorts and wait for the excess to be worked off with time and price before they would be eager to sell again. It was a doji bar and therefore a possible bear flag, and traders need a second signal before going long. 2 bars later, the market broke below a small bar, a 1-bar bear flag, but this bear breakout failed on the next bar, trapping shorts and giving longs the second signal that they need for at least a scalp up. Reversal bar 2 overlapped about 50% of the prior bar and several of the bars before it, and it did not spike below a prior low. It likely just represents a trading range on the I-minute chart, and no trades should be taken until more price action unfolds. Although a classic reversal bar is one of the most reliable signal bars, most reversals occur in their absence. There are many other bar patterns that yield reliable signals. In almost all cases, the signal bar is stronger if it is a trend bar in the direction of your trade. For example, if you are looking to buy a possible bear reversal, the odds of a successful trade are significantly increased if the signal bar has a close well above its open. Signal bars, other types. Remember, a signal bar is a setup bar that led to an entry. However, not all trades are worth taking, and just because a stop was triggered and turned the prior bar into a signal bar, that does not make the trade worthwhile. For example, many signals in barbed wire are best avoided. All signal bars are meaningless in the absence of price action that indicates that a reversal, trend reversal, or reversal at the end of a pullback is likely. Besides a classic reversal bar, other common signal bars, some are 2-bar patterns, include small bars inside bar. Roman 2 or Roman 3 pattern, 2 or 3 increasingly smaller inside bars in a row. Small bar near the high or low of a big bar, trend bar or outside bar. Or trading range, especially if there is a body in the direction of your trade indicating that your side has taken control. Note that doji bars are rarely good signal bars because they are 1-bar trading ranges, and when the market is in a trading range, you should not be looking to buy above the high or go short below the low. They can be decent signal bars if they occur near the high or low of a trading range day, or if they are a with trend setup in a strong trend. In a trading range, it can be fine to sell below a doji if the doji is at the high of the range, especially if it is a second entry. The bigger trading range trumps the tiny trading range represented by the doji bar, so selling below the doji bar is also selling at the top of a large trading range, which is usually a good trade. Other types of signal bars, outside bar, see next section. Double bottom twin, consecutive bars in a strong bear with identical lows and preferably small or non-existent bottom tails, a type of bear flag. Double top twin, consecutive bars in a strong bull with identical highs and preferably small or non-existent top tails, a type of bull flag. Opposite twins, up-down twin top and down-up twin bottom, consecutive trend bars in opposite directions with small tails and nearly identical highs and lows. Reversal bar failure, for instance, buy above a bear reversal bar in a strong bull. Shaved bar, no tail at one or both of its extremes in a strong trend. Exhaustion bar, huge trend bar. There are many types of small bars and many different situations in which they occur, and all represent a lack of enthusiasm from both the bulls and bears. Each has to be evaluated in context. A small bar is a much better setup if it has a body in the direction of your trade, a small reversal bar, indicating that your side owns the bar. If the small bar has no body, it is usually better to wait for a second entry, since the probability of a successful trade is much less, and the chance of a whipsaw is too great. An inside bar does not have to be totally inside, high below the prior bar's high and a low above the prior bar's low. One or both of its extremes can be identical to that of the prior bar. In general, it forms a more reliable signal when it is a small bar and when its close is in the direction of the trade you want to take. It is always better to have bull setup bars when you are looking to buy and bear bars when you are looking to sell. When an inside bar occurs after a big trend breakout bar, it could be simply a pause by the trend traders or a loss of conviction that will lead to a reversal, failed breakout. A reversal is more likely when the small bar is an inside bar, and if it is a trend bar in the opposite direction of the large breakout bar. A with trend inside bar increases the chance that the breakout move will continue, especially if the market had been trending in that direction earlier in the day. For example, if this might be the start of the second leg that you were expecting. Small inside bars after breakout trend bars are somewhat emotional because a trader will consider entering in either direction on a stop and will have to process a lot of information quickly. For example, if there is a bull breakout during a down day, he will often place an order to buy at one tick above the high of the inside bar and a second order to sell at one tick below its low. Once one order is filled, the other order becomes the protective stop. If he was filled on a breakout failure, that is, on the sell order, he should consider doubling the size of the buy stop order in case the failed breakout becomes a breakout pullback. A failed failure is usually a reliable trade. On the other hand, if he was first filled on the buy with trend order, he usually should not reverse on his protective stop, but he might if the day had been a bear trend day. Once there has been a second or third bar without a failure that then occurs has a higher chance of simply setting up a breakout pullback entry rather than a tradable failure. In general, good traders make quick subjective decisions based on many subtle factors, and if the process feels too confusing or emotional, it is better to not place an order, especially complicated orders like a pair of breakout orders or an order to reverse. A trader cannot invest too much emotion in a confusing trade because he will likely be less ready to take a clear trade that may soon follow. An inside bar after a swing move might mark the end of the swing, especially if its close is against the trend and other factors are in play, like a trend line, trend channel line overshoot, a high or low two, or a new swing high in a trading range. Also, any small bar, whether or not it is an inside bar, near an extreme of any large bar, trend bar, doji, or outside bar can set up a reversal, especially if the small bar is a small reversal bar. In general, traders should be looking to buy low and sell high. In a trading range day, or a trading range in a trend day, the only small bar entries should be fades at the extremes. For example, if a small bar is a swing high or follows a bear trendline test or bull trend channel line overshoot and reversal, only look for a short entry. If it is a swing low, only look for a buy. In a trend, even one during a trading range day, a small bar can set up an entry in either direction. For example, if there is a strong bull move and no prior bull trendline break, an inside bar near the high of a large bull trend bar or a small bar that extends above the high of the trend bar should only be viewed as a buy setup. If it is an inside bar, especially if it is a bull trend bar, it is a great long setup. If it is simply a small bar that extends above the high of the bull trend bar, it might be a safe long setup if the trend is strong enough. In general, it would be better to wait for a pullback, unless the small bar was a bear reversal bar, in which case it could trap bears, and it might make sense to buy on a stop at one tick above its high. And Roman 2 pattern is an inside bar that follows a larger inside bar. It is two in a row with the second being inside the first and of the same size or smaller, and Roman 3 is even stronger with 3 in a row. After a protracted move, especially if there has been a trendline break, a with trend breakout from a 2 pattern is often just a scalp and has a good chance of reversing before or after the profit target is reached, a failed final flag. However, a countertrend breakout or a reversal from a failed final flag often leads to a large reversal. The pattern often develops in a final flag because it finally indicates balance between the bulls and the bears. The strength of the weaker side has caught up to that of the stronger side, at least temporarily. As such, if the with trend side takes control, the odds are high that the countertrend side will try to take it back after the with trend breakout. Stop on a Roman 2 pattern is beyond the opposite side of both bars, not just the second bar, which technically is the signal bar. But sometimes you can use a smaller stop, beyond the second of the 2 bars instead of beyond both bars if the bars are relatively large. After the entry bar closes, tighten the stop, and consider reversing at one tick beyond the entry bar. Keep looking to reverse on any failure in the next several bars, since failures are common soon after Roman 2 breakouts, especially if the pattern forms in the middle of the day's range. A 5-minute Roman 2 pattern is often a 1-minute double bottom-top pullback, which is a reversal pattern, and might explain why a small 2 can lead to a large countertrend move. When there is a strong bull, there will sometimes be 2 consecutive bars with identical highs, and usually with small tails at the tops of the 2 bars. This is a double top twin buy setup and is a double top on the 1-minute chart. Place a stop to go long at 1 tick above the high of the bars because you will be buying a failed double top, and there will be protective stops there from traders who shorted it, adding fuel to the move. Likewise, in a strong bear, look to short on a stop at 1 tick below a double bottom twin sell setup. Up-down and a down-up twin setups go by several names, and each is an overlapping pair of trend bars with opposite directions and bodies of about the same size, opposite twins. In an up-down setup, the first bar is a bull trend bar, and the second is a bear trend bar, and this combination is a sell setup if the market is not in a trading range. A down-up twin is a bear trend bar and then a bull trend bar and forms a buy setup. They are each basically a 2-bar reversal pattern, and they correspond to a 10-minute reversal bar. Just imagine how the 2 5-minute bars would look when combined into a single LO-minute bar. When a trend bar in a strong trend has a shaved body, no tail at one or both ends, it indicates that the market is one-sided and strong. However, a shaved top on a 5-minute bull trend bar in a runaway bull is stronger than a shaved bottom, because the extreme strength is right into the close of the bar, and it is more likely to continue than strength that occurred 5 minutes earlier. Therefore, a shaved top is a good setup for a long, but it is often impossible to place a buy-stop order because the next bar will already be above the high before you can place your order. If the bar has a 1-tick tail at its high or a shaved bottom, it is still strong, but in general, that alone would not be reason enough to buy above its high. Also, the bar has to be analyzed in context. If the bar is in a trading range, it would be foolish to buy above its high because trading ranges tend to test the extremes repeatedly, and you should not be buying near the high when the odds of the bar being a test are greater than the odds of the bar being a successful breakout. Similarly, a bear trend bar with a shaved bottom in a runaway bear is a setup to short at 1 tick below its low. Not all small bars are good fade setups. There is one particular situation where they should not be used as signal bars, and that is when the bar is a small doji, small, relative to the recent bars. Especially if there is no body, it is near the EMA and occurring approximately between 9 a.m. and 1100 a.m. PST in a Barb wire pattern. These have a very high failure rate and always require more price action before placing a trade. Although most large trend bars that are with trend in a trend are strong, if a bar is unusually large, it often represents a climactic exhaustion. For example, in a bull, it often means that the last buyers bought. If there are no more buyers, the market will go down. Any standard reversal setup can serve as a signal bar, but a second entry with a strong reversal bar is always the safest setup when trading countertrend. Big trend bars on breakouts often fail on the next bar, trapping traders into the wrong side of the market. This is especially common on quiet trading range days. In a trend, a small bar on a pullback is only a with-trend setup. In Figure 1.7, bars 1, 2, 4, and 6 were small bars in pullbacks, and the only trade they offer is a short on a stop at 1 tick below the low. Even though they are mostly doji bars, they are with trend and therefore reasonable shorts. A small bar can also set up a countertrend trade in a trend if it occurs at a swing low, and there are other reasons for trading countertrend, like a prior trendline break. Bar 3 was a swing low, a reversal up from a low 2 short, and the second leg down of a second leg down, making it a high 4 long setup. Bar 5 was a high 2 after a strong move up to bar 4, it broke a trend line, making a second leg up likely. It was also at the low of a trading range. The only time that you would sell a small bar at a low is in a bear. Bar 8 is not particularly small, but it was an inside bar which functions like a small bar, and it was a bear trend bar, making it a safe short at the low of the day. It was also a breakout pullback short setup and a micro trend line, low 1 short. In Figure 1.8, bar 1 is a failed bear reversal bar long setup in GS. The small bear reversal bar formed after the large bull trend bar broke out of a trading range on a bull trend day. Most bars are above the rising EMA. Early shorts entered on the reversal bar before it triggered a short signal. The next bar did not trade one tick below its low, and these overly eager shorts were now trapped. There was likely a 1-minute reversal pattern that trapped shorts into one of the many small losing 1-minute countertrend trades that occur all day long in strong trends and just eat away at your account, small piece by small piece. They would exit at one tick above the bear reversal bar, which is where and why smart traders went long. A reversal bar alone is not enough reason to enter, even if it is in an area where a reversal might reasonably take place. Here, it appeared to be setting up a failed trading range breakout, but the short entry below the bar was never triggered, and it therefore set up an entry in the opposite direction. In Figure 1.9, Bar 3 is a huge trend bar that collapsed below the low of the open and through a bear trend channel line, and was followed by a bull inside bar with a shaved top, meaning that buyers were aggressively buying it right into its close. This is a great setup for at least a two-legged rally. It was also the bottom of a spike and channel bear trend, and the reversal should test the bar 2 start of the channel, which it did. The failed bar 4 reversal bar was a great long entry on the bar 5 outside bar in this strong bull, a failed low 2 top in a strong bull. The low 2 trapped naive traders who sold under the reversal bar, but they failed to wait for a prior demonstration of bearish strength. You cannot sell in a strong bull if there has not been a prior bull trendline break. Note that none of the dojis before and after bar 1 are good signal bars because they are in the middle of the day's range and next to a fiat EMA. In Figure 1.10, POT gapped below yesterday's low and reversed up beyond the EMA. The market yesterday broke a few bear trend lines, indicating that there was a reasonable chance for a tradable long if there is a good buy setup and a good signal bar. Both are needed. Bar 3 was a clear long, reversing up from below yesterday's low with a strong bull reversal bar. The rally up from bar 2 broke the bear trend line of the prior hour or so. The line is not shown. The bar 4 EMA gap bar short was followed by a possible high 2 long at bar 6, except that there was no signal bar. Bar 5 was a bear trend bar and not a bull signal bar, which is needed when you are buying in a bear trend. The trend line from bars 4 to 6 allowed for the creation of the trend channel line attached to the bar 5 low. Bar 7 took out the high of the prior bar, but that bar had a bear close. A pullback after a probe below a trend channel line is not reason enough to buy. You need a bull signal bar. Bar 8 was a small bull inside bar after a larger bull inside bar, and that bar followed a second probe below the trend channel line. This might also be a higher low test of the bar 3 low of the bear trend. The rally to bar 4 broke all bear trend lines, so you should be looking to buy a test of the bar 3 low, and the bar 8 Roman 2 bull inside bar was a great long setup. An aggressive trader could have bought the double bottom pullback reversal in GS above the bar 5, Roman 2 in Figure 1.11, but there was not yet a trendline break in the small bear down from bar 4. There was a second entry above the bar 6 Roman 2 setup. This flag drifted far enough to break a small trend line down from bar 4, plus it was a second entry. Bar 7 set up a third entry on the failed failure. The market failed on the upside breakout, and this failed on the downside on the next bar, which is a very reliable breakout pullback long setup and a micro trendline high 1 buy. Double bottom pullbacks have a pullback that typically extends more than 50% and often almost the entire way to the double bottom. This double bottom was exact to the tick. Higher low often forms a rounded bottom, and traditional stock traders would describe it as an area of accumulation. The name is irrelevant. What is important is that the market failed to put in a lower low on this second attempt down. Bar 3 was the first, so if it can't go down, the bears will step aside, and the market will probe up in search of sellers willing to sell at a higher price. Instead of finding sellers, the market found buyers willing to buy at the higher price. The bar 2 signal bar in Figure 1.12 was a tiny bar 11 cents in a $185 stock, but if you look at a line chart of the closes, the small higher low was clear at 0.2. A high 2 from 2 bars earlier did not have a good prior trendline break, so it was not an ideal lower low failed final flag long entry. Bar 2 is a second entry and a small higher low, which is a good setup with minimal risk. Also, it is almost in Roman 2 pattern, and close is close enough in trading. High 1 at bar 1 was not a good entry since there was no bull trend bar, which is needed to reverse a strong bear. Also, it followed 5 bear bodies, so there was not yet any up momentum prior to the setup, and this is always needed when looking to buy a bear. On the 5-minute chart on the right of figure 1.13, there were 2 Roman 2 patterns. The first is in Roman 3. As you can see from the 1-minute chart on the left, the first one was a double bottom pullback by pattern, and the second was a failed low 2. In both cases, the bull trend bar at the end of the Roman 2 was a great setup for a long entry. Even though small bars have less directional significance, it is always better to have the final one being a trend bar in the direction of your intended entry. In figure 1.14, bar 1 was a double bottom twin setup, consecutive bars with identical lows in a strong bear. Sell at 1 tick below its low. You could also sell below the 2-bar breakout pullback setup on the next bar, giving you an earlier entry. This was also a micro trendline low 1 short. Bar 2 was another example. Bar 3 was a double top twin setup for a long trade, and it was also a micro trendline long, a high 1. LEH had a down-up twin bar reversal on a test of the bear trend channel line in figure 1.15. The sell-off was climactic because it was unsustainable behavior. 16 of the prior 17 bars all had a high that was below the high of the bar before. A climax is usually followed by a 2-legged correction that lasts for many bars, at least an hour on a 5-minute chart. In figure 1.16, bar 4 was an up-down twin bar reversal on a break above yesterday's high and a bull trend channel line, and after the breakout of a small flag, bar 3. Bar 1 was not a good down-up twin by setup, because there was too much down momentum in the prior 2 bear trend bars on their breakout from the lower high. It was followed by another down-up twin by setup. Back-to-back happens occasionally, but 4 overlapping bars is a bear flag, and you cannot buy at the top of a trading range in a bear. These patterns are only countertrend signals if there is a reason to expect a reversal. The first pause after a strong breakout is a breakout pullback, and it is usually followed by more trending. Bar 2 was a good short because there were trapped bulls who bought above the back-to-back down-up twin reversals, and because it ended a 2-legged pullback to the EMA in a bear. The 2 up legs were the 2 bull trend bars separated by a bear trend bar and the bear flag. Bar 2 resembles the second bar of an up-down twin cell setup, but its close and low were too far below the low of the prior bar. Besides, traders were already short before the close of the bar, based on the bear M2S, low 2 short at the moving average. A bar with no tail at either end in the middle of a strong trend is a sign of strength, and traders should enter with trend on its breakout. In figure 1.17, bar 1 had no tail at both its high and low, indicating severe selling pressure. They sold it from start to finish, so it was likely that there would be more selling to come. Traders have to be fast in placing their sell-stop orders because the market is moving fast. Bar 2 had a shaved top in a bear, but since the market was not in free fall at this point, that was not the reason for a short. However, it was a short entry based on taking out the low of a small inside bar in a bear, a low 1. Bar 3 was a bull trend bar with a shaved top and bottom, but it was not in a bull trend, and therefore it does not function as a buy setup. However, there was still a buy on the next bar because it was a high 2, and a down-up twin reversal at a lower low, which was also a failed breakout of a trading range. The first EMA pullback broke the bear trend line, so the move down to bar 3 was a 2-legged lower low, which is usually good for at least a scalp. Bars 4 and 5 were not shaved bar sell setups because they were not in a free fall bear. Apple demonstrates many common signal bars on this 5-minute chart, figure 1.18. Bar 1 is a doji with a tiny body and was the third overlapping bar barbed wire. It would be foolish to buy above its high because you would be buying the top of a bear flag barbed wire below the EMA, despite the tempting doji bar that will make many candle worshippers enter into a bad long trade. Bar 2 was a good reversal bar with a long tail that went far below the low of the prior bar and reversed up, and it had a decent size bull body. The tail at the top showed some weakness, but this was erased by the trend bars that followed it. It was a high 2 long opening reversal at a new swing low, and a trend channel line breakout, not shown, but it could be drawn across the lows of the prior 3 bars. Bar 3 was an outside-up bar and a microtrend line long after a pause bar that followed the breakout to a new high of the day. Outside bars in new trends often trap traders out of great trades because they happen so quickly. Many traders don't have enough time to reverse their perspective fast enough from bearish to bullish, and then they have to chase the market up. Bar 4 was a bear doji at a new high, but the up momentum is so strong and the reversal bar was so weak that a short could be considered only on a second entry. Bar 5 was a bull outside-up bar that tested the EMA and the breakout from the opening range, and it was the first pullback in a strong up move, and a high one long. Bar 6 was a relatively small bear reversal bar and a second entry short after taking out the bar 4 swing high in yesterday's high. It was also the second leg up from the bar 5 first pullback, and from the bar 2 low, and second legs are often reversals. Also, it was a low 4 and a wedge-shaped 3 pushes up from the bar 3 low that started the bull breakout above the opening range. With this many factors operating, a trader should expect at least 2 legs down. Bar 7 was in Roman 2 short at a time when you were expecting 2 legs down and more of a test of the EMA than what happened on the prior test at bar 5. It was a small piece of barbed wire, but the risk was small. The bar after the small entry bar extended above the entry bar but not above either of the Roman 2 bars where the protective stop would be. Normally, you would tighten the protective stop after the entry bar closes, but when the entry bar is small and it only ran for a few cents, you should give it more room and risk to beyond the high of the Roman 2 bars. This is barbed wire and it is prone to run stops, so if you are going to take the short, you have to give it a little room. The Roman 2 breakout reverses back up a couple bars later, which is expected when in Roman 2 is in the middle of the day's range. Also, the market completed its goals of 2 legs down and a penetration of the EMA. The traders who went long on the high 2 above bar 7 were immediately trapped by the large outside down bar, and astute traders would go short below the bar 7 low. The new longs who were trapped and panicked would sell out their losing longs below bar 7, creating a high probability short. Bar 8 was a lower high second entry short after 2 legs up and a trendline break, the pullback from bar 6. This is a possible trend reversal, and you have to take it seriously. Even though it is a doji, which is a 1-bar trading range and you should not be shorting below a trading range, it is at the top of a large trading range and it is a second entry. Also, back-to-back dojis and 3 sideways bars in a row at a possible turning point is similar to an Roman 2 pattern 2 bars with small bodies, and therefore become an acceptable short setup. R9 was a down-up twin bar reversal, which, if you think about it, is a reversal bar on a 10-minute chart, after a new swing low and test of the bar 5 low, an attempt to form a double bottom bull flag. It is also a second leg down from the bar 6 high. Bar 10 is a breakout pullback and a double bottom twin short, which is a pair of consecutive bars with the same low in a strong bear. Bar 11 is a bull reversal bar after a third pushdown, but the prior bar was a big doji, and bar 11 had a large bear tail and small body, and it largely overlapped the 2 prior bars. This is not a strong reversal, but does show some sign of bullish strength. The odds of a trading range are greater than the odds of a significant reversal. R1 in figure 1.19 is a break below a bull reversal bar failed reversal bar in a strong bear, and is a great short because the early bulls who bought will be trapped and forced to sell at 1 or more ticks below its low. A doji is a 1-bar trading range, and selling below a small bar at the top of a trading range is always a good trade, especially in a strong bear, as was the case with bars 2 and 3, both of which followed large dojis. Bar 3 was also a low 2 in a bear. Bar 1, in figure 1.20, is a down-up twin by reversal after taking out the low of the open, and it was a higher low. Bar 2 is a small bear reversal bar at the high of a large bull trend bar, and it tested the EMA. Failed to reverse the market, and set up a buy at 1 tick above its high for a second leg up. It marked the end of the 1-bar first leg. Bar 3 was in bear inside bar after a break of a bull trend channel line in yesterday's high, setting up a short of the wedge. Bar 4 was a doji bar after 2 other dojis, and a bar with a tiny body is not a good setup bar when the lows, highs, and closes are trending up. Needed second entry setup, Karn 2 bars later, completing the lower high that followed a trendline break. Bar 5 is a one-tick failed breakout of the top of Enroman 2, setting up a failed final flag, which was reversed by the Bar 6 reversal bar. This also reversed a breakout to a new low of the day, and formed a double bottom bull flag with Bar 1, and it was a 5-tick failed breakout. Bar 7 was a doji bar that set up M2B, a high 2 above the EMA, and a higher low long after the bull leg from Bar 6. Even though it had a small body, it was a second entry and was with trend. Bar 8 was an inside bear trend bar that was the end of the second leg up and a test of the high of the day. It also was after a trend channel line breakout. However, the momentum up from Bar 7 was strong, so it is better to wait for a second entry, which came with the Bar 10 outside down bar and failed bull reversal bar. The move up from Bar 7 was strong, so many longs bought the small, especially compared to the two bear trend bars that came before it. Bull reversal bar, Bar 9 was a high one, but were immediately trapped by the Bar 10 outside bar down. The bears seized control of the market, so there should be two legs down from here. An outside bar that traps traders usually leads to two more legs. Bar 11 was technically a high 3, but should be expected to behave like a high 2, since the Bar 10 outside bar bull trap should be considered the start of the downswing, not the Bar 6 actual swing high. Bar 11 was a bull inside Bar IOI and the second attempt to reverse the breakout below Bar 7, and it reversed the trendline break. It was an EMA gap 2 bar on a non-trend day and a high 2 after the Bar 10 bear outside bar that trapped longs. R1 in figure 1.21 was a big bull trend bar, but there was so much momentum leading up to it that only a second entry short Bar 2 could be considered. Bar 3 was a bear trend bar, but the next two bars were small doji bars, so there was no long setup. Small dojis are rarely ever good countertrend entry bars, and it is almost always better to wait for another setup. Bar 5 was a good bull reversal bar after a bear trend bar and a bear, and also 3 pushes down from the rally following the Bar 4 low. There was also a trend channel line breakout and reversal from the line that could be drawn starting at Bar 4. This was an acceptable long scalp. Bar 6 was a large bear trend bar with a big bottom tail after a collapse at the end of the bear. It was also an overshoot of several bear trend channel lines not shown. With 4 large bear trend bars in a row, only a second entry long can be considered, which came on the Bar 7 outside up bar. The Bar 7 low was a small higher low, which is the start of the second leg up. Bar 1 in figure 1.22 was a relatively small bar after a big bear trend bar broke out of a large flag, a failed breakout setup, and it was an exact test of the earlier low. On a trading range day with Bar 1 setting up these two reversals, it was a reasonable long setup. Bar 2 followed a large bull trend bar breakout of a tight trading range and formed a higher high 9 bars earlier. It was a bear reversal bar that set up a failed breakout short that led to a strong bear into the close. The market closed 30 points lower, but this is not shown because it would shrink this bull trend bar to the point of looking unremarkable instead of how it appeared in real time. Outside bars. If the high of the current bar is above the high of the previous bar and the low is below the low of the previous bar, then the current bar is an outside bar. Outside bars are complicated to read, and there are many subtleties in their analysis. The increased size of the bar means that bulls and bears are willing to be more aggressive, but if the close is near the middle, it is essentially a 1-bar long trading range. At other times, they can act as reversal bars or trend bars. Traders must pay attention to the context in which they occur. Traditional technical analysis teaches that outside bars are setup bars for a breakout in either direction, and you should put an entry stop above and below. Once filled, double the size of the unfilled stop and make it a reversal order. However, it is almost always unwise to enter on a breakout of a 5-minute outside bar, especially if the outside bar is large. A breakout of a 1-minute outside bar is often a good trade because of the greater risk that the distant stop entails. If for some rare reason you did enter on the breakout of an outside bar and the protective stop is too large, consider using a money stop, like 2 points in the E-mini, or trading fewer contracts. Since an outside bar is a 1-bar trading range and it is better to not buy at the top of a sideways market or sell below it, it is almost always imprudent to enter on a breakout of the bar. Sometimes you have to enter on an outside bar, not on its breakout, because you know that traders are trapped. This is especially true after a strong move. If an outside bar occurs as the second entry in a strong reversal from a trendline break or trend channel line overshoot, it can be an excellent entry bar. For example, if the market just sold off below a swing low for the second time and reversed up from a trend channel line overshoot, you are likely looking to buy, and you keep moving a buy-stop order to one tick above the prior bar's high until you get filled. Sometimes the fill will be on an outside-up bar. This is usually a good reversal trade, and it is due to strong buyers and not just anxious trading range traders getting in, and then quickly getting out in a panic, once they realized that they made the mistake of buying near the high of an outside bar in a trading range. If an outside bar is in the middle of a trading range, it is meaningless and should not be used to generate trades, unless it is followed by a small bar near the high or low of the outside bar, setting up a fade. An outside bar in a trading range just reaffirms what everyone already knows: that both sides are balanced, and both will sell near the top of the range and buy near the bottom, expecting a move toward the opposite end of the outside bar. If the market instead breaks out in the other direction, just let it go and look to fade a failed breakout of the outside bar, which commonly happens within a few bars. Otherwise, just wait for a pullback. A failed failure of the breakout becomes a breakout pullback. If the bar after the outside bar is an inside bar, then this is an IOI pattern inside, outside, inside, and can be a setup for an entry in the direction of the breakout of the inside bar. However, only take the entry if there is a reason to believe that the market could move far enough to hit your profit target. For example, if the IOI is at a new swing high, a downside breakout could be a good short since it is likely a second entry. The low of the outside bar will probably be the first entry. If it is in Barb wire, especially if the inside bar is large and in the center of the outside bar, it is usually better to wait for a stronger setup. When a with-trend outside bar occurs in the first leg of a trend reversal, and the prior trend was strong, it functions like a strong trend bar and not a trading range type of bar. It usually leads to two legs after the outside bar, because the outside bar is an attempted with trend entry that failed. Everyone suddenly agrees about the new direction, and therefore the move will have so much momentum and extend so far that it will likely get tested after a pullback, creating a second leg. The outside bar will act as the start of the trend rather than the actual old trend extreme. For example, if the beginning of the bar triggers a low 1 or low 2 short in a bear rally, but by the end of the bar has become an outside-up bar that ran the protective stops on the shorts and then closed on its high, this bar will have formed a higher low in the new bull. This failure puts everyone in agreement that the new trend is strong, and once everyone agrees, the first leg up will likely require a test in the form of a second leg up. This failure, and not the actual bear low, is the start of the up leg, so there should be 2 legs up from here. This will appear as 3 legs up on the chart, but functionally, it is 2 legs up from the outside bar low, which is the point where it became clear that the bulls seized control. Why is the move often strong? The low one enticed the old bears to short. Then the entry bar will quickly reverse to an outside bar up, trapping the bears in and trapping the bulls out. Invariably, the market will trend up hard for many more bars as everyone realizes that the market has reversed, and they are trying to figure out how to position themselves. The bears are hoping for a dip so they can exit with a smaller loss, and the bulls want the same dip so they can buy more with limited risk. When everyone wants the same thing, it will not happen because both sides will start buying even 2 or 3 tick pullbacks, preventing a 2 to 3 bar pullback from developing until the trend has gone very far. A smart price action trader will be aware of this possibility at the outset, and if she is looking for a 2-legged extended up move, she will watch the first low 1 and low 2 carefully and anticipate its failure. She will place her entry orders just above the high of the prior bar, even if it means entering on an outside bar up, especially if it is the entry bar for the shorts. The single most important thing to remember about outside bars is that whenever a trader is uncertain about what to do, the best decision is to wait for more price action to develop. A strong trend that goes sideways midday often has a second leg later in the day. This is a trend resumption move in figure 1.23. Note that outside bar breakouts in a strong trend usually result in a two-legged move. Bar 1 is an outside bar, and smart traders would have orders to go short at one tick below its low because the enthusiastic longs will exit there and not look to buy until more support develops. Bar 2 was the second leg down. The first leg was the high one outside bar 2 bars earlier. After a two-legged move from a breakout, the market will usually try to correct. Bar 5 was an outside down bar, but the market was basically sideways with lots of overlapping bars, so it is not a reliable setup for a breakout entry. The inside bar that followed it, IOI, was too large to use as a breakout signal, because you would be either selling at the bottom of a trading range or buying at the top, and you only want to buy low or sell high. Outside bars are tricky because both the bulls and bears were in control at some point during the bar, so the movement over the next few bars can have further reversals. Bar 1 in figure 1.24 is an outside bar that formed an inside-outside-inside IOI pattern. Bar 2 breakout of the inside bar following bar 1 failed, which is common. Bar 2 would have been a terrible long because the inside setup bar was too large and it would have forced the trader to buy near the high of the range. A small failure bar is a great entry because the risk is small. The short down from bar 2 broke below the outside bar, triggering longs to exit and resulting in two small legs down to bar 4. This was also a failure of the reversal up from the bear trend channel line. Bar 4 is almost an outside-up bar, and in trading, if something is almost a reliable pattern, it will likely yield the reliable result. Bar 4 was the second bull bar in the second leg, and the second attempt to reverse the low of the day, and so it was a great setup for a long. R5 is an outside bar followed by a small inside bar near its high. Again, this yields a great short with minimal risk. Once the market ran the stops below the outside bar, traders would expect two legs down because bulls were trapped into longs on the strong bull trend outside bar. This time, the two legs formed Dojis bars 8 and 9 and a small double bottom, which was not the down momentum that traders were expecting. This loss of down momentum was followed by the bar 10 double bottom pullback long and a failed low too short, so there are trapped shorts. Bar 9 was also a high too long on the pullback from the bull up from bar 4, forming a higher low on the day after a protracted rally following the break of the bear trendline. This high too is reason enough to buy. In figure 1.25 bar 2 was an outside bar up that trapped traders who shorted the low one. The next bar was a bear reversal bar at the high of the outside bar, setting up a great short fade. Even on days like this with a sideways open, the moves on the open are usually good enough to provide at least a scalper's profit. Trading the upside breakout of the bar 1 bear trend bar by the outside bar on a big gap down opening is a good bet, since the market will try to close the gap, and now you also have trapped bears. The odds of success were increased by the bar 2 entry bar breaking below the inside before breaking above. That downside move trapped more shorts since it was the second attempt down. The first bar of the day was the first attempt. The bar 4 outside bar was part of barbed wire, and the next bar was not a small bar that could be faded. In fact, it was an even larger outside bar, trapping both the longs and shorts who entered on the bar 4 outside bar as it broke above and below its prior bar. The bar after bar 5 was a great setup. It was a small bar near the low of the outside bar, making it a low-risk long. It was also a high 2 and a higher low. Bar 6 was a bear reversal bar and a low 2 bar near the high of an outside bar and a good short. Bar 7 broke to a swing high and reversed down as an outside bar. The next bar was a small bar near the low, but there was no reversal above its high, and so there was no long entry. 2 bars before bar 8 also tried to trigger the long, but they too failed to hit the entry stop above that small inside bar that followed bar 7. Even though this is barbed wire, it is a possible short after so many failed attempts to hit the buy stops. Also, a down move would create a second leg down from the bar 7 high, and this was a great day for second legs. Bar 8 was also something of a micro-trendline short. Sell-off to bar 3 in figure 1.26 broke a major trendline, alerting traders to short a test of the bar too high. Bar 3 was an outside bar that was a reversal bar and an entry bar. Bar 4 was a large bull trend bar climactic that formed a higher high, and it was followed by a strong bear inside bar that was the signal for the short. Traders were expecting two legs down from such a strong setup. Such, smart traders will be watching for the formation of a high 1 and then a high 2, and readying themselves to short more if these long setups fail and trap the bulls. Bar 5 was a short setup for a failed high 1, and bar 6 was a great bull trap. It was a failed high 2, and the long entry bar reversed into an outside bar down, trapping longs in and bears out. This outside bar acted like a bear trend bar and not just an outside bar. Because it is an outside bar, the entry bar and its failure happen within a minute or two of each other, not giving traders enough time to process the information. Within a bar or two, they realize that the market, in fact, has become a bear trend, and the longs are hoping for a 2 or 3 bar pullback to exit with a smaller loss, and the bears are hoping for the same rally to allow for a short entry with a smaller risk. What happens is that both sides start selling every 2 or 3 tick pullback, so a 2 or 3 bar rally does not come until the market has gone a long way. Note that the high 2 long was a terrible setup because 5 of the 6 prior bars were bear bars and the other bar was a doji. A high 2 alone is not a setup, especially after a climax top and possible major reversal down. There first has to be earlier strength, usually in the form of a high 1 leg that breaks a trend line, or at least an earlier strong bull trend bar. The importance of the close of the bar. A bar usually assumes something similar to its final appearance seconds to a minute or more before the bar closes. If you enter before the bar closes, you might occasionally make a tick or so more on your trade. However, once or twice every day, the signal that you thought was going to happen does not, and you will lose about 8 ticks. That means that you need about 8 early entries to work as planned for everyone that does not, and that simply won't happen. You can enter early with trend in a strong trend, and you will likely be fine. However, when there is a strong trend, you have so much confidence in the signal that there is no downside to waiting for the bar to close and then entering on a stop beyond the bar. You cannot be deciding on every bar if an early entry is appropriate because you have too many other important decisions to make. If you add that to your list of things to think about, you will likely end up missing many good trades every day and forego far more in missed opportunities than you could gain on an occasional early entry. This holds true for all time frames. For example, look at a daily chart, and you will see many bars that opened near the low but dosed in the middle. Each one of those bars was a strong bull trend bar with a last price on the high at some point during the day. If you bought under the assumption that the bar was going to dose on its high and bought near the high and instead it dosed in the middle, you would realize your mistake. You are carrying home a trade that you never would have entered at the end of the day. There are 2 common problems that regularly occur on the 5-minute chart. The most costly is when you try to pick a bottom in a strong trend. Typically, you will see a lower low after a trendline break, and traders will be hoping for a strong reversal bar, especially if there is also a bear trend channel line overshoot. The bar sets up nicely and is a strong bull reversal bar by the 3rd minute or so. Price is hanging near the high of the bar for a couple of minutes, attracting more and more counter-trend traders who want to get in early so that their stop will be smaller. Their stop will be below the bar. But then with 5 seconds remaining before the bar doses, the price collapses and the bar doses on its low. All of those early longs who were trying to risk a tick or 2 less end up losing 2 points or more. These longs let themselves get trapped into a bad trade. The other common problem is getting trapped out of a good trade. For example, if you just bought and your trade has had 3 to 5 ticks of open profit, but the market just can't hit 6, allowing you to scalp out with 4 ticks of profit, you start to become nervous. You look at the 3 or 5 minute chart with about 10 seconds before its bar doses, and it is a strong bear reversal bar. Then move your protective stop up to 1 tick below that bar, and just before the bar doses the market drops and hits your stop only to pop up several ticks in the final 2 seconds of the bar. Then, within the first 30 seconds of the next bar, the market quickly goes up to 6 ticks where smart traders took partial profits while you are sitting on the sidelines. Good entry, good plan, bad discipline. You just let yourself get trapped out of a good trade. If you had followed your plan and relied on your initial stop until the entry bar dosed, you would have secured your profit. There is one other point about bar doses. Pay very dose attention to the dose of every bar, especially for the entry bar and the bar or 2 later. If the entry bar is 6 ticks tall, you would much prefer seeing the body suddenly increase from a 2-tick trend bar to a 4-tick trend bar in the final seconds of the bar. You will then likely reduce the number of contracts that you will scalp out. This is true for the next couple of bars as well. If there are strong closes, you should be more willing to swing more contracts and hold them for more points than if these bars had weak closes. The 5-minute E-mini in figure 1.27 has been in a strong bear for weeks, and it is now starting to have bigger pullbacks, and each new lower low is being bought, leading to profitable countertrend trades. The bulls are more confident, and the bears are becoming more willing to take profits. The thumbnail on the left is a 3-minute chart, and the one on the right is a close-up of the 5-minute chart. Bar 5 broke above a trend line, and bar 8 exceeded another by a fraction of a tick. Bar 10 was in Roman 2, and if you look at the bodies alone, it was in Roman 4, 4 inside bars in a row, each smaller than the prior, which could lead to a great failed final flag, and then a two-legged rally and probably a gap bar above the EMA. It happened at bar 12, which will likely be exceeded after a pullback to a higher low, maybe the bar 13 test of the trend line. Bar 11 was a strong bull reversal bar, and a second attempt to reverse up from a lower low. The Roman 4 was the first. This is a very high probability long, but the stop would have to be beneath its low, 3 points below the entry price. This is more than what is typically required in the E-mini. Normally 2 points works for most trades, but that is what the price action shows is needed. If you are nervous, just trade half size, but you must take a strong setup like this one and plan on swinging half. This is a perfect example of a common problem that traders face when they try to reduce risk by watching a smaller time frame chart. There was also a 3-minute reversal bar at bar 11, but the stop below the entry bar was hit by a bear trend bar with shaved tops and bottoms, indicating very strong sellers. At this point, it would be very difficult to reconcile that with the 5-minute chart where the stop had not been hit. The large size of the stop required on the 5-minute chart would make traders more willing to exit early and take a loss. If a trader was also watching the 3-minute chart, he almost certainly would have exited with a loss, and he would have been trapped out of the market by that strong bear trend bar. The next bar on the 3-minute chart was a very strong outside bull trend bar, indicating that the bulls were violently asserting themselves in creating a higher low. But most of the weak hands who were stopped out would likely be so scared that they would not take the entry and instead wait for a pullback. Stop runs on the 3-minute chart are very common at important reversals, and smart traders look at them as great opportunities because they trap weak longs out of the market, forcing them to chase the market up. It is always better to just watch and trade off one chart, because sometimes things happen too quickly for a trader to think fast enough to place his orders if he is watching 2 charts and trying to reconcile the inconsistencies. Exchange-traded funds, ETFs, and inverse charts. Sometimes the price action becomes clearer if you change something about the chart. You can switch to a bar or line chart or a chart based on volume or ticks, or a higher or lower time frame, or simply print the chart. Several ETFs are also helpful. For example, the SPY is almost identical in appearance to the E-mini chart and sometimes has clearer price action. Also, it can be helpful to consider the chart from an opposite perspective. If you are seeing a bull flag but something doesn't seem quite right, consider looking at the SDS, which is an ETF that is based on the inverse of the SPY, but with twice the leverage. If you look at it, you might discover that the bull flag that you were seeing on the E-mini and SPY might now look like a rounding bottom on the SDS. If it does, you would be wise not to buy the E-mini flag and instead wait for more price action to unfold, like waiting for the breakout and then shorting if it fails. Sometimes patterns are clearer on other stock index futures, like the E-mini Nasdaq 100 or its ETF, the QQQQ, or its double inverse, the KID. But it is usually not worth looking at these, and it is better to stick with the E-mini and sometimes the SDS. Top chart of the E-mini in figure 1.28 is essentially identical to that of the SPY in the middle chart, but the price action on the SPY is sometimes easier to read. The bottom chart is the SDS, which is an ETF that is the inverse of the SPY with twice the leverage. Sometimes the SDS chart will make you reconsider your read of the E-mini chart. Second entries. Bottoms on the daily chart usually require a second reversal off the low to convince enough traders to trade the market as a possible new bull. This second entry is almost always more likely to result in a profitable trade than is a first entry. The sellers are making a second attempt to drive the price down, and if the market fails in 2 attempts to do something, it usually will attempt to do the opposite. If the second entry on any time frame is letting you in at a better price than the first, be suspicious that it might be a trap. Most good second entries are at the same price or worse. A second entry trader is someone entering late, trying to minimize risk, and the market usually makes you pay a little more for that additional information. If it is charging you less, it might be setting you up to steal your money in a failed high/low too. Traders looking for second entries are more aggressive and confident, and will often enter on smaller time frame charts. This usually results in traders on the 5-minute charts entering after many other traders have already entered, making the entry a little worse. If the market is letting you in at a better price, you should suspect that you are missing something and consider not taking the trade. Most of the time, a good fill equals a bad trade, and a bad fill equals a good trade. If you are fading a move, buying a pullback in a bull, for example, and the move had about 4 strong trend bars or 2 or 3 large trend bars, there is too much momentum for you to be placing an order in the opposite direction. It is better to wait for an entry, then don't take it, and then wait for a second pullback bar and then enter on the market's second attempt to reverse. Since second entries in good setups usually succeed, if one fails, assume that you are reading the market incorrectly and do not take a third entry unless it is a wedge, a failed trend channel line breakout. Were many second entry trades today in Figure 1.29, and all but one were at the same price or a worse price than the first entry. Look at the bar 10 long. The market is letting you buy at 1 tick better than the traders who bought at bar 9. In general, the good fill, bad trade maxim applies. Whenever the market is offering you a bargain, assume that you are reading the chart incorrectly, and usually it is better not to take the trade. Bar 1 in Figure 1.30 was a low 1 short at a new high on the day, but it followed 5 bull trend bars, which is too much upward momentum to be looking to sell. Smart traders would wait to see if the bulls would fail in a second attempt to rally before going short, and this happened on the second short entry at bar 2. Bar 3 was a first entry long on a new low of the day, but after 6 bars without a bullish close, it makes more sense to wait for a second long entry, which occurred on bar 4. In general, 4 or more trend bars against your intended direction means that a second entry is usually preferable. Bar 5 was a high too, but it followed 4 bear trend bars, which is too much down momentum. A second entry never developed, so smart traders averted a loss by waiting, although going long on a reversal out of an Roman 2 flag, 7 bars earlier after a long move is usually a good trade. The bar 7 Roman 2 was a possible failed final flag. Traders could have gone long on bar 8, but the prior reversal bar had too much overlap with the bar before it, and the move down from bar 6 was too strong. Bar 9 offered a second entry, following the prior bar's attempt to sell off. Bar 10 was a low one following 2 earlier bear bars since the bar 8 low, but there were 6 bars with higher lows, indication too much bullish strength. There was a second entry at the bar 11 bear reversal bar, late and missed entries. If you look at any chart and think that, if you had taken the original entry, you would still be holding the swing portion of your trade, then you need to enter at the market. However, you should only enter with the number of shares or contracts that you would still be holding had you taken the original entry, and you should use the same trailing stop. For example, if you see a strong trend underway in GS, and had you taken the original entry with 300 shares, and you now would only be holding 100 shares with your protective stop at $1.50 away, you should buy 100 shares at the market and place a $1.50 protective stop. Logically, buying a swing size portion now or holding a swing position from an earlier entry doesn't make a difference. Although it might be easier emotionally to think of the trade with the open profit as risking someone else's money, that is not the reality. It is your money, and what you are risking is no different from buying now and risking the same $1.50. A trader knows this and will place the trade without hesitation. If he does not, then he simply does not believe that he would still be holding any shares had he entered earlier, or he needs to work on this emotional issue. In Figure 1.31 GS ended in a strong bear yesterday that might have bottomed before the close when the rally into the close broke the bear trend line. There was a second long entry at bar 1 following a strong bull trend bar and a high 2. Today's opened sold off for 3 bars to test the EMA and yesterday's close, and then reversed up for an opening reversal and a higher low after a two-legged sideways correction. If a trader had missed the long and saw this chart around bar 4 after a series of bull bars, he would probably be wishing that he had caught the open so that he would at least have the swing portion of his position still working. If he normally trades 300 shares, and he would normally only have 100 left around bar 4 with a break-even stop from the bar 3 entry that he missed, he should buy 100 shares at the market and use that stop at the high of the bar 3 signal bar, maybe 10 cents below the high, since GS often runs stops. He should also look for pauses and pullbacks to add on. After adding on at the high 2 after bar 6, he could move the stop for the entire position to 1 tick below the bar 6 signal bar and then trail it up. Entering late and using the original stop is absolutely identical to being long the swing portion of the original position, using the same protective stop. Chapter 2. Trend Lines and Trend Channels. Both trend lines and trend channel lines are straight lines that are parallel to the trend but on opposite sides of the trend, forming a channel that contains the price action. Trend lines most often set up with trend trades, and trend channel lines are most helpful finding tradable reversals. Curved lines are too subjective and therefore require too much thought when you are trying to place trades quickly. Trend lines. A trend line is most helpful when looking for entries in the direction of the trend on pullbacks and in the opposite direction after the trend line is broken. Trend lines can be drawn using swing points or best fit techniques such as linear regression calculations or simply quickly drawing a best approximation. It also can be drawn as a parallel of a trend channel line and then dragged to the trend line side of the bars. But this approach is rarely needed since any signals generated are usually also based on more common types of price action analysis. Sometimes the best fit trend line is drawn just using the candle bodies and ignoring the tails. This is common in wedge patterns, which often do not have a wedge shape. Most of the time it is not necessary to actually draw a line since the lines are usually obvious. If you do draw a line, you usually can erase it moments after you verify that the market has tested it. Once a trend has been established by a series of trending highs and lows, the most profitable trades are in the direction of the trend line until the trend line is broken. Every time the market pulls back to the area around the trend line, even if it undershoots or overshoots the trend line, look for a reversal off of the trend line and then enter in the direction of the trend. Even after a trend line breaks, if it has been in effect for a couple of hours or more, the chances are high that the trend extreme will get tested after a pullback. Test can be followed by the trend continuing, the trend reversing, or the market entering a trading range. The single most important point about a trendline break is that it is the first sign that the market is no longer being controlled by just one side, buyers or sellers, and the chances of further two-sided trading is now much greater. After every trendline break, there will be a new swing point upon which to base a new line. Typically, each successive line has a smaller slope, indicating that the trend is losing momentum. At some point, trend lines in the opposite direction will become more important as control of the market switches from the bears to the bulls, or vice versa. The strength of the trendline break provides an indication of the strength of the countertrend traders. Bigger and faster the countertrend move, the more likely that a reversal will occur after the market comes back to test the trend's extreme, for example, after a lower high or a higher high in the test of the high of the bull. It is helpful to consider a gap opening and any large trend bar to effectively be breakouts, and each one should be treated as if it is a one-bar trend, since breakouts commonly fail and you need to be prepared to fade them if there is a setup. Any sideways movement over the next few bars will break the trend. Usually, those bars will be setting up a flag and then be followed by a with trend move out of the flag, but sometimes the breakout will fail and the market will reverse. Since the sideways bars broke the trend line, you can look to fade the trend if there is a good signal bar, which trend lines are valid in Figure 2.1. Every one of them that you can see has the potential to generate a trade. Look for every swing point that you can find and see if there is an earlier one that can be connected with a trend line, and then extend the line to the right and see how price responds when it penetrates or touches the line. Notice how each successive trend line tends to become flatter until some point when trend lines in the opposite direction become more important. In actual practice, when you see a possible trend line and you are not certain how far it is from the current bar, Draw it to see if the market has hit it, and then quickly erase the line. You don't want lines on your chart for more than a few seconds when trading because you don't want distractions. You need to focus on the bars and see how they behave once near the line, and not focus on the line. As a trend progresses, countertrend moves break the trend lines, and usually the breakouts fail, setting up with trend entries. Each breakout failure becomes the second point for the creation of a new, longer trend line with a shallower slope. Eventually failed breakouts fail, creating breakout pullbacks, and these allow for the drawing of trend lines in the opposite direction. After the major trend line is broken, the trend lines in the opposite direction become more important, and at that point, the trend has likely reversed. A trend line can be drawn from a trend channel line, but this rarely provides trades that are not already apparent using other more common price action analysis. Here in Figure 2.2, a bear trend channel line from bars 1 to 4 is used to create a parallel, and the parallel is dragged to the opposite side of the price and anchored at the bar 2 high, because this then contains all of the prices between the bars 1 and 4 beginning and end of the trend channel line. Bar 6 is a second attempt to reverse the break above that line, and therefore a good short setup. The trend line is almost indistinguishable from the trend line created from the highs of bars 2 and 5, and so adds nothing to a trader looking for a short. It is shown only for completeness. Bar 6 was also a failed overshoot of the bars 3 and 5 trend channel line, making the bar 6 short an example of a dueling lines trade trend line and trend channel lines intersecting and in opposite directions. The trend channel line from bars 2 and 3 in Figure 2.3 can be moved and anchored to bar 1 to create a trend line that can give an idea of where a tradable bounce might occur. A two-legged pullback overshot the trend line and reversed up on the 1-minute E-mini. Bar 2 is a big bar and should be considered to be a 1-bar trend. Any sideways movement will break the trend line but usually will set up a flag, as it did here. However, reversals are common and can be traded if there is a good signal bar. When a possible head and shoulders pattern is setting up, a trend channel line drawn across the neckline bars 2 and 6 in Figure 2.4 and dragged to the left shoulder, bar 1, sometimes gives an approximation of where the right shoulder should form, bar 8. This is of minor importance since the most recent bars are always much more important in deciding where to enter. This chart is included only for completeness. Independent of any head and shoulders pattern, a trader would short the bar 8 lower high because it was a double top bear flag with bar 5, a small wedge, and the top of a spike and channel rally from the bar 6 low. Micro trend lines, small, steep trend lines in strong trends. A micro trend line is a trend line on any time frame that is drawn across from 2 to about 10 bars where most of the bars touch or are close to the trend line, and then one of the bars has a false breakout through the trend line. This false breakout sets up a with trend entry and is the most reliable type of a high one long in a bull or a low I short in a bear. These are tiny, usually just 1 or 2 bars long, but strong bull and bear flags. If it fails within a bar or two, then there is usually a countertrend trade, which effectively becomes a breakout pullback entry and a failed final flag. The vast majority of micro trendline false breakouts are I-minute high/low I&2 pullbacks. But if you follow the I-minute chart, you will likely lose money because you will not be able to take all the trades and you will invariably pick too many bad cherries. When a trend is strong with no bar pullbacks and you are eager to get in, you can look at a 1-minute chart for a high/low 2 pullback. But it is just as easy to enter on a 5 or 3-minute micro trendline failed breakout. Any poke through it is also likely a 1-minute pullback, so enter on the failed breakout in a bull. Enter at 1 tick above the bar that dips below the trend line. Small, steep trend lines, even drawn using 2 consecutive bars, often provide setups for with trend trades. If the trend is steep, sometimes a small pullback bar or a pause bar can penetrate a tiny trend line, and when it does, it can become a signal bar for a with trend entry. Some of the penetrations are smaller than 1 tick in the E-minis, but are still valid. If the breakout pullback entry fails, for example in a falling market with a bear micro trend line, then look at the size of the bodies of the bars. If the bars are trend bars, then the second failure, the failed breakout, and then the failed breakout pullback. The odds are high that the market is giving you a tradable low too short. If the bars have more of a doji look, then the market will likely enter barbed wire, but the odds still favor a downside breakout. If you are not certain, then wait because it is likely that most traders will not be certain and barbed wire is likely. Microtrend lines can be used to create microtrend channel lines, which also can set up a reversal of a failed breakout. The microtrend channel line is usually created as a parallel of a microtrend line. However, sometimes as the microtrend line is forming, the opposite ends of the bars are also all close to a microtrend line that can be drawn after the first 2 or 3 bars of the leg form. Finally, when a microtrend line contains a very tight channel for an extended period, like about 10 bars, the odds increase substantially that the breakout failure will fail and become a breakout pullback reversal that should be good for at least a scalp. This is especially true when it develops after an extended trend move. Microtrend lines can generate many scalps during the day, especially on the 1-minute chart, which is seldom worth trading. The chart on the left in figure 2.5 is a 1-minute E-mini chart, and the numbers correspond to the same bars on the 5-minute chart on the right. Both show that failed breakouts from tiny trend lines can result in profitable fades. There are other trades on the 1-minute chart that are not shown because the purpose of this figure is only to show how 5-minute microtrend lines correspond to more obvious, longer trend lines on the 1-minute chart. So if you can read the 5-minute chart, you do not have to additionally look at the 1-minute chart to place your orders. Many of these trades could have been profitable scalps on the 1-minute chart. Note that several breaks of microtrend lines on the 5-minute chart are easy to overlook and are less than 1 tick in size. For example, bars 3, 5, 6, and 7 are failed microtrend line breaks on the 5-minute chart that would be invisible to most traders, but the one at bar 5 is particularly significant and led to a good short scalp. It was the second failed attempt to break above a bear trend line. Bar 3 was the first. Price action trading works even at the tiniest level. Note how bar 8 on the 1-minute chart was a higher high breakout test long setup, and that, although the market came down to test the bar 8 signal bar low 2 bars after entry, the protective stop below the signal bar would not have been hit. Also note that there was also an even smaller major reversal in this segment of the 1-minute chart. There was a tiny bull trend, indicated by the bull micro trend line up from the low of the chart, then a break of the trend line at bar 7, and then a higher high test of the tiny bull trend extreme. Since the pattern is so small, the trend reversal down to bar 8 was just a scalp, as should be expected. Even trend lines created using just 2 or 3 consecutive bars in a steep trend can set up with trend entries when there is a small break that immediately reverses. Each new break becomes the second point in a longer, flatter trend line until eventually trend lines in the opposite direction become more important, and at that point the trend has reversed. Bar 1 in figure 2.6 dipped below a 3-bar trend line and reversed up, creating a long entry at 1 tick above the prior bar. Bar 2 dipped below a 6-bar trend line. Traders would place a buy stop above its high. When not filled, they would move the stop to the high of the next bar and would be filled on bar 3. Incidentally, the bar before bar 2 was a possible short setup based on a microtrend channel line, not shown, that is a parallel of the 3-bar microtrend line leading up to bar 1. The upward momentum was too strong for a short without a second entry, but this illustrates how microtrend channel lines can set up countertrend trades. Bar 4 was a small inside bar that extended below a 2-bar trend line. The penetration is not shown. The buy is on a stop at 1 tick above the high of the small inside bar. Bar 5 broke the major trend line of the day. Any trend line lasting about an hour or so is more significant, so traders would be thinking that a 2-legged pullback was more likely. After the break above the bear trend line on the bar following bar 5, a short would be triggered on the bar 6 lower high. When bars are small doji bars like those following bar 5, it is usually best to wait for bigger trend bars before taking more trades, but these trendline reversals still led to profitable scalps of 30 to 50 cents in Amazon. Small trend lines and strong trends, even when drawn using adjacent bars, often have failure tests, failed breakouts that set up good with trend entries. Many of these are high/low 2 setups on 1-minute charts, but you don't need to look at the 1-minute when you see the false breakouts on the 5-minute chart, as seen in figure 2.7. When trading, You do not have to actually draw the trend lines on the chart very often because most are visible without the help of the lines. The 1-minute E-mini provided entries on trendline tests and trend channel overshoots and reversals all day long. Many of the penetrations in figure 2.8 were less than 1 tick, but still meaningful. Lines shown are just some of the ones that could be drawn on this chart, and there are many others. Each successive trend line gets shallower until trend lines in the other direction dominate the price action. In figure 2.9, there were many micro trend line and channel trades today. Only 4 are shown. A very unusual day where the Dow was down over 700 points but rallied into the close to make back half of the loss. Bar 5 is a micro trend channel reversal, where the channel line was a parallel of the bars 1 to 4 micro trend line. You could also have drawn the channel line using the lows of the bars after bar 1 and bar 3. There was a great Roman 2 setup where both bars had bull closes, which is always desirable when fading a strong bear. Bars 7 and 9 were micro trendline false breakout short scalps, low 1 setups, and both were quickly followed by buy scalps as the failure failed, creating effectively a breakout pullback buy even though both were lower lows, and a failed final flag, the breakout from the 1 bar bear flags of bars 7 and 9. The rally from bar 5 tested the EMA and broke a trendline, so buyers were looking for a second entry long on a test of the bar 5 low. Here, it was a lower low, and bar 10 was a second attempt to rally after taking out the bar 5 low. This lower low was too far below the bar 5 low and too long after the rally that broke the trend line, an extension of that from bars 1 to 4 to be ideal. But it was still a second entry with a signal bar with an up close, and a failed failure of a micro trendline break. Incidentally, note that although not drawn, there is a bull micro trendline up from the bar 5 low, and the small bear trend bar 6 bars later broke it. This was followed by a higher high test of the extreme of this small bull, and then a trend reversal down off the EMA in a bear. The price action involved is the same as for a major trend reversal. A trend line break, a test of the trend's extreme as the market once again tries to push above that price area, and then a reversal as the market fails in this second attempt. When the market tries to do something twice and fails, it usually then tries to do the opposite. Bar 11 was a classic trap to get you out of a strong rally. If you exited, you must buy again on the high one above the bar 11 micro trendline false breakout. Many of the bars today had a range of over 6 to 8 points. It would be prudent to reduce your position size to half or less, and increase your stop to 4 points and your profit target to 2 points. Otherwise, it was just another well-behaved price action day. Horizontal lines, swing points, and other key price levels. On most days, which are trading range days, horizontal lines across swing. Highs and lows often serve as barriers that result in failed breakouts and then reversals. Expect swing high breakouts to fail and form higher highs, and swing low breakouts to fail and form lower lows. Sometimes the failure fails, and the market makes a second more extreme higher high or lower low. A fade of a second higher high or lower low setup is even more likely to be successful because many of them are variants of 3 push patterns. On trend days, horizontal lines should generally only be used to enter on pullbacks, like with the double top bear flag or a double bottom bull flag patterns. Once there has been a clear trendline break, a failed test of the extreme can be a good reversal setup, especially if there is a strong reversal bar and a second entry, a high/low too. Most days are not strong trend days, and on these days traders should be looking at all prior swing highs and lows for failed tests and reversal entries. High/low 2 entries are the best. A second higher high or lower low is a more extreme point on a trading range day where the middle of the day acts like a magnet, and a further extreme is therefore more likely to yield a scalper's profit. For example, bar 5 in figure 2. 10 is a second higher high over bar 2, and 3 pushes up from bar 3. Bar 9 is a lower low below the open of the day and the 7th point of an expanding triangle bottom. Bar 13 is a large double bottom pullback. There were multiple bottoms to choose from for labeling the double bottom, and bars 3 and 9 might be the best. Bar 15 is a double top bear flag. When it failed, the market became noticeably more bullish. Bar 17 is a second lower low below bar 14 and a lower low below bar 16. Both days were strong trend days in figure 2.11 with one extreme near the open, and then no EMA pullback for over 2 hours 2 days. On strong trend days, only consider fading swing highs in bulls and swing lows in bears if there was first a good trendline break. Acceptable countertrend entries were at bars 4, 8, and 12. However, since these are countertrend, and there was only minimal countertrend momentum on the trendline breaks, these trades should only be scalps. Not take them if they are distracting you from the with-trend entries, where you should swing much of your position. Bars 1 and 5 formed a double bottom bull flag, and bar 9 was part of a double top bear flag. Both bars 5 and 13 gave great with-trend entries, EMA gap bars, 1130 traps based on swing fades. Bar 5 was a swing low breakout fade, and bar 13 is a swing high breakout fade. Trend channel lines. Trend channel lines are on the opposite side of the price action from a trend line and have the same general slope. In a bull, a trend line is below the lows and a trend channel line is above the highs, and both are rising up and to the right. A trend channel line is a useful tool to fade a trend that has gone too far, too fast. Look for an overshoot that reverses, especially if it is a second reversal of the overshoot. Usually when there is a trend, you can find a trend line and a trend channel line that contain it. The market will eventually break out of the channel in either direction. Most trend channel line overshoots reverse back into the channel, but sometimes one will continue, and this results in a steeper trend. Also, most trend line breaks fail, but they generate a new swing point that creates a new, less steep trend line, indicating that the trend may have become weaker. Eventually, there will be a trendline break that extends so far beyond the trendline and has so much momentum that the pullback from this surge will fail to exceed the prior trend extreme. This swing point, a higher low in a new bull or a lower high in a new bear, can be used to draw a trendline for the incipient trend, using the end of the old trend as the first point of the trendline. As the new trend develops, its trend lines and trend channel lines represent what is taking place better than the lines from the old trend, and they become the focus of your trading. Since most trend line and trend channel line breakouts fail, entering on the breakouts is a losing strategy. It is far more profitable to look to enter on the failure, but if the breakout extends far, then you should wait for a pullback and then enter in the direction of the breakout. A trend channel line can be a parallel to a trend line and dragged to the opposite side of the price action. It can be drawn across spikes on that opposite side, or it can be a best fit line, like a regression line or visually drawing a best fit line. In a bull, a trend line is drawn across two lows. If that trend line is used to form a trend channel line, then drag it to the opposite side of the trend. You want it to be above the highs of all of the bars located in between the two bars used to create the trend line. So drag it to the high of whatever bar that will leave it touching that bar alone. Occasionally, you will get a better sense of the trend if you anchor the line to a bar that is outside of the two bars. Always do whatever best highlights the trend. Alternatively, a trend channel line can be useful when created on its own. In a bear swing, a trend line will be downward sloping and above the highs. The trend channel line will have a similar slope, but draw it between any two swing lows in the bear swing. It is most useful if it is below all of the other bars in the swing, so choose the bars that will give that result. Trend channel line overshoots are closely related to wedges and should be viewed and traded as if they are one and the same. Most wedges have failed trend channel breakouts as the trigger for a reversal trade, and most trend channel overshoots and reversals are also wedge reversals, although the wedge may not be obvious or have a perfect wedge shape. The wedges are less obvious and less likely to be present when the trend channel line is constructed as a parallel of a trend line, but wedges are still often present. Why do so many reversals occur after trend channel line overshoots when everyone knows that it commonly leads to a reversal? Won't early entrance prevent the line from ever being reached? Common wisdom is that novice traders on the wrong side hold their losing positions until they cannot stand any more pain, and then suddenly all of them exit at once, creating a blow-off or a parabolic climax. However, that is not a meaningful component of a reversal in a huge market like the E-min is. Smart traders won't trade countertrend until either there is a pullback from a strong trendline break or there is a reversal from a trend channel line overshoot. For example, in a bull, smart money will keep buying until they drive the price above the bull trend channel line, and then they will take profits. There may be a couple of failures along the way, and then a longer and steeper line comes into play, but eventually the market will agree on which line is the final one. At the same time as the profit takers are taking profits, many will reverse, and many others who were already flat will initiate shorts. Other smart traders will wait for a reversal on the charts, and there will be traders entering on reversals on all types of charts, 1 to 5 minute, and volume charts and tick chart of any size. Once they believe that the top is in, this smart money won't be looking to buy any longer. They are short, and many of these traders will hold through a new high despite an open loss on their current position, believing that the top is in or close to in. In fact, many will add on above the high, both to get a better average price for their shorts and to help push the market down. The big players are only thinking short and won't be scared out except by the rare occurrence of a failed second entry or a huge failure, for example, maybe 3 points above their entry. There are no buyers left, so the market only has one way to go. Look at the volume at key turning points. It's huge. The only logical way that can happen is if institutions are exiting in one direction and entering in the other, and other institutions are taking the opposite side as part of a hedge in another market: stocks, options, bonds, currencies, and so on. They perceive that their risk-reward ratio is better by buying futures at the high or selling them at the low and offsetting the risk in another market. Nothing else makes sense. You know that the volume is not from small individual traders being squeezed out of shorts and buying at the high. There are plenty of stupid people out there, but if you were to pool all of their buys at the high, it is still small compared to the institutional volume. Reversal at an overshoot happens because it is such an entrenched part of institutional trading psyche that it has to happen. Even if an institution does not look at charts, it will have some other criterion that tells them that the market has gone too far and it is time to exit or reverse, and this will invariably coincide with what price action traders are seeing. Remember, price action is the inescapable footprint of what is happening to price as a huge number of smart people are independently trying to make the most money that they can in the market. In a big market, it cannot be manipulated and will always be basically the same. One final observation is that the slope of the final flag of a trend often provides an approximation of the slope of the new trend. This has limited value to a trader because there will be other much more important factors involved in the decision leading up to placing a trade, but it is an interesting observation. Extend them to the right and watch how the price acts when it penetrates the channel line. Trend channel lines are commonly drawn in one of two ways. First, as a parallel line, dashed line in figure 2.12 of a trendline solid line, and then dragged to the opposite side of the action, placed to touch a swing point located between the two bars used to create the trend line. Choose the point that will result in all of the bars between the trend and channel lines being contained between the lines. The second type, dotted line of trend channel line, is drawn across swing points and is independent of any trend line. You can also simply draw a best fit, but these are usually not helpful in trading. The slope of the final flag of the bull in figure 2.13 provided direction for the subsequent bear. A linear regression trend line drawn between bars 1 and 2 became a rough bear trend channel line for the sell-off that extended into the next day. It is possible that it contributed to the buying at bar 7, but bar 7 was a buy simply based on the trendline break, and the second attempt to reverse the breakout below the low of the open. It is usually far better to place orders based on the most recent price action if it provides a justification for a trade than to look back 30 or more bars. The trend line from bars 2 and 3 in figure 2.14 was used to create a parallel that was dragged to bar 1 and extended to the right. This trend channel line dotted was not penetrated by bar 5. Also, it was anchored to bar 1, which is not in between bars 2 and 3, the bars used to create the original trend line. However, traders should always be looking at every possibility. Had there been a penetration and reversal, the chances of a two-legged rally off the bar 5 low would be improved. The simple trend channel line using bars 1 and 5 was penetrated by bar 6. But this is not an ideal trend channel line to use as a basis for a countertrend trade, since bars 1 and 5 were far apart, and bars 5 and 6 were close together. Trend lines work best when they are tested by a third leg, and here bars 5 and 6 were essentially still part of the same leg, 3 pushes down, bars 4, 5, and 6. The trade was still worth taking because bar 6 was small, so the risk-reward ratio was good. This is also a shrinking stair pattern down, which indicates waning bearish momentum and supports along. Dueling lines, intersecting trend line and trend channel line. When a longer trend line is tested and the test occurs at a shorter-term trend channel line of opposite slope, look to enter in the direction of the trend if the test is successful, failed breakout, and reversal. The trend channel line test indicates that the correction is over and the location is perfect, since it is a test of a longer trend line. A bear trend channel line drawn from bars 3 and 5 in Figure 2.15 offered support at bar 6. Bar 3 was a swing low in a bull, and bar 5 appeared to be a swing low in a new bear. However, the move down to bar 6 was just a large two-legged correction in the bull market. There were dueling lines at bar 6, a bull trend line and a bear trend channel line of opposite slope, and the market reversed up at the intersection, as is common. Since the move down to bar 6 was steep, it is reasonable to wait for the second entry at the bar 7 higher low, buying on a stop at 1 tick over its high. A bear trend channel line could also have been based on a trend line drawn across the 2 swing highs that followed the bar 4 high, and then anchored to bar 5. The goal is to look at the overall shape, and then choose any trend channel line that contains the price action. Then, watch how the market reacts after penetrating the line. Bar 4 in Figure 2.16 tested the bear trend line, and as it did, there was an overshoot of a smaller bull trend channel line from bars 3 to 4, resulting in a short scalp off the dueling lines pattern. There was a second entry at the bar 6 nominal higher high. Chapter 3, Trends. Why is it important to recognize the existence of a trend? Because then most of your trades should be in that direction, and you must try to take every with trend entry and rarely take counter-trend entries. The earlier you see the trend, the more money you stand to make. Focusing on the counter-trend setups will likely make you miss the much more profitable, but often scarier with trend entries. The with trend entries are scary because the market always looks overdone, and it's hard to imagine that selling near the low of an overdone bear or buying near the high of an overdone bull could ever be profitable. However, that is exactly why it is. The market draws in counter-trend traders, and if you enter where they exit at a loss, they will drive the market in your direction, even though the market looks so overextended. This chapter describes many common trend patterns that you should look for every day. If you see one setting up within the first hour or two of the day, there will likely be several high probability with trend trades that you can then make. You need to decide many times every day if the day resembles any of the types of trends described later in this chapter, and if it does, force yourself to take the with trend trades. A trend is a series of price changes that are mostly either up a bull trend or a bull or down, a bear trend or a bear. A trend can be as short as a single bar. Remember, a trend bar is made up of a trend on a smaller time frame or longer than all of the bars on your screen. Trends are loosely classified into 4 overlapping and often interchangeable categories: trend, swing, pullback, and leg. The distinctions are just guidelines because each of the 3 smaller versions is a different version on different time frames. For example, a pullback in a bull on a 60-minute chart might be a strong bear trend on a 1-minute chart. Also, each category will contain one or more of the smaller versions. A trend might be made of 10 swings, each containing 1 to 4 pullbacks, and each pullback might have 1 to 4 legs. Also, every up and downswing of any size is commonly referred to a leg, so the distinctions are not very important, but each term carries a subtle distinction with it. At its simplest, a trend is present when the chart on your computer screen starts at one of the 2 left-hand comers and ends at the diagonally opposite comer of the screen with no huge fluctuation in between. For example, if the bars on the left are near the lower left comer of your monitor and the bars on the right are near the upper right-hand comer, and there are not many large upswings and downswings in the middle of your screen, then this is a bull trend. A chart only shows 1 or 2 trends. If more than 2 trends are present on a chart, it is preferable to describe the trends by using one of the other 3 classifications because the 2-sided action creates different trading opportunities. Both swings and legs are smaller trends, and there are at least 2 on the chart. The term swing is used when there are two or more smaller trends on the chart, even though the overall chart might be sideways. A leg is any smaller trend that is part of a larger trend, and it can be a pullback, a countertrend move, a swing in a trend or in a sideways market, or with trend move that occurs between any two pullbacks within a trend. A pullback is a temporary countertrend move and is part of a trend, swing, or leg. For example, a bull pullback is a sideways to downward move in a bull trend, swing, or leg that will be followed by at least a test of the prior high. Any bar or series of bars that represents any pause or loss of momentum is a pullback, even if there is no actual backward movement. This includes a single inside bar, which obviously does not extend below the low or above the high of the prior bar. When it is a single bar, the bar is called a pause bar or a pullback bar. These one-bar pullbacks are made up of a series of small swings on a smaller time frame chart. However, you might have to go all of the way down to a 1-minute or a 100-tick or smaller chart to see them. This is a waste of time for a trader, but it is helpful to be aware of the reality because it provides a rationale for considering placing a trade. Within any trend, there are a number of smaller opposite trends, some lasting for only 1 or 2 bars, and all of them should be considered as likely to fail and therefore setups for trades in the direction of the larger trend. In a bull, the swings should be trending upward, meaning that each pullback should be above the prior pullback, and it should result in a new high trending highs and lows or trending swings. All moves with strong momentum usually have at least a test of the extreme following a pullback. All strong moves usually have at least 2 legs, even if the second one falls short and reverses. All trends, no matter how small, must first break a trend line from the prior trend or trading range and then have trending swings, such as a series of higher highs and lows in a bull. Absent either of these, there is no trend. Best risk-reward ratio occurs when you enter on the first pullback after a trendline break, before there is a clearly established trend. As a possible trend day is unfolding, traders should look for signs of strength, each of which increases the odds that the trend will continue. The trend continues until after it breaks its trend line, and then it continues some more. You should not be trading countertrend until the market has enough strength to break the trend line. However, even then, you should not be entering countertrend until the market first goes back to test the extreme of the trend. This means that even after a trendline break, you should still be looking for with trend trades because there should be a test of the old extreme. Sometimes there is so much strength on the trendline break that there should not be much of a test of the trend extreme, but this is the exception and not the rule. If you find yourself drawing many trend channel lines or looking at a 1-minute chart, then you are too eager to find a reversal and are likely missing lots of great with trend trades. You are in denial and are losing money because of it. Also, since most trend channel line overshoots and reversals are minor in a strong trend and fail, you will be trading lots of losers and wondering why these patterns are failing when they are supposed to be so good. Wait for a trendline break on the 5-minute chart before looking for a countertrend trade and look at all those minor trend channel line overshoots as with trend setups, and enter where the losers are exiting on their protective stops. You will be much happier, relaxed, and richer, and you will be entertained by how well they work when intuitively they should not because the market appears to have gone much too far without a correction. Whenever you find yourself waiting a long time for a great reversal, you are oblivious to the trend that is in front of you. When a trend is that strong that it cannot get anywhere near a trend line but you feel it has gone much too far, and you think that entering with trend near the extreme is risky, you are missing the most reliable trades that exist. All minor pullbacks, even a single small inside bar, are great with trend entries. After a substantial decline in a bear market on the daily chart, people begin to become very concerned about the money that they've lost, and they do not want to lose any more money. This makes them sell, regardless of the fundamentals. There was an added problem in the bear of 2008. Baby boomers were on the verge of retiring and were shocked by what they saw as comfortable nest eggs quickly falling 40% in value. So what will they do? They will continue to sell every rally as they try to preserve what they have left. Also, all that money that they are taking out of the market will never return to lift prices again. They will take their money at all the thank you, God points along the way. This will be just below the prior swing high, where they exit and promise God that they will never buy again in return for him letting them recoup some of their losses. This creates a series of lower highs and lows until the last bear has sold. Once that happens, the market will then be able to rally above the prior swing high. The result of people selling regardless of fundamentals is that the market often falls in huge bear trend days, dropping much further than what the fundamentals warrant, and often there is a huge plunge in the final 30 minutes as funds are forced to sell because of redemption orders. There will be vicious rallies along the way as people become convinced that the bottom is in, and they panic to get back long. Also, because the trend is so clearly down, there will be many who are short and will cover aggressively, resulting in huge bull trend bars on the daily chart, but still in a bear market. The end result is a collection of very large range days once the bear is well underway. The huge ranges offer great price action day trading opportunities, but you might have to increase your stop size and therefore reduce your position size. While people following the daily charts are selling at the low and buying at the high of each trap, every strong short covering rally, trading off emotion more than reason, a good price action trader can do very well just looking for standard price action setups. This kind of mentality is not restricted to unsophisticated investors. In the fall of 2008, most hedge funds were down on the year, and their sophisticated investors aggressively pulled their money out as the market continued to sell off. The hedge funds had to continue to liquidate on every small rally to meet redemptions and anticipated redemptions. This continued to drive the market down, independent of fundamentals, and just like with less sophisticated investors, the selling will continue until all that's left are positions that investors will hold until they fall to zero. Also, for many hedge fund managers, a big part of their income is incentive-based. For example, every quarter that the fund closes at a new high, they might take 20% of that profit above the old equity high. If the fund instead is down 30% on the year, it will need to earn about 50% to get up to that incentive level again. Rather than working for free for several years, it might make more sense to close the fund and start over with a new fund. However, when they close the fund, they have to liquidate, and since there is no incentive for them, they can liquidate at any price, no matter how low. This adds to selling that is independent of the intrinsic value of stocks. If they have a $1 billion fund, their new fund is starting from scratch, and it will take a few years before they have enough equity and own as much stock as they did in the old fund. So buying by the new funds don't immediately lift the market. When the volatility reaches an extreme, the end of the bear is often near as traders give up responding to the whipsaws and decide that there is nothing left that they will sell at any price. When there are no more sellers and the market is overdone on the basis of fundamentals, a good rally should follow. And just how far can a big-name stock fall in a bear? Much farther than you might think, even for the bluest of the blue chips. Cisco lost 90% of its value in 3 years after the tech wreck of 2000, and Apple lost 85% of its value in the 6 years after 1991. GM lost 95% in the 8 years after 2001. So don't be eager to buy just because a stock is down a Fibonacci 3850 or even 62%. Wait until there is a price action setup, and it must include a prior break of the bear trendline. Incidentally, what caused the 2008 crash? The housing bubble burst more than 2 years earlier, and the credit crunch was well known for more than a year, but the market began its crash when the world realized that Barack Obama was actually going to be the next president. The concern was that he would increase regulations on business and increase their labor costs, and both would reduce earnings. The world panicked in its adjustment to this new perceived reality and collapse in search of the new appropriate value for stocks given a less capitalistic America. It most likely overreacted, and Obama will almost certainly not be as bad for the economy as people fear. He may even come out to be great, but there is no way to know at this point. Since the market is technically overdone, it will likely go sideways for many months as it gives Obama a chance to reveal his hand. However, the fall was so sharp that it will probably be years before the old highs are surpassed, and it is possible that the market will drift down for several years. The odds still favor a trading range because that is the most common state of the market, especially after a violent move. 2 legs. A break of a trend line creates a new leg. If there is a trend, even a small one, any pullback that breaks any trend line defines that trend as a leg and the pullback as another leg. Anytime there is a new trend or any capitulation of one side, there will usually be at least a 2-legged move. This can occur in a pullback in a trend, a breakout, a major reversal, or any time that enough traders believe that the move has sufficient strength to warrant a second attempt to test whether or not a protracted trend will develop. Both the bulls and bears will be in agreement that the momentum is strong enough that a test will be needed before they develop a strong conviction one way or the other. If the second attempt fails, a reversal pattern forms, then the market will usually attempt to do the opposite. Some complex two-legged moves take place over several hours, and if viewed on a higher time frame chart, would appear clear and simple. However, any time a trader diverts his attention away from his trading chart, he increases the chances that he will miss important 5-minute trades. To be checking the higher time frame charts for the one signal a day that they might provide simply is not a sound financial decision. Every trendline break and every pullback in Figure 3.1 is a leg, and each larger leg is made of smaller legs. The term is very general and simply means that the direction of movement has changed, using any criterion that you choose to determine that the change exists. Signs of strength. There are many characteristics of strong trends. The most obvious one is that they run from one corner of your chart to the diagonally opposite corner with only small pullbacks. However, in the earlier stages of a trend, there are signs that indicate that the move is strong and likely to last. The more of these signs that are present, the more you should focus on with trend entries. You should start to look at counter-trend setups only as great with trend setups, with you entering on a stop exactly where those counter-trend traders will be forced to exit with a loss. One interesting phenomenon in trend days is that on many of the days, the best reversal bars and the biggest trend bars tend to be counter-trend, trapping traders into the wrong direction. Also, the lack of great with trend signal bars makes traders question the entries, forcing them to chase the market and enter late. Finally, once you realize that the market is in a strong trend, you don't need a setup to enter. You can enter any time all day long at the market if you wish with a relatively small stop. The only purpose of a setup is to minimize the risk. Here are some characteristics of that are commonly found in strong trends: big gap opening, trending highs and lows swings, no climaxes and not many large bars, not even large trend bars. Often, the largest trend bars are countertrend, trapping traders into looking for countertrend trades and missing with trend trades. The countertrend setups almost always look better than the with trend setups. No significant trend channel line overshoots, and the minor ones result in only sideways corrections. Failed wedges. 2HM. Few if any profitable countertrend trades. Small pullbacks. If the E-min's average range is 12 points, the pullbacks will all likely be less than 3 or 4 points. You find yourself wading through countless bars for a good with trend pullback, and one never comes, yet the market slowly continues to trend. Sideways corrections after trendline breaks. Repeated high/low 2 and M2B and M2S with trend entries. No two consecutive trend bar closes on the opposite side of the EMA. Bars with no tails or small tails in either direction. With a trend in runaway mode, there will likely be no pullbacks for many bars, and the bars will be good-sized trend bars with mostly small tails. Since you want to keep scalping more as the trend continues while still holding onto the swing portion of your position, consider looking at the 3-minute chart. It often has more pause bars, countertrend inside bars, and 1-bar pullbacks that allow for with trend entries. 1-minute chart also has with trend entries, but it also has some countertrend setups, which can be confusing when you are trying to only trade with trend. This, along with the speed of the reading required, can create too much stress during a runaway trend and can interfere with your ability to trade effectively. Since you need to be making sure that you catch every with trend entry, it is best to trade only off the 3 or 5-minute charts in a runaway trend. 5 R-Ninute E-mini in Figure 3.2 gapped up 11 points, which is huge, and the first bar was a bull trend bar. Large gaps that don't reverse early usually mark the start of a strong trend for the day, and the day often closes at or near the high or low in a bear. Also, the market did not test the EMA for over 2 hours, a 2HM pattern, another sign of strength. Notice how there was not much emotional behavior: big bars, climaxes, big swings. Quiet markets with lots of small bars, many of which are dojis, often lead to the biggest trends. On days like this, the institutions have a huge amount to buy, and they want lower prices, but when the lower prices don't come, they have to fill their orders in pieces all day long at increasingly higher prices. even though they see the trend day unfolding and expect that they will likely have to be buying at higher prices all day long. They don't dump all of their buy orders onto the market at once, because this could cause a climactic spike up and then possibly a reversal down below their average entry price. They are content filling their orders in manageable pieces all day long, understanding that they are buying higher and higher, but knowing that the market will likely go higher still. Also, strong days like this usually have higher prices over the next 1 to several days. The market had a small two-leg move down to bar 3. A bear trend bar and 2 dojis composed the first leg, and then a second leg made up of a bear trend bar with a large bear tail on top. The tail was the pullback that ended the first leg down, followed by a doji. This was a variant of a two-leg move and is certainly going to have 2 clear legs down on a smaller time frame chart, setting up a high 2 variant. Buy at 1 tick above bar 3. It is also a test of the gap, forming a double bottom bull flag. The opening gap is the flagpole. Since this is a possible trend day and as such could extend much further than most traders would ever suspect, smart traders will swing part or all of their positions. R5 is a high 1 breakout pullback after a strong move up, 4 bull trend bars, and a high 1 is always a good buy in a strong bull. The bar 4 low 1 break below the trend line and reversal from the new high is not a short, even for a scalp. After such a strong up move, smart traders would only be looking to buy and would only consider a short if there was a second entry. Bar 6 is a low 2, which is a second entry short. However, in the face of the strong bull trend, shorts would only scalp this trade. They would only swing it if there was first a prior strong down move that broke a substantial trend line, maybe 20 or more bars. If they short, they will be quick to exit and then they will look for a long setup for a swing trade. With trend entries in a strong trend should be mostly swung, with only a small portion taken off as a scalp. If you find that you missed a with trend entry, stop looking for counter-trend scalps and start trading only with trend setups. During a trend day, you must try to catch every with trend signal because that is where the source of the most consistent money is. Since the bar 6 entry bar was a strong bear trend bar, there is a chance for 2 legs down. Bar 7 is an entry bar for a low 2 short into the second leg down, but after a 6-bar tight trading range, any breakout in either direction would likely fail after not going very far. Bar 8 is a 2-legged pullback and the first to the EMA in a strong bull, which is a great buy. Whenever the market stays away from the EMA for 2 hours or more, the trend is very strong. Bar 9 is a reversal at a new swing high, but there were no bear trend bars among the prior 7 bars, so no short can be taken unless a second entry forms. Bar 10 is a second entry, but in a tight trading range in a bull, any short is a scalp at best, and it is probably best to pass on this trade. Outside bars are less reliable, but you could consider taking the short for a scalp since second entries are so reliable. 3 small dojis developed at the EMA. The odds are high that there will be a trend bar breakout and it will fail. Hold short and risk maybe for ticks. The bar 11 bull trend bar breakout failed, as expected, allowing you to take your 4-tick scalp profit on the next bar. Bar 13 was a breakout test that extended 1 tick below the high of the signal bar that generated the strong move up from the bar 8 long. The move down from bars 9 to 13 was very weak and appears essentially sideways. The market struggled to get down to test the breakout, meaning the bears lacked conviction. Bar 13 also set up a high 4 entry just below the EMA, and it was the first EMA gap bar of the day, a bar with a high below the EMA. It formed a higher low higher than bar 8 following a higher high at bar 9 and is part of trending bull swings. It is essentially a double bottom bull flag with bar 8. Bar 14 is a high 2 breakout. Bar 15 was a bear trend bar for the first leg down, followed by a bull trend bar and then a second bear trend bar, completing the 2 down legs actually. A small, sideways 2-legged correction or flag. High 2 breakout pullbacks are strong entries. There was also a failed wedge top. It broke down for only a single bar at bar 16, setting up a long above the bar 17 failure. Bar 18 broke above a bull trend channel line and gave a low 2 short signal. However, on a strong trend day, smart bears will only short if there is first a strong bear leg that broke a trend line. Otherwise, they will view all short setups as buy setups. They will place orders to go long exactly where the weak shorts will have to cover, such as one tick above the highs of bars 17 and 19. Bar 19 was a one-bar trendline break that failed and therefore a buy setup. One peculiarity of trend days is that often the best-looking reversal bars and trend bars are countertrend, trapping traders into losing trades in the wrong direction, bars 1-8 in figure 3.3. Notice how there was not a single great bear reversal signal bar all day, yet this was a huge bear. Just look at the moving average. The market could not put 2 consecutive closes above it until the gap bar at the top of the rally that began with bar 8. This is a bear, and every buy should be viewed as a short entry setup. Just place your entry order exactly where the longs will have their protective stops, and let them drive the market down as they liquidate. Common trend patterns. In the following sections, there are descriptions of several common types of trend days. The names are meaningless because all that a trader needs to know is how to read the price action, which is the same for any pattern. However, the names allow for the organization of common patterns, and this makes it easier for traders to learn and anticipate important price action concepts. With all trend patterns, the only reason to apply names to them is because they are commonly recurring patterns, and if you recognize one as it is unfolding, you should be focusing on trading with trend only and be more confident about swinging a larger part of your trade. The setups will be the same as during trading range days, but you should be trying to take every with trend entry, no matter how weak the setup looks, and you should only take counter-trend entries after a trendline break and only if there is a good reversal bar, and only if you are still able to take every with trend signal. If you find that you are missing any with trend entries, stop trading counter-trend and focus only on with trend setups. On the counter-trend trades, you should scalp your entire position. Also, you should not find more than 2 or 3 counter-trend trades in the day, and if you do, you are spending too much time looking in the wrong direction and likely missing great with trend swings. The stronger the trend, the more you need to be swinging with trend and not scalping counter-trend. In a very strong trend, all trades should be with trend swings scalping out part, and no trades should be counter-trend scalps, as tempting as they are. Once you are familiar with these patterns, you will find that you can see them potentially setting up in the first 30 to 60 minutes. If you do, make sure to take every with trend trade and swing part of your position. Sometimes you will get stopped out of the swing portion a couple times, but keep swinging apart because if the day becomes a trend day, a single swing can be as profitable as 10 scalps. As a corollary, if you cannot see one of these patterns setting up, then assume that the day is a trading range day and look for entries in both directions. Also, a trend day can turn into a trading range day or a trend in the opposite direction at any time. When it happens, don't question it or be upset by it. Just accept it and trade it. Trend from the open. This is usually the strongest form of trend pattern. The market forms one extreme in the first bar or two and then trends all day, closing at or near the opposite extreme. After the first couple bars of every day, especially if there is a large gap, you always have to consider the possibility that a trend from the open might be forming, and you must look for swing entries. In the majority of cases, your break-even stop will be hit, but there will be a sufficient number of times that it will not and you will make a large enough windfall profit to make this type of trading worthwhile. There may be a small trading range for the first 30 minutes or so and then a breakout, but the open of the day will usually be very close to one extreme of the day, the low in a bull or the high in a bear. These days often open with large gaps, and then the market continues as a trend in either direction. In other words, a large gap down can lead to a trend from the open bull or bear. This type of trend is so strong that there is usually follow-through in the first hour or two of the next day, so traders should be looking to enter with trend on a pullback after the open. The pullback is often a higher time frame, two-legged correction, like a pullback to the 5-minute EMA. However, most traders would find it easier to simply read only one chart when trading. Whenever a trend is so strong that it never pulls back enough to make you feel comfortable, it is tempting to look at 1-minute charts to find entries with smaller risk. However, if it was just that easy, everyone would do it. The problem is that there will be countless stop runs on all 1-minute entries that will just kill you as the day goes on. You keep entering with trend, but your stop keeps getting hit by sharp, quick tails. If you want to make money, just stay with the 5-minute and take every tiny entry, and you will be shocked at the end of the day to discover that all of those trades that looked like they couldn't possibly work because you were selling the low of the day in a bear or buying the high of a bull, and because the 1 minute was so choppy, in fact, all worked. In figure 3.4, yesterday closed strongly above an earlier strong swing high. First leg up was climactic, with many bull trend bars, very little overlap, and only small tails. However, the correction to bar 3 broke a trend line and made a reversal after the next leg up more likely. Also, bar 4 broke above a bull trend channel line and was followed by an inside bar, a possible signal bar, but the best bear signal bars usually have bear bodies. Bar 5 was the first bar of the day, and it opened on its high tick. Most traders would not be nimble enough to sell below that inside bar, but it would be reasonable to sell a small position on the close of the bar. If you missed the first entry, you could look at a 1-minute chart for a small pullback. There were many to short or simply wait for a 5-minute setup. When there is a trend from the first bar, selling the first pullback is a high probability trade, even though it is hard to take since you are selling near the low of a big move down. Bar 6 gave a low 1 short, and bar 7 gave a low 2 breakout pullback after breaking below yesterday's low, and the trade continued down for about $5 more. Bar 8 was a reversal up from a second break below a bear trend channel line drawn parallel to the bars 6 and 7 trend line, so 2 legs up are likely. They ended with M2S short at bar 9. The day turned into a spike and channel bear and did not close near the low. The day started as a bear trend from the open in figure 3.5 after a 1-bar rally to close the gap to yesterday's low, not shown. However, the bar 4 higher low that followed the bar 3 rally that broke the bear trend line led to a runaway bull. Bar 2 also reversed up after a trend channel line overshoot. The line is not shown. Why are the best trends so difficult to trade? Because all of the with trend entries look weak, and there are many small pullbacks that trap traders out of the market. None of these pullbacks in figure 3.6 would have hit a 2-point money stop, which is usually the best stop to use in a strong trend, unless the average daily range is more than about 15 points. With so many small bars, price action stops get hit too often, and it makes more sense to rely on the original 2-point stop. When the trend is strong, you need to do whatever you can to stay long. With a large gap up on the open, the odds favored a trend day up or down. With no significant selling in the first several bars, there was a possibility of a bull trend from the open, so traders had to be looking long. Bar 3 was a high 2 and a low 2 that failed, but when there was a Barb wire pattern, you should be selective about entries and wait until one side is trapped or until there is a small bar near the high or low. Since this is a possible trend from the open bull, you can only be looking to buy for the time being. Bar 4 was a small bar near the low of a bull Barb wire pattern, and it is a buy, even though it is a high 3. It is also a high 2 from the bar 2 high. You cannot wait to see if a high 4 will develop when there is a strong trend. Bars 1, 5, 8, 11, and 14 are all high 2 longs. Bar 6 is a long since it is a failed wedge short. Bears are trapped. Bar 9 was the FOMC report, Federal Open Market Committee. It was a breakout test of the high of bars 2 and 3 and hit at the break-even stop on longs from that breakout to the tick. Just like earlier in the day during the breakout above bars 2 and 3, the market found aggressive buyers at the same price. Notice something unusual about bar 10. It is the first bar in 5 hours of trading that had a close below the EMA and is therefore likely to fail, setting up a buy. Bars 3 and 13 were failed high 2 longs Barb wire, but when there is a strong trend, either rely on a 2-point stop or take the loss. But if you take the loss, you must buy again on the very next setup, bars 4 and 14. Bar 14 was a great bull trap that set up the rally into the close. It first gave a buy signal and then traded below the inside bar. You cannot tell from this chart, but that is what happened. It first traded above the inside bar, then below it, and then above it again, all in bar 14, running stops on traders who used a price action stop instead of a 2-point stop, and then it reversed back up. An outside bar that traps traders out of a trend often leads to a strong trend leg as traders are forced to chase the market up. Reversal day. Some of the strongest trends begin in the middle of the day, not the first or last hour, and originate as trading range breakouts or trend reversals, usually attributed to some news item, but this is unimportant. In either case, the market can enter a runaway trend mode where it trends relentlessly with only minor pullbacks. There are large trend bars with little overlap and mostly small tails. You must enter quickly, even if the new trend looks climactic and overdone, and it is, but it will likely continue to get much more so, and swing most of your position. In a runaway bull, there are more chances to buy on the 3-minute chart. Bars 1 and 2 in figure 3.7, which were small countertrend inside bars on the 3-minute chart, were not clear signals on the 5-minute chart, but offered profitable high 1 long opportunities. The bar 3 long was present on both charts. Trend resumption day. On a trend resumption day, there is a trend off the open and then sideways action that can last 2 to 3 hours, and finally a breakout and resumption of the original trend. Midday sideways action sometimes has 3 countertrend lazy swings, and sometimes the third fails to surpass the second, forming a head and shoulders flag. Most head and shoulders reversal patterns fail and become continuation patterns. Because the pattern often has 3 pushes instead of 2, it traps traders out, thinking that this countertrend action might in fact be a new trend. However, don't let yourself get trapped out, and be ready to enter when you see a good setup that will get you into the market in the same direction as the morning trend. The difficult part of this type of day is that the quiet midday sideways movement often leads traders to give up on the day, when in fact they should view this as an opportunity. Just be ready to enter. The market opened with a large gap up, and then had a test of the low and a big rally up to bar 3 in figure 3.8. From there, it traded in a tight range for more than 3 hours, lulling traders into thinking that the good trading was done. Bar 6 reversed up from a poke below a bear trend channel line, and it also dipped 1 tick below the bar 4 signal bar high. Finally, the signal bar was the first EMA gap bar of the day. There were several other chances to get long. Bar 7 was a high 2 and a reversal up from a 1 tick break of a bull micro trend line. Bar 8 was a high 2 variant bear bull bear bars. Bars 9 and 10 were failed breaks below micro trend lines. Trending trading range days. Unlike other types of trend days when you want to trade almost exclusively with trending trading range days are made up of trading ranges, so you should trade each trading range like any other trading range, and don't hesitate to trade in both directions, fading the trading range extremes. Some trend days are made of a series of 2 or more trading ranges separated by brief breakouts, and sometimes they may not be readily seen as trading ranges. However, on the daily chart, the day is clearly a trend day, opening near one end and closing near the other. The market breaks out of one range and then forms another. Sometimes even 3 or 4 can develop in a day. If the market later pulls back into a prior range, it often will retrace all the way to the other side of that range. The implication is that the market consolidates in a range after the breakout, which means that there will be two-sided trading that tests both the top and bottom of the range and possibly a breakout in either direction at some point. Because of this two-sided trading throughout the day, it is common for the day to reverse through at least one of the trading ranges in the final hour or 2 of the day. If the market reverses back into the prior range, it will likely test the countertrend signal bars in the prior range. For example, if a bear trend reverses up, it will attempt to reach the high of prior failed bull signal bars. Today may not look like a trend day, but as can be seen on the thumbnail of the daily chart, today is bar 1 in figure 3.9 it is, and it is made of a series of trending small trading ranges. These days frequently reverse in the final couple of hours and retrace at least the final trading range. This is another trending trading range day with the first trading range beginning yesterday. The thumbnail of the daily chart shows it is a bear trend day, bar 1 in figure 3.10. The first hour in figure 3.11 was contained in a 7-point range, but the average range lately has been about 20 points. Traders were aware that the market could break out and run. Once the market broke out, it formed a higher range from bars 4 to 6. It broke out to a third range, from bars 9 to 8. When it broke out again, it failed at bar 10 and retraced through the bottom of the third range and ultimately to the bottom of the second range. The implication in the word range is that the market will test the low of the range at some point, although it could continue trading up. When a market retraces a strong move, the first target is always the earlier countertrend entry points. Here, the closest bear entry point after the market broke out of the top range was the low of the closest bear signal bar, bar 6. The market broke out of the top range and then broke into the next lower range and took out that bear signal bar low on bar 13. The market gave a breakout pullback short entry after bar 11 and another after bar 12. By the close, the market had tested the low of the bar 3 lowest bear signal bar in the second range. Although the day opened on its high and closed on its low in figure 3.12, and arguably is a trend from the open bear, there was too much sideways action during the first 2 hours for this to trade like one. A trend from the open trend day doesn't have tradable countertrend swings, but a trending trading range does and is a weaker, less predictable type of trend day. The initial trading range broke down into a lower range on bar 4, creating a trending trading range day. Bar 9 tested back up into the earlier range, and bar 11 tried again to rally, but failed. Bar 12 broke down into a third range, which did not have time to test up to the bar 13 top of the range. Incidentally, bar 15 was a failed high too, a failed second attempt to reverse the breakout below bar 7, which is a very high probability short setup. The market made 2 attempts to reverse the new low of the day, and the second one failed on the bar after the bar 15 long. Tight channels and spike and channel bull or bear. Sometimes the market trends in a tight channel with basically a trend line that is parallel to the trend channel line, and they are close together, forming a tight channel. There will often be frequent pullback bars, trapping countertrend traders who are entering before there has been a trendline break. They see the trend as weak, since there are few strong trend bars, lots of overlapping bars with relatively big tails and frequent pullback bars. All of these are signs of weakness, except for one thing. The market is relentlessly moving slowly and very far in one direction without breaking a trend line. This is a very strong trend, even though the bars look weak. When it starts after a climax spike at the end of the prior trend, there is usually a small spike in the direction of this new trend, creating a spike and channel trend. Sometimes the spike is so small that it is non-existent on the 5-minute chart, and the trend channel just develops after a climax in the prior trend. Whether or not there is a clear spike at the start, if you do not get in at the start, these trends are very difficult to enter later because there are no easy pullbacks and the trend looks weak. Unfortunately, they are often difficult to recognize until they are well underway and therefore are usually difficult to trade. Do not worry about failing to recognize the pattern until it has progressed for a couple hours. Just take the with-trend trades that you see from this point onward and simply accept the reality that some days are harder to read than others. Easier patterns will soon develop, so be patient and don't force yourself to take unclear trades in the meantime. Some days have an early strong momentum move, a spike, and then the move continues in a less steep channel for the rest of the day. Usually the start of the channel is tested within a day or two, and the result can be a trading range or a trend in either direction. The important thing to realize is that the channel is tradable only in the with-trend direction because the channel is so tight that the pullbacks will not go far enough for a countertrend trade to be profitable. You should be prepared to look for entries in the countertrend direction after there is a breakout from the channel, since there is a good chance that the countertrend move will extend all the way back to test the start of the channel. Also, once you recognize the pattern, do not take countertrend high/low 2 entries, because invariably, there will have been no prior trendline break, and the tightness of the channel makes countertrend trading a losing strategy. Their failures are great with trend setups. After the strong rally was followed by a major bull trendline break at bar 2 in figure 3.13, the market tested the bull extreme with a 3-push move that created a double top at bar 3. A protracted at least an hour pullback of at least 2 legs should begin, and the market could reverse into a bear trend, which it did. Price action traders would only be looking for shorts until there is a break of the bear trend line followed by a clear buy setup, such as a strong bull reversal bar. The bear trend down from bar 3 was in several tight trend channels, all of which would have been difficult emotionally to short. In the absence of a climactic top, bulls will be looking at the move as a bull pullback. They will start losing patience, and they will buy Fibonacci pullbacks, oversold oscillators, divergences, and EMA pullbacks on all time frames, even in the absence of a break of the bear trend line and a strong bull reversal bar. Price action traders will view the absence of a good bull pullback setup as a sign that the market had reversed into a bear, and they will short all low 1 and 2 setups. At bar 8, the bulls finally capitulated, and the market collapsed below the bear trend channel line. The March 28 bear spike and channel day in figure 3.14 began with a spike up that reversed into a spike down to bar 3, where it attempted to form a double bottom bull flag. From there, it drifted down in a tight channel all day, with several good short entries near the EMA. The market broke above the channel on the next day, and since the start of the channel usually gets tested, don't continue to only trade the short side after the reversal, because there now should be good long entries, as well as the market works its way back to the top of the channel at bar 4, which it reached on the bar 7 gap-up opening. IBM had several spike and channel days in figure 3.15, and since the start of the channel often gets tested within a day or two, make sure to consider countertrend setups on the next day. Each of the channel beginnings was tested bars 2, 5, and 8, except the last one, bar 12. Bar 13 tried to begin the sell-off to test bar 12, but instead it quickly failed and reversed up strongly. Sometimes a gap can be the spike, forming a gap spike and channel day. The bar 2 in figure 3.16 start of the channel was tested on the next day, bar 4. The bull flag from bars 1 and 2 that led to the channel breakout functions like a failed final flag, but with a protracted breakout. Sometimes the failure leads to a major trend reversal. Stairs, broad channel trend. When a market has a series OF3 or more trending swings that resembles a mildly sloping trading range or channel, both the bulls and bears are active, but one side is exerting somewhat more control. Two-way trading is taking place, so traders can look for entries in both directions. If the breakouts get smaller and smaller, then this is a shrinking stairs pattern and indicates waning momentum. It often leads to a two-legged reversal and a trend line break. Many three-push reversals qualify as stairs or shrinking stairs trends that failed and reversed. Many others are wedge-shaped instead of channel-shaped. Alternatively, one stair might suddenly accelerate and break out of the trend channel in the with-trend direction. If it then reverses, this overshoot and reversal will likely result at least a two-legged move. If it does not, the breakout will probably continue for at least a couple of more legs, or at least the approximate height of the channel in an approximately measured move. The distance beyond the channel should be about the same as the distance within the channel. Bar 7, in figure 3.17, was the third pushdown and a shrinking stair. It extended less below bar 5 than bar 5 extended below bar 3. The channel lines are just approximate and drawn to highlight that the market is trending down and in a channel. There is clearly two-sided trading, and traders should be buying the lows and selling the highs when they see appropriate setups. By bar 7, in figure 3.18, the Eurust Forks chart had 3 higher highs and lows in a channel, and therefore formed a stair-type bull trend. Bar 8 was a bull trend bar that broke out of the top of the channel, and it was followed by a bear reversal bar that never triggered a short. The breakout should extend to about a measured move up to a parallel line that is about the same distance from the middle line as the middle line is from the bottom line, an Andrews pitchfork move, which it did. This is a bull trend stairs pattern in figure 3.19 with 3 or more trending higher highs and lows contained in a roughly drawn channel. Bars 4, 6, and 8 formed shrinking stairs, representing waning bullish momentum and presaging the reversal. After the bar 9 breakout, there was a lower high breakout pullback to bar 10 that resulted in a stair bear trend. Bar 10 was a rough double top bear flag with the high of the first pull back in the move down to bar 9. Bar 11 overshot the bear channel to the downside and led to a small two-legged reversal up. Chapter 4, Pullbacks. In the strictest sense, a pullback is a bar that moves against the trend enough to take out the prior bar's extreme. In a bull, a pullback is a move where a bar extends at least one tick below the low of the prior bar. However, a broader definition is more useful, and any pause, including an inside bar or an opposite trend bar in a trend's momentum, should be considered to be a pullback, even though there may only be sideways action and not an actual move backwards. Since a pullback itself is a trend, even though it is usually small compared to the larger trend from which it is pulling back, like all trends, it will commonly have at least two legs. Sometimes the legs are visible only on a smaller time frame chart, and other times they are large and each leg breaks down into smaller legs, each of which also has two legs. Remember, the second leg is a second attempt to reverse the market, and if it fails in its second attempt, the market will likely do the opposite. The trend will resume. Any move that has two legs should be traded as if it is a pullback, even if it is with trend. Sometimes the final leg in a trend is a two-legged, with trend move to a higher high in a bull or a lower low in a bear. Two clear swings are generally referred to as an ABC correction, with the A and C legs being the two countertrend swings while the B leg is the small leg in between. For example, after a swing high and then a sell-off that falls through the bull trend line, if there is then a two-legged move to a new high, this should be looked at as a possible pullback in the new bear that broke the bull trend line, even though traditional chart interpretation says that the new high negates the bear and that you have to begin again looking for a bear reversal down. What qualifies as two legs? You can create a line chart based on closes and often clearly see a two-legged move. If you are using bar or candle charts, the easiest two-legged move to see is one in which there is a countertrend move, then a smaller with trend move, and then a second countertrend move, a textbook ABC pullback. However, oftentimes the two legs are only clearly visible on a smaller time frame chart and have to be inferred on the chart that you are viewing. Since it is easier to use a single chart for trading than to be checking multiple charts all day long, a trader has an advantage if he can see the two legs on the chart in front of him, if only by inference. In a bull market, when there is a series of bull trend bars, a bear trend bar can be assumed to be the first leg of a pullback, even if the low of the bar is above the low of the prior bar. If you examined a smaller time frame chart, a countertrend leg would likely be evident. If the next bar has a with trend close but a high below that of the bar that ended the bull swing, then this is the second leg. If there is then a bear bar or a bar with a low below the low of the prior bar, this will create the second leg down. The more that has to be inferred, the less reliable is the pattern, since fewer traders will see it or have confidence in it. Traders will likely commit less capital and be quicker to exit. Invariably, pullbacks are difficult entries because they so often follow what appears to be a climactic end to the trend, and many traders will have an altered mindset, expecting either that the trend has reversed or that the market has entered a trading range. However, one of the hallmarks of a strong trend is that it keeps forming reversals all day, and they all fail. The reversals trap with trend traders out and counter-trend traders in. They work as great with trend setups because they trap both sides, and then there are many traders who will be chasing the market in the direction of the trend. For example, in a bull, those trapped bears will scramble to get out, and the bulls who thought that the top was in now will chase the market up. If you bought that high too near the EMA, these traders will provide the fuel for the move to your profit target. There is an obvious point here. If the trend that is now pulling back ended in a climax like a trend channel line overshoot and reversal, or in any significant trend reversal pattern, the trend has changed, and you should not be looking to enter pullbacks in the old trend. It is over, at least for an hour or so, and maybe for the rest of the day. So after a strong rally, if there is a wedge top or a lower high after a break of the bull trend line, you should now be looking for shorts and not pullbacks in the old bull. First pullback sequence, bar, minor trend line, imag gap, major trend line. There are many types of pullbacks that can occur in a trend, some shallow and others deep, and they can be classified and ranked in terms of their extent. The first time any one of them appears is a first pullback for that type of pullback. Each subsequent pullback will be the first one of a larger variety, and each one will usually be followed by a test of the trend extreme, since strong trend moves usually have at least two legs. Each test is a second leg. Each type of first counter-trend move will therefore likely be followed by another leg in the trend. Most of the first pullbacks are minor and are still part of the larger trend's first leg. However, each pullback tends to be greater as the counter-trend traders become more willing to take positions, and the with-trend traders become quicker to take profits. At some point, the counter-trend traders will overwhelm the with-trend traders, and the trend will reverse. The first minor pullback in a strong trend is a 1 or 2 bar pullback, typically a high/low 1 entry, and it often is a micro trendline entry, which almost always is followed by a new extreme. Next pullback might be 3 to 5 bars long and will likely break a minor trend line and then be followed by another new extreme. It is often a high/low 2 setup, but can be another high/low 1 in a strong trend. If the market went from 1 or 2 high/low 1 entries, and then a high/low 2 entry, and it appeared to be setting up another high/low 1, it is wise to wait. After a series of winning trades, you should be suspicious of renewed strength without first seeing a larger pullback, since this strength might be a trap setting up like a failed final flag. It is better to wait for more price action and miss a possible trap than to feel invincible and fearless because you fooled yourself into believing that you are playing with someone else's money. If you trade, it will likely become someone else's money. If the trend is strong, it might stay away from the EMA for 2 hours or more, but once it hits the EMA, it will likely form another with trend setup that will lead to another new extreme, or at least a test of the old extreme. At some point, there will be a pullback that not only goes beyond the EMA, but it will likely have an EMA gap bar and be followed by a test of the extreme and likely a new extreme. Eventually, there will be a countertrend move that will break a major trend line often. It is the pullback with the EMA gap bar and will be followed by a test of the extreme, which may undershoot higher low in a bear or lower high in a bull, or overshoot lower low in a bear or a higher high in a bull, the old extreme, and then be followed by at least a two-legged countertrend move, if not a trend reversal. Each pullback prior to the reversal is a with trend entry, because each is a first pullback of one type or another: bar, minor trend line, EMA gap, major trend line. And any type of first pullback is usually followed by at least a test of the extreme and usually a new extreme until after the major trend line is broken. Although it is not worth the effort to pay attention to higher time frame charts when trading on a 5-minute chart, it is likely that the larger 5-minute pullbacks end at 15, 30, or 60-minute, or even daily, weekly, or monthly chart points of significance like EMAs, breakout points, and trend lines. Also, there is often a tendency for the first pullback to the 5-minute EMA to be followed by a test of the trend extreme, and then a pullback to the 30 or 60-minute EMA, which be followed by another test of the extreme. With higher time frame points of significance occurring relatively infrequently, spending time looking for tests of those points will be a distraction and cause traders to miss too many 5-minute signals. If a trend is strong and you have made several profitable trades, but now there are several sideways bars, be cautious about further entries, because this is effectively a trading range and it could become a failed final flag. In a bull, you can buy if there is a setup near the low of the range, but be careful buying a breakout of the high of the trading range because bears might be willing to sell a new high and bulls might be beginning to take profits at the high. The same is true in a bear flag after a protracted down move. Sideways bars means that both buyers and sellers are active, and you do not want to be shorting on a breakout of the low of the flag that could become a bear trap, a failed final flag. However, if there is a short setup near the top of the flag, your risk is small and the trade is worthwhile. In a trend, there will always be pullbacks, and they tend to get larger as the trend progresses. However, until there is a reversal, each pullback should be followed by at least a test of the prior extreme here. In a bear, the prior low of the day, and the test will usually create a new extreme. Bar 3 in Figure 4.1 was a short after a 2-bar pullback, which was the first pullback in the bear that started on the reversal down from above yesterday's high. It was a breakout pullback, following the breakout below yesterday's swing low. Bar 4 was the first break of a trend line in the EMA, albeit by only a tick or so, and this low too was followed by a new low. Bar 5 was the second test of the EMA, and this time there were 2 closes above the EMA, but barely, and the pullback was followed by a new low. Bar 8 broke a major trend line and formed the first EMA gap bar, a bar with a low above the EMA. The first gap bar is usually followed by a test of the low, but sometimes there is a second entry. The break of a major trend line might be the first leg of a new trend, but will usually be followed by a test of the low that can overshoot or undershoot before a counter-trend move of at least 2 legs unfolds here. In a bear, a rally. The market formed a double bottom bull flag at bars 7 and 9, Bar 9 dipped one tick below bar 7, running stops, but it was not able to put in a new low. The bulls were defending their longs and were aggressively buying the dip's accumulation. The second leg up was completed the next day. Although the bottom was at bar 1 in figure 4.2, the first strong bull surge began at bar 3. There were several pullbacks to the 20-bar EMA that led to new highs on the move up from bar 3. Bar 4 was a trend channel line overshoot that led to a sharp correction to bar 5, which tested the 15-minute 20-bar EMA dashed line, and was then followed by a test of the trend high. Bar 6 was a higher high. The market gapped down to bar 7, and although the market initially appeared bearish, the move down was the first pullback to the 60-minute 20-bar EMA dashed line, and it was followed by the bar 8 new high. Double top bear flags and double bottom bull flags. After a strong move of one or more legs, and even after the first leg if the leg is strong, the market often goes sideways for a number of bars before the trend resumes. The sideways move can last for hours and have large swings, and it often begins and ends with spikes that have extremes that are very close in price. The second spike can slightly overshoot or undershoot the first one. The first spike acts as a magnet, pulling the market back to see if it is strong enough to prevent running the stops that are beyond the first spike. If it is, it becomes an excellent with trend entry setup. In a bull trend, the two pullbacks form a double bottom bull flag. For example, in a double bottom bull flag, the first bottom found buyers. When the market comes back to that same price area and the buyers again overwhelm the sellers, the market has twice failed to go down and will therefore likely go up. In a bear, they form a double top bear flag. These patterns are similar to the deep pullback to the start of the channel after a spike and channel trend, and that pullback often becomes a double top / bottom flag. Also, a head and shoulders continuation pattern is another variation. These patterns are also frequently a right shoulder of a head and shoulders reversal pattern. Traders know that if that right shoulder fails, instead of a reversal like a higher low in a new bull or a lower high in a new bear, the pattern becomes a continuation pattern. Therefore, traders will defend their entry often to the exact tick. More commonly, the test slightly overshoots or undershoots, making the double top or bottom less than perfect but still effective. If it holds, consensus forms and the market will usually run. A with trend bull flag sets up a long entry on a buy stop order at one tick above the high of the second bottom bar, and the initial protective stop is one tick below the low of that signal bar. After the entry bar closes, the stop is moved to one tick below the entry bar. Although double tops and double bottoms are well-known reversal patterns, these flags are with trend setups. By ending the pullback, they are reversing it, but it is better to think of them as with trend patterns. The double top bear flag at bar 2 in figure 4.3 failed and resulted in a tradable long, and became a small head and shoulders bottom. GS formed a double bottom bull flag with bars 5 and 7 in figure 4.4, even though there was a higher high in between. Bar 5 was the last higher low of the bull, and bar 7 was possibly the first swing low of a bear or trading range. In this situation, the market can form a head and shoulders top if bar 6 is not exceeded by the rally off bar 7. In any case, a double bottom bull flag is a reliable setup for at least a scalp. Also, since most head and shoulders tops, like all tops, turn into failures and become continuation patterns, it is always wise to keep buying in a bull. In a trend, most reversal patterns fail and most continuation patterns succeed. There was also a small double bottom bull flag after the bar 3 low formed by the 3rd and 7th bars that followed bar 3. Bars 2 and 3 and bars 5 and 6 in figure 4.5 formed double bottom bull flags. Both bars 3 and 6 slightly undershot their first legs, but patterns are rarely perfect. When the double bottom forms right near the trend low, as it did with bars 2 and 3, the pattern is often a small spike and trading range bull reversal if the spike down was climactic enough. The bar 1 spike down is close enough for this to also be considered to be a spike and trading range bull reversal, but that is not important since the small double bottom bull flag is reason enough to go long. Many patterns resemble one another and often coexist. All you need to do is recognize one of the patterns because by itself, it is a valid entry. Also, whenever a pattern resembles another pattern, the two of them will usually unfold in a similar way. Bars 3 and 4 in figure 4.6 formed a small double bottom bull flag after the sharp move up to bar 2. It is also arguably a spike and bull trading range by setup, but it is a little too high above the bar 1 low, so the market has likely already been recognized as a new bull, and a reversal up at this point adds little. Traders already believe that the market has reversed to at least 2 legs up. After the sell-off to bar 6, the bar 2 high could turn into a left shoulder of the head and shoulders bear flag. If bar 8 tests the bar 6 low and is followed by a rally above bar 7, the market will likely rally to test at least the bar 5 high, as is typical when a head and shoulders pattern fails. If bar 8 becomes a swing low that is above bar 6, then it would be a long setup for a double bottom pullback. On the other hand, if the market drops below the bars 3, 4, and 6 lows, it will form a head and shoulders bear flag, and then the first target is the obvious magnet at the bar 1 climactic low. Although a trader could short on the breakout below bar 6, it is less risky to short a breakout pullback. The pullback can come before or after the actual breakout. If the market almost breaks out and then forms a pullback, it will likely behave as if the breakout had in fact occurred. Close is usually good enough. Since the market has been in a downtrend since November 2007, and there should be a second down leg after such a protracted move, the odds favor a downside breakout with a move below the bar 1 low. The trading range from bars 2 through 7 may end up being the middle of a measured move down, which would project to around 100, or a loss of 60% from the high. That is not a prediction. Instead, it is just an academic observation of what could result from this pattern. Bar 4 in figure 4.7 attempted to form a double bottom bull flag with the bar before bar 3, and bars 5 and 6 also tried to complete the base. Often the market breaks below the first bottom by a tick or so, trapping bulls out and bears in, as was the case at bar 5. However, the market cannot fall below that low by even a tick, or traders will start to assume that the bears are taking control. Bar 6 was an exact test of the bar 5 false breakout of the bar 4 low, and it led to the bar 7 breakout of the top of the range. Once the market took out the bar 6 low at bar 8, the die was cast. A false breakout of the low bar 6, followed by a false breakout of the high bar 7, confirmed by the bar 8 breakout of the low again, made the smart shorts feel pretty good at this point. They would have shorted below the bear inside bar that followed the bar 7 failed breakout. They would exit at break-even on the small rally after bar 8, but then would have taken the second entry short of the lower high at bar 9, and then rode the market all the way down. A failed double bottom bull flag can have one small breakout of the bottom, as at bar 5, but that low must hold or else the bulls will stop buying and the bears will become aggressive. EMA and gap EMA pullbacks. A gap is a general term that simply means that there is a space between 2 points on the chart. For example, if today's open is above yesterday's close, there is a gap. If the open is above yesterday's high, there will be a gap on the daily chart. A broader use of the term opens up other trading opportunities. For example, if the high of a bar is below the EMA, then there is a gap between that bar and the EMA. In a bull market or sideways market, there is a good chance that the market will move to fill that gap above the bar that is below the EMA. Sometimes a bar will go above the high of the previous bar, but then within a bar or two, the pullback continues down again. If the market again goes above the high of a prior bar, this is an EMA gap 2 bar or a second attempt to fill an EMA gap in a bull, and the odds are excellent that there will be a tradable rally off this setup. Likewise, gaps above the EMA will tend to get filled in a bear or sideways market. Bar 2 in figure 4.8 was a second attempt to fill the gap below the EMA in a sideways market. The down momentum was strong, which arguably means that the market is not sideways today, but the EMA was basically flat because of yesterday's strong close. Bars 3 and 8 were also second attempts. The first attempt can be simply a bull trend bar, or EMA gap 2 bar entries. Bars 6 and 9 were EMA gap 2 bar shorts. Once the market broke above bar 9, there was then a bull trend because 2 attempts to go down failed. Bar 9 was a EMA gap 2 bar, which means that it was a second attempt. 2HM, if away from EMA for 2 or more hours, then fade EMA and first EMA gap bar. When the market stays on one side of the EMA without touching it for 2 hours or more, the trend is strong. but it may also be a sign of an overdone market that will soon reverse. The first touch is a high probability scalp for a test of the trend's extreme, but wait for a price action entry in case the market goes well beyond the EMA. There is nothing magical about 2 hours. It is just a guideline that is useful to remind you that a trend is strong. A trend can be extremely strong and still touch the EMA every 30 minutes, and a trend can be away from the EMA for 4 hours only to suddenly reverse into an opposite trend. Also, the 2 hours can be at any time during the day, not necessarily the first 2 hours. Once you become aware that a 2HM is present, look to fade all touches of the EMA, but wait for a setup off the EMA and enter on a stop. After one or more EMA tests, there will likely be a test that goes through the EMA and forms an EMA gap bar. Look to fade the first gap bar in a bull, buy one tick above the high of the first bar where the high is below the EMA, especially if there is a second entry. Since you are trading with trend, you should swing part of your position because the market may run much further than you thought possible. EMA tests are particularly reliable in stocks and often provide great entries all day long. Each EMA test tends to have more penetration of the EMA than the prior one, and at some point one will likely break a major trend line. Once that happens, the correction will probably have at least a second leg. For example, in a bear, the pullback after the trend line break usually forms a higher low and then runs above the high of the first leg. Market did not test the EMA until 9:10 a.m. PST on the rally after the bar 3 low. Bar 2, in figure 4.9, missed the EMA by 1 tick, but it was a good enough test to take the low too short there. Always look for a with trend entry for a test of the extreme. Bar 4 was an EMA gap bar and a failed Roman 2 breakout, and a short entry there yielded a scalper's profit but not a new low. Because the rally to bar 4 broke a minor trend line from the bar 2 top to the bar 3 bottom, and only barely broke the major trend line from bars 1 and 2 before reversing, the countertrend momentum was not impressive, despite the string of small bull trend bars in the rally to bar 4. Bar 5 tried to form a higher low and a new bull after the trendline break, but the rally failed. Some longs covered on the bar 7 move to below bar 5, but there was good buying, forming the bar 7 reversal bar. The high 2 long above bar 7, the high 1 was above bar 5 in this larger two-legged possible bull pullback, failed at the bar 8 breakout pullback, and the market finally sank to a new low. The stop run below the bar 7 low resulted in a bear trend bar as the second chance longs were forced to sell out. Despite the bear strength in the first half of the day, the bulls broke several bear trend lines and were finally able to move the market up after the stop run plunged down to bar 11 that formed a double bottom and a failed final flag reversal. This was basically a bear trending trading range day, which often will rally above the final trading range by the end of the day, since trading ranges indicate two-sided trading, and the day would therefore be unlikely to close on its extreme. RIM did not touch the EMA in figure 4.10 until 3.5 hours into the day at bar 5 on a 3 bear trend bar plunge. However, the 20 or so bull trend bars in the rally from bars 1 to 2 with only one pullback bar is unusual behavior, and unusual behavior is not sustainable and therefore a form of a climax. It had a parabolic shape, and there was a failed trend channel line breakout at bar 2. The line is not shown, but there were a couple ways to draw one. After a climactic move, traders should not look to enter with trend on an EMA pullback unless the pullback has been long at least an hour or so, and the setup is strong. The tight trading range between bars 5 and 7 is not a place to look for entries in either direction, and could be the middle of the bear pullback, as is often the case after a climax where a two-legged correction should be expected. Could also be the start of a bear channel after the spike down to bar 5, a spike and channel top reversal, although the high at bar 4 was not as climactic as is typical in spike and channel reversals. You need to wait for a breakout of the tight trading range where the breakout is by one or more strong trend bars, and then look to enter on a failed breakout or a breakout pullback. It is best to look to trade other stocks after a climax devolves into a tight trading range because the risk-reward ratio is poor. Trend day 11:30 stop run pullback to trap you out. Very commonly on strong trend days, there will be a strong counter-trend panic move that will scare people out of their positions. and this normally happens between 1100 and 11:30 a.m. PST, although it can come earlier or later. Once it is clear that you were fooled by a strong counter-trend move, the trend will have gone a long way back towards its old extreme, and you and the other greedy traders who were trapped out will chase it, making it go further. What causes the move? Institutions benefit from the spike because it allows them to add on at much better prices, expecting the trend to resume into the close. If you were an institutional trader who wanted to load up going into the close, and you wanted to enter at much better prices, and you know that if stops could be run on some rumor, you would be looking to contribute to any rumor in any way that you could. It doesn't matter what the rumor or news item is or whether some institution spread it to make some money. All that matters is that the stop run gives traders an opportunity to piggyback on the institutions and make a profit off the failed trend reversal. Here are two 2HM days in figure 4.11, both with late stop runs. R5 is the entry after the 11:25 PST stop run, and it is also a gap too long. Notice how strong the bear trend bar was with a large body and a close near its low. This will make all weak hands think that the market has turned into a bear. Smart traders will look at this as the great buying opportunity that it is. Bar 10 is a 12:15 PST stop run short that is also an EMA gap entry. On both days, the EMA gap fades developed after 2 or more tests of the EMA, which is to be expected. After the countertrend traders were able to bring the market back to the EMA multiple times, they developed the confidence to press their bets, resulting in a break well beyond the EMA. However, the first such break usually fails, providing a great fade for the expected trend resumption. On a bear trend from the open day followed by an inability to get above the EMA, traders were expecting an 11:30 a.m. PST trap, and it occurred today exactly on time. Bar 3 in figure 4.12 was also the first EMA gap bar in a bear. Usually the trap is a strong countertrend leg, getting hopeful longs to buy aggressively only to get forced into liquidation as the market quickly reverses back down. Today, however, the rally from bar 2 was composed of large dojis and had a barbed wire look, indicating that traders were nervous in both directions. If there was no conviction, then how could traders get trapped? Well, the bar before bar 3 attempted to form a double top bear flag, and bar 3 spoiled it by going above the bar 1 high. This made many traders give up on the bear case, forcing the shorts to liquidate. So it was not so much trapping the bulls into the trade as it was trapping the bears out, but it is still a trap, and therefore there still was fuel for the short side. Those shorts all wanted back in, and they helped push the market down. The weakness of the down leg from bar 3 is consistent with the weakness of the up leg from bar 2, but the result was as expected. A close on the low of the day. This was a bear trend resumption day, but since the resumption started so late, it resulted in a smaller leg than the sell-off at the open. Counting the legs of a trend, trends often have 2 legs. If the momentum on the first leg countertrend, since the new trend is not yet confirmed after the reversal is strong. Both the bulls and bears will wonder if it will be the first of possibly many legs, creating a new trend. Because of this, both bulls and bears will expect that a test of the old trend's extreme will fail, and with the old trend traders will be quick to exit. For example, if there is a strong move up after a protracted bear and the up move goes above the EMA and above the last lower high of the bear, and there were many bull trend bars in this up move, both bulls and bears will assume that there will be a test of the low that will hold above the bear low. Once the momentum of this first up leg wanes, bulls will take partial or full profits, and bears will short, just in case the bears are able to maintain control of the market. The bears are not certain if their trend is over and will be willing to initiate new short positions. The market will work down since buyers will be reluctant to buy until there is more bullish price action. As bulls come back in on the pullback that is testing the low, the new bears will be quick to exit because they don't want to take a loss on the trade. The buying by the bears covering their shorts will add to the upward pressure. The market will then form a higher low. The bears will not consider shorting again unless this leg falters near the top of the first up leg, a possible double top bear flag. If it does, the new bulls will be quick to exit because they won't want a loss, and the bears will become more aggressive since they will sense that this second leg up has failed. Eventually, one side will win out. However, this kind of trading goes on all day long in all markets and creates a lot of two-legged moves. The bear from the open down to bar 6 occurred in 2 legs, and the second leg subdivided into 2 smaller legs. The move up to bar 9 was also in 2 legs, as was the move down to bar 12 in figure 4.13. Bar 12 was a perfect breakout test of the start of the bull move. Its low exactly equaled the high of the bar 6 signal bar, running the break-even stops of the bar 6 longs by 1 tick. Whenever there is a perfect or near-perfect breakout test, the odds are very high that the market will make an approximate measured move. Expect the move up from the bar 12 low to be equal in points to the move from bars 6 to 9. There was a 2-legged move up to bar 15, but when its high was surpassed, the market ran up quickly in a bull trend bar as the new shorts had to buy back their positions from the failed low 2 off the bar 15 short setup. Bar 9 formed a double top bear flag with bar 3, and its failure on the rally up from bar 16 also contributed to the bull breakout. The day was also a head and shoulders bottom. As with all patterns, they do not have to be exact. Bars 1 and 4 in figure 4.14 formed a common double bottom bull flag. The bar 4 low was 1 penny higher. These flags are often seen in the first pullback of a trend day. Bars 3 and 5 formed a double top, but its high was exceeded 3 bars later, creating a failure. There was a breakout pullback at bar 7 that led to a large up move. There were several 2 and 3 bar double bottoms and tops, bars 2, 7, 8, and 11. Bars 12 and 13 formed what is effectively a double top, but it doesn't matter what you call it. What matters is that you short it. Bar 13 was a slightly higher high after the breaking of a small bull trend line up from bar 11. Also, it was a second entry after bar 12 reversed down following an overshoot of the trend channel line drawn across the bar 9 high. The channel was a parallel of the bull trend line between bars 6 and 10. This is also a spike and channel bull day and a trend from the open bull. Opal is a well-behaved stock on the 5-minute chart. It formed a common double top bear flag at bar 2, 1 cent below the high of bar 1 in figure 4.15, and more than met the approximate target of twice the height of the trading range. R2 was also the top of a 2-legged move up to the EMA in a bear, forming a bear M2S, a low 2 at the EMA, or a moving average short second entry. Trends in many stocks are very respectful of the EMA, which means that the EMA provides opportunities all day long to enter in the direction of the trend with limited risk. 4 bars after bar 2, there was a double top pullback short. High/low 123 and 4. A reliable sign that a pullback in a bull or in a trading range has ended is when the current bar's high extends at least 1 tick above the high of the prior bar. This leads to a useful concept of counting the number of attempts that this occurs. In a sideways or downward move in a bull trend or a trading range, the first bar whose high is above the high of the prior bar is a high one, and this ends the first leg of the sideways or down move, although this leg may become a small leg in a larger pullback. If the market does not turn into a bull swing and instead continues sideways or down, label the next occurrence of a bar with a high above the high of the prior bar as a high 2, ending the second leg. There needs to be at least a tiny trendline break between the high 1 and the high 2 to indicate that the trend traders are still active. Without this, do not yet look to buy since the high 1 and high 2 are more likely to be just part of the same first leg down. In a strong upswing, the high 2 entry can be higher than that of the high 1, and in a strong downswing, a low 2 entry can be lower than that of the low 1. Some pullbacks can continue to form a high 3 or a high 4. Beyond a high 4, it is likely that the market is no longer pulling back in a bull move and instead is in a bear swing. Wait for more price action to unfold before placing a trade. When a bear trend or a sideways market is correcting sideways or up, the first bar with a low below the low of the prior bar is a low 1, ending the first leg of the correction, which can be as short as that single bar. Subsequent occurrences are called low 2, low 3, and low 4. If the low 4 fails, a bar extends above the high of the low 4. The price action indicates that the bears have lost control and either the market will become two-sided, with bulls and bears alternating control, or the bulls will gain control. In any case, the bears can best demonstrate that they have regained control by breaking a bull trend line with strong momentum. As you are counting these pullbacks, you will often see the market continue its correction instead of reversing, in which case you have to change your perspective. If you think that you are in a trading range with simply a strong new high and then see a low 2 above the old high, a sell setup. But instead of falling, the market continues up, you should begin to look for high 1 and 2 entries. It is likely that the bull strength is sufficient for you to be only trading longs. You should defer looking for low 1 and 2 shorts until the bears demonstrate enough strength to make a tradable down move likely, like a trendline break, followed by a failed test of the swing high. Notice that in a sideways price action, it is common to see a high 1, high 2, low 1, and low 2 all present in the course of 10 bars or so, even though a high 2 is bullish and a low 2 is bearish. Since the market is sideways, neither the bulls nor the bears are controlling the price action for more than a brief period, so it makes sense that each will try to wrest control, and as each tries to assert itself, bull or bear patterns will form. There are variations on this numbering, but the goal is still to help spot two-legged corrections. For example, in a strong bull, a two-legged pullback can form and have just a high 1, but functionally be a two-legged pullback. If there is a bear close or 2, this can represent the first leg down even if the next bar does not extend above the high of the bear bar. If that next bar has a bull close, but its high is still below the trend high, it then becomes the end of the first down leg if the next bar or so is again a bear trend bar. If the next bar extends below its low, look for a bar within the next few bars that extends above the high of its prior bar, ending the two legs down. View each bar as a potential signal bar and place a buy stop at 1 tick above its high. Once filled, you now have a variant of a high 2. This entry bar is strictly speaking just a high 1, but treat it as a high 2. That bear bar at the start of the pullback was followed by a bar with a bull close. On a smaller time frame, this was almost certainly a small down leg followed by an up leg that became a lower high, and then finally another push down to where the high 2 ended the second leg. There is also a variation for a failed high/low 4. If the signal bar for the high 4 or low 4 is particularly small, especially if it is a doji, sometimes the entry bar will quickly reverse into an outside bar, running the protective stops of the traders who just entered. When the signal bar is small, it is often best to place your protective stop at more than 1 tick beyond the signal bar, maybe 3 ticks, but no more than a total of 8 ticks from your entry in the E-mini, to avoid a whipsaw, and still treat the pattern as valid even though technically it failed, albeit by only a tick or so. Remember, everything is subjective, and a trader is always looking for something close to perfect, never expecting perfection because perfection is rare. Finally, complex corrections on the 5-minute chart often appear as simple high/low 1 or 2 corrections on higher timeframe charts. It is not worth looking at the higher timeframe charts since the trades are evident on the 5-minute, and you risk distracting yourself looking for rare signals and missing too many 5-minute signals. The most reliable high 1 and low 1 entries occur when there is a false breakout of a micro trend line, because micro trend lines are only present in the strongest segments of trends. The 1 or 2 bar false breakout that creates the high 1 pullback in a bull or low 1 pullback in a bear is a high probability with trend scalp. The other time when you need to take these entries is when there is a strong move well beyond the EMA and then a high 1 pullback in a bull or a low 1 pullback in a bear to the EMA, even without a micro trend line being present. Trends have trending highs and lows. In a bull, each low is usually above the prior low, a higher low, and each high gets higher, a higher high, and in bear trends, there are lower highs and lower lows. In general, the terms higher high and higher low are reserved for situations in which a bull trend appears to be in place or in the process of developing, and a lower low and a lower high imply that a bear might be in effect. These terms imply that there will have been at least a minor trendline break, so you are considering buying a higher low in a bull, a pullback, or a bear countertrend but maybe a reversal, and selling a lower high in a bull or a bear. When trading countertrend, you should scalp most or all of your position unless the reversal is strong. In Figure 4.16, a high 1 high occurs in a down or sideways leg of a bull move, and it is the first bar with a high above that of the prior bar. If there is then a high that is lower than the prior bar, the next occurrence of a higher high is a high 2. A high 3 is the third occurrence and a high 4 is the fourth. Counting beyond 4 does not offer reliable trades since it is likely that the pullback has extended far enough to be considered a trend in the opposite direction. Likewise, a low 1 L1 occurs in a down or sideways market, and a low 2, 3, and 4 are comparable to their high 2, 3, and 4 counterparts. Although many are labeled when the market is clearly trending up, you should not be looking to sell most low 1 and low 2 setups. Sometimes, a high 2 and low 2 can occur in the same sideways market. There are many variations, but many of those meeting the basic definition are labeled on the chart. This difficult day to count but fairly easy to trade shows many subtleties to counting the legs of pullbacks. When the first leg is steep and its correction is only a couple of bars long to bar 2 in figure 4. 17 above, and then a high 2 forms again after only a bar or 2 here, bar 3. No significant trend line will be broken, so you should not be looking to buy a high 2. Bars 1 and 2 set up micro trendline shorts, which indicate strong bearish momentum. Even though there have been 2 attempts to go up, the first attempt was too weak. You always want a show of strength before your buy setup. Otherwise, assume that the market is still in its first leg down. If the bar after bar 3 went above the bar 3 high, it would still be a long entry, but the buy is always better if the rally after the first leg down, the high one, shows more strength. The market sometimes drops again and forms a high 3 after penetrating a trend channel line and reversing up. This is a wedge reversal, 3 legs, and a failed breakout of a trend channel line. This occurred at bar 4. Note that neither bar 2 nor bar 3 went above their prior bars, but they each effectively ended a small leg down. On a 1-minute chart, there was almost certainly a small corrective rally that formed these 5-minute bull trend bars. Bar 4 was the end of the bear wedge and set up a high 3 long on the next bar. Although you do not like to see your long entry bar tum into a bear trend bar, the stop below the entry bar was not hit. All counts gain more significance when they follow a break of a longer and stronger trend line. If no meaningful trend line is broken on the prior leg like bar 2, then the next leg's reversal will not have much conviction, bar 3, and you should wait for additional price action like the wedge bottom at bar 4. Bar 5 can be viewed as a low 1 or as a low 2, but when the chart is not clear, it doesn't matter what you call it because you must wait for a trendline break and clarity before shorting. Also, following a wedge bottom, you should not be looking to sell until the market has made 2 legs up here. The low 4 at bar 7 was as good as 2 legs up. Once the market went above bar 5, there was now a failed low 2, and this usually results in 2 more legs up. Bar 6, strictly speaking, is a low 2, but since there was no meaningful bull trendline break at the low 1, you would not be shorting it. However, you should be thinking of it as a low 3 and expecting 1 more leg up. You would need more price action, like a second entry at the EMA, which developed at bar 7. Bar 5 was just a huge doji and had no bearish conviction, so it does not represent an adequately strong low 1. In fact, it set up a failed low 2 with the long entry on the next bar. Bar 8 is a high 1, but again it occurred after a single small bar, so it does not have much predictive power and was a micro trendline short. Bar 10 is a EMA gap 2 bar, which is the second attempt to rally from below the EMA in a flat or up market. Space between the high of these bars and the EMA is the gap in question. The first attempt was the bull trend bar 9. Bar 4 earlier was also a EMA gap 2 bar buy. Bar 10 is also a clear high 2 in a flat market, which is usually a good buy. Bar 11 was a high 1 variant, a bull trend bar that did not extend above the prior bar. In these unclear cases, you need to see further price action before you know whether the bar will work as a high 1. Its higher low is constructive because it is a minor disruption of the downswing and therefore a sign of upward strength, although minimal. The leg down to bar 10 did not break any significant bear trend lines from bar 7 down to bar 10, so it had a lot of momentum. It is reasonable to assume that there will be a second leg down and a lower low, or at least a test of the bar 10 low. Bar 12 was a bull reversal bar in a quiet day, and it was the new low of the day, making it a high probability trade for at least a scalp. At this point, you would not be expecting more down movement until after a tradable rally, so you would now call bar 11 a high 1. Why bother? Because it makes a case for bar 12 being a high 2, which is a second entry and therefore more likely to lead to a profitable long. If there was no traditional high 1 or a high 1 variant here, a bull trend bar at bar 11, the long at bar 12 would be less certain, and you would likely scalp most or all of your contracts and then wait for more price action. However, under the scenario that unfolded, bar 12 was likely to have at least 2 legs up, so a trader would want to swing about half of her contracts. Also, bar 12 was the end of a measured move, approximately, in a larger two-legged pullback, with the first leg ending at bar 10, and the end of an even larger measured move from the high of the day with a first leg ending at bar 4. Finally, bar 12 was a reversal from a bear trend channel overshoot, not shown, but based a parallel drawn from the bar 7 high to the swing high that followed bar 10 and then dragged to the bar 10 low. Bar 14 was a low 2, ending the second leg up. It was also a double top bear flag. There was a strong move down on the open with a corrective move up ending on the bar before bar 7. Bar 14 is a test of that, creating a second failed attempt to run to the high of the day and a double top. On a trendless day and after a double top bear flag, you should look for 2 legs down. First leg ended with the bar 15 high 1, which was followed by 2 small legs up, ending with the bear M2S at bar 16. It is barbed wire, but the small bar at the high of the trading range is a good short. The second leg ended with the high 2 at bar 17, but bar 17 was a bear trend bar following a bear trend bar, following a first leg down to bar 15 that was very strong. It is still a valid buy, but the uncertainty as seen by the large tails resulted in a second chance entry at the bar 18 high 2. This second entry developed because enough traders were sufficiently uncomfortable with the first entry to make them wait for a second setup. It is also in Roman 2 variant based on bodies only. The low 2 at bar 19 was after strong upward momentum, but it is still a valid short. However, it resulted in a 5-tick failure at bar 20. Bar 20 extended above the high of the prior bar after the move down from bar 19 only reached 5 ticks, and therefore left many shorts still trapped without a scalper's profit. Bar 20 formed a failed low 2, which traps lots of shorts and is a great entry, especially when the up momentum has been good. When it occurs, it usually results in 2 legs up and often ends in a low 4. Because of this, buying the high 1 at bar 21 was a great trade. Everyone knew that the momentum was strong and there was going to be a second leg up. It is possible for this leg down to develop a second leg down with a low below the low of bar 21, forming a high 2 buy setup, but the odds were against it. There was simply too much strength. The bar counts are much more reliable if the legs are at least several bars long and break clear trend lines. For example, a bear low 4 is not a good short if it occurs in a rally that is an up-sloping tight trading range because there have been no clear trendline breaks. The 5-minute E-mini had 2 strong legs down in figure 4.18 that ended in a 1-tick false breakout at bar 1. The market drifted sideways and upward in a tight channel and finally broke the trendline from the open. After 2 legs down and a broken trendline, 2 legs up are likely. R5 is a low 4 short at the EMA. But this is not a strong short since the market has been largely sideways with lots of small dojis, and there will probably be a higher low, and there is not much room for the short to be profitable. However, if a trader relied on a protective stop above the signal bar, it would have resulted in a profitable scalp. Since a higher low and then a second leg up is likely, traders would be looking for a reason to buy. The market was in a tight channel down from bar 6, but then gave a high 4 buy after a test below the EMA. The high 1, 2, and 3 were bars 6, 7, and 8. The market then rallied into the close to form the second leg up. Trading when there is a tight trading range is not particularly good. There are constant pullback bars and too much overlap. The patterns act as a huge magnet, making it difficult for the market to go very far in either direction until there has been a failed breakout. Bar 9 set up a failed downside breakout. Anytime there is a trendline breakout, the chances are high that there will be a second leg, because everyone now is aware of the possibility of a higher low/lower high trend reversal. In general, avoid a with trend entry until after the second attempt fails. For example, after a strong break of a bear trend line, it is better to focus on buying a higher low than to look for short setups until after the higher low is setting up a failure. However, if there is a lot of room to the old low, you can look to short that strong first up move, especially if it ends with the first gap bar above the EMA in the bear. Whenever a high or low 2 develops and one or more of the bars touches the EMA, especially in a strong trend, it is called an M2B moving average, second entry, buy setup or entry, or an M2S moving average, second entry, sell setup or entry. It is worth distinguishing from other high/low 2 setups because it is particularly reliable. A two-legged pullback to the EMA in a trend is a great setup. Bars 5, 6, and 8 were M2S entries in figure 4.19. Bar 3 is a low 2, but none of the bars of the setup touched the EMA. Bars 2 and 4 were M2B setups. The bear bar 8 M2S was immediately followed by the bar 9 bull high 2, but not a good bull M2B since it was largely below the EMA. Although a high 2 and a low 2 are common reversal setups, they should never be traded unless the prior high 1 or low 1 broke a trend line. The break can occur from a countertrend move or a sideways move, and the more bars and more momentum in the leg, the more the countertrend strength, and the more likely that the high 2 or low 2 countertrend trade will be profitable. On the left in figure 4.20 is the 5-min E-mini, and on the right is the 5-min SDS, an ETF that is the inverse of the SBY, an ETF that is comparable to the E-mini, but twice the leverage. On the E-mini chart, there is a high 2 at bar 5 following a bull trendline break at bar 1, and then the higher high at bar 3 tested the old trend high. This could be a trend reversal. The down momentum is strong, and the high 1 at bar 4 was weak. It poked above the bull micro trend line from the bar 3 high and immediately reversed down, indicating that the bulls were weak. This was a much better low 1 short. It would be unwise to buy the high 2 at bar 5 unless it showed exceptional strength. For instance, if there were a strong bull reversal signal bar. Also, the signal bar was too large, forcing you to buy high in a weak market, and the signal bar was a doji bar that was almost entirely within the prior 2 bars. Both were bear trend bars. And there are 3 or more bars with a lot of overlap and 1 or more is a doji barb wire. It is best to wait for more price action before initiating a trade. The bulls and bears are in balance, and any breakout will likely fail like the high 2 buy signal at bar 5. And you certainly shouldn't be buying a breakout above its high, in particular in a bear leg, especially since most trading ranges are with trend and the prior leg was down. Whenever you are wondering if a signal is strong enough, it is helpful to study the chart from different perspectives, for instance, using a bar chart or an inverse chart. In general, just the fact that you feel that you need further study should tell you that it is not a clear and strong signal, and therefore you should not take the trade. Even if you were tempted to buy the high 2 on the E-mini chart, virtually no one would be looking to sell the bar 5 low 2 on the SDS chart on the right because the up momentum is so strong. Since these charts are essentially just the inverse of one another, if you would not buy on the SDS, you should not sell on the E-mini. Note that bar 7 on the E-mini was a high 4, which is usually a reliable buy signal. However, in the absence of any bullish strength in the high 1, 2, or 3, you cannot take the trade. A bar count alone is not sufficient. You need prior strength in the form of relatively strong move that broke at least a minor trend line. Notice that earlier there was a strong bull, and that low 2 shorts were bad trades until after the market broke the bull trend line. There was not a strong down surge, but the market went sideways for about 10 bars, indicating that the bears were strong enough to hold the bulls at bay for a protracted period. This show of strength by the bears was necessary for a trader to feel confident to short the failed final flag breakout to the bar 3 new high of the day. A failed low 2 often ends up as a low 4 short. Bar 2 was a failed low 2, so 2 more legs up were to be expected. In figure 4.21, a low 4 ended the bear rally, and another one ended the sell-off to the low of the day. It does not matter that the bar a high 1 occurred before the low 4 of the prior leg. Bar 1 was a micro trendline short that was good for a scalp. It reversed to a breakout pullback long on the next bar. The breakout above the micro trendline failed, but the failure only lasted a couple bars, and those bars became just a pullback from the break above the trendline. Variations of high/low 2 setups. The key to understanding the concept of high/low 2 setups is to remember its intent. The idea is that the market will tend to make 2 attempts at anything, and in its attempt to correct, it frequently will try twice to reverse the trend. If it fails twice, it will likely do the opposite. The trend will resume. The advantage of buying a high 2 pullback in a bull is that there is very little thought involved, and it is easy to do. The difficulty comes when a correction has 2 attempts but does not form a clear high or low 2. That is why it is necessary to look at variations. You can make money by trading 2-legged pullbacks, even when they don't offer a perfect high or low 2 setup. Most obvious 2-legged move has 2 clear swings with an opposite swing in between that breaks a minor trend line. The pullback usually forms a high 2 pullback in a bull or a low 2 in a bear, an ABC correction. However, there are less clear variations that provide just as reliable trades, so it is important to recognize these as well. Anytime that you see a correction where you can infer 2 legs, then you have found an acceptable pattern. However, the further from the ideal that it is, the less likely it will behave like the ideal. This uncertainty will make traders hesitant, and therefore the pattern will be more likely to fail. The bar 2 doji in figure 4.22 had a large tail on the top, which indicates that the market moved up and down within that bar. That up move was the end of the first leg down, and therefore bar 3 should act like a high 2, which it did. Since there is a new low of the day and a third push down on the day here, a shrinking stairs pattern which indicates waning bear strength. It was also a failed final flag reversal you were looking to buy despite the 3 bear trend bars. The implied high 2 at bar 3 is the final component that gives you confidence to enter without further price action, such as waiting for a second entry. Anytime that you can infer 2 legs, the market will likely behave as if there were 2 legs. Rs 3 and 4 in figure 4.23 create a 2-legged correction in a bull swing, even though the bar after bar 3 was the end of the up leg. Because it was a 2-legged correction, bar 4 is a high 2 long entry. The sideways pattern with 2 bear bars separated by a bull bar created the 2 legs. Bar 8 is a high L long because it followed a bear reversal bar that tried to end 2 legs up from the low of the day. There were trapped shorts who sold the low 2 at bar 6. Bar 10 is a high 2 long, bar 8 was the high 1 because it followed 2 attempts to sell off at the high of the day, bars 7 and 10. 2 attempts down is the same as a 2-legged correction, so it is a high 2 long setup. You could also look at it as high 1, but since the prior 6 bars were largely sideways, it is reasonable to look at it as part of one pattern, with bar 7 being the first leg down. Bar 12 is a high 2 long setup because it is a second leg down. The first leg was the doji inside bar just before it. All of this analysis is loose, but its objective is important. Traders need to see 2-legged corrections because they set up excellent with trend entries. This chart in figure 4.24 of the SPY demonstrates lots of variations in low 2 setups. But if you think about each one, each is the logical end of a 2-legged bear correction. Since the chart is clearly bearish, most of the bars are below the falling EMA. Traders are looking for opportunities to enter shorts, so anything that resembles a low 2 is good enough. Bar 3 is a low 1, and its high is taken out by bar 4, making bar 4 a second attempt up and a setup for the low 2 short that triggered on the next bar. Bar 6 was a low 1 setup, and 2 bars later there was a bull trend bar, indicating an up leg. Bar 7 was the signal bar for the short on the following bar, even though it was lower than the low 1. It was still a 2-legged correction. Bar 8 was a small bear trend bar inside bar in an upward correction, and it therefore constitutes a tiny correction, ending the first leg up. Bar 9 followed another bull trend bar, actually 2, so it is the second attempt down and effectively a low 2 short near the EMA. Bar 11 is lower than bar 10, so it is the start of the move up to bar 12. Why is the bar after the bar 12 top a low 2? The low of the bar 12 bull outside bar dipped below the prior bar just after bar 12 opened, although you cannot tell from this chart, but you can tell for certain by looking at a 1-minute chart, not shown. This makes bar 12 a low 1. An outside bar breaks out of both sides of its prior bar, and you do not know which side it broke through first, although the direction of its body is usually reliable. For example, a bull body usually indicates that the upside breakout occurred second, since its direction is up into its close. The bar after bar 12 broke below bar 12, so it was the second time in this leg up from bar 11 that a bar broke below the low of the prior bar and is therefore a low 2 short at the EMA and M2S. Bar 13 is a clear low 1. Once there was a second leg up, Bar 14 has a higher high, and so it is clearly a small second leg. Any bar that has a low below the prior bar is a low too short. Bar 15 turned into a low too short signal bar even though it is a small swing high that was below the high of the 2 legs up. It was a lower high in what should be expected to be at least 2 legs down. Bar 17 was a low 2 setup even though this is barbed wire because it was a small bar near the high. Bar 18 is the end of a bear trend bar breakout from barbed wire and a high 2. Barbed wire often has back-to-back failures, and bar 19 is therefore a good short also. It is the first EMA gap bar in a bear and the second leg up from the bar 16 low. Sometimes a 2-legged pullback has 3 legs, as is the case with most wedge pullbacks. View the first leg as the sharp move up to bar 2 in figure 4.25 here. Most of it was a gap open. After a sharp move, there is usually a 2-legged move. The 2 legs, bars 3 and 4, are subdivisions of the second leg up. 3 push pullbacks. Just as a 3 push pattern or perfect wedge can end a trend, they can also end a pullback. A strong trend sometimes has a 3 swing pullback midday that lasts a couple of hours and lacks much momentum. That third swing traps countertrend traders because most pullbacks have 2 legs and a third leg is often a new trend. A strong trend is often followed by a 3 swing pullback that typically has low momentum. Bars 4, 6, and 8 in figure 4.26 are the ends of the 3 pullbacks after the bar 3 new low, and each was a bull trending swing, higher lows and highs. Since there was no significant upward momentum, traders will short each new high. There was also an expanding triangle bars 1, 2, 3, 8, and 9. The long entry setup ended with inside bar after bar 9, which completed the triangle bottom. However, the next day gapped up above the signal bar. In general, it is better to only take an entry if the entry bar opens below the high of the signal bar and then trades through your buy stop. So there was no entry until the bar 10 breakout pullback on the next day. This 3 swing pullback in figure 4.27 in the QQQQ, a bear trend, followed by a 3 push rally, and then a test of the bear's low, unfolded over 3 days. Even though the upward momentum was good, it was actually minor compared to the size of the prior bear trend, whose low almost certainly would be tested. The test of the low occurred on the open of the 3rd day. The large gap up in Opal in figure 4.28 effectively is a steep bull leg, a bull spike. This was followed by 3 pullbacks, the 3rd of which was a failure swing. It failed to go below the prior low. Since this pattern is often in the middle of a trend, traders should swing part or all of their longs from the bar 3 entry, expecting approximately a measured move up. This is a variant of a trend resumption day, where here the first bull leg was the gap opening. Arguably, a failed 3rd push is also a head and shoulders bull flag. LEH had a huge reversal day at bar 1 in figure 4.29. Bar 8 was the end of a wedge pullback bars 4, 6, or 7, and 8, and of a small 3 push pattern bars 6, 7, and 8. It was also a double top bear flag with bar 2. Bar 8 was 24 cents higher, but close enough on a daily chart. A big down move followed by a big up move that retraces part of the bear is basically a doji type move. Remember, a doji is a trading range, so until there is a series of higher lows and highs, this move up to bar 2 should be considered the start of a trading range in a bear, which is a bear flag. The odds favor a downside breakout, and this occurred following bar 8. It ultimately failed in its test of the bar 1 low, and the company went out of business within a few months. There was a 2-legged correction up to bar 6, and the first leg ended at bar 5 in figure 4.30. Bar 5 was a wedge, but as is often the case, it is effectively 2 legs with the second one being made of 2 smaller legs bars 4 and 5. Bar 6 was a setup for a failed wedge. The wedge sell-off after bar 5 failed and reversed out the other side above bar 5, but that breakout also failed, and failed failures are great setups. There was a second 3-legged correction up from bar 7. It doesn't matter if you see this as a triangle or as 2 legs, one from bars 7 to 8 and the other from bars 9 to 11, with the second leg being made of 2 smaller legs. 3-legged corrections are common in trends, and sometimes they are really just 2 legs with the second leg having 2 smaller legs. When it gets this hard to think about it, Stop thinking about anything other than the trend and the market's inability to get much above the EMA. Look for short entries, and don't worry too much about counting legs if those thoughts are giving you an excuse to avoid placing orders. Chapter 5. Trading Ranges. If the chart is composed of upswings and downswings across the entire screen, then neither the bulls nor the bears are dominant, and they are alternating control over the market. Each swing is a small trend that is potentially tradable, especially on a smaller time frame. If the sideways price action has lasted for about 5 to 20 bars, then a trader has to be particularly careful because the bulls and bears are in very tight balance. Trading breakouts in this situation can be costly since every brief up move is sold aggressively by the bears, and the new bulls are quick to exit. This results in a tail at the top of the bar. Likewise, every sharp move down is quickly reversed, creating a tail at the bottom of the bar. There are, however, ways to trade this type of market profitably. In general, all trading ranges are continuation patterns, meaning that they more often than not break out in the direction of the trend that preceded them. They also tend to break out away from the EMA. If they are below the EMA, they usually break to the downside, and if they are above it, they tend to break out to the upside. This is especially true if the trading range is adjacent to the EMA. If they are far from the EMA, they may be setting up a test back to the EMA. If a bull swing pauses in a trading range, the odds favor the ultimate breakout taking place to the upside. However, there may be several failed breakouts of the top and bottom before the final breakout, and sometimes the market breaks out countertrend. Also, the longer a trading range continues, the greater are the odds that it will become a reversal pattern, accumulation in a bear trading range, distribution in a bull trading range. Because of these uncertainties, traders need to be careful and look for risk-price action setups. Trading ranges on a 5-minute chart that last for hours with many big, hard-to-read swings can be small, clean, and easy to read trading ranges on a 15 or 60-minute chart, so it sometimes is helpful to look at higher time frames. Tight trading ranges. A tight trading range is a common pattern that has been called many different things, but none of the terms is adequately descriptive. It is any sideways movement of 2 or more bars with lots of overlap in the bars. The bulls and bears are in balance, and traders are waiting for a breakout and the market's reaction after the breakout. Will the pullback reverse through the opposite side or just test the breakout and then continue? When a tight trading range slopes slightly up or down, it is still a tight trading range, and it should be treated the same way. Bulls and bears are in close balance, and in general, it is best to wait for failed breakouts and breakout pullbacks. In general, they are continuation patterns, like the small one that ended at bar 1. The range that started at bar 2 in figure 5.1 was after 2 sharp bear legs and should be expected to be protracted and likely to lead to 2 up legs. The move to bar 3 became the first of the 2 legs. These patterns are difficult to trade and often have false breakouts. It is wise to trade them minimally if at all, and simply wait for the inevitable clarity that will reappear. A tight trading range is usually a continuation pattern, but after a climax, usually a trend channel overshoot and reversal, even a small one, the market can break out in either direction. This is because the climax has generated momentum in the opposite direction, and you will not know whether this opposite momentum will be continued and lead to a breakout, or if the momentum of the prior trend will be continued. Horizontal flags and barbed wire are small forms of tight trading ranges, and like most tight trading ranges, usually break out in the direction of the prior trend. Sometimes the pattern can extend to 20 or more bars with tiny tails, and it then truly becomes a setup with no predictive value. Since guessing is never a sensible approach to trading, price action traders have to wait for the breakout before deciding what to do. In the majority of cases, there is a failure within a bar or 2 of the breakout, and the odds of a profitable trade are higher if you base your entry on the failure rather than on the breakout. In most cases, the failure fails and becomes a breakout pullback. Enter in the direction of the breakout on a stop once the bar after the pullback takes out the extreme of the pullback bar. In a bull breakout, you would enter on a buy stop at 1 tick above the pullback bar. If the pullback bar instead plunges through the opposite side of the tight trading range, or if it does so in one of the next couple of bars, you enter short on a stop at 1 tick below the tight trading. Because the move after the breakout is often not strong, the market remains largely trendless for the rest of the day, resulting in this frequently being not a particularly profitable trading pattern. The pattern is more reliable with stocks, and it occurs frequently, and sometimes results in an extended trend, so it is worth understanding. It often has other types of setups, small trendline breaks, high/low twos, and so on within it, and those are often tradable and have a much higher chance of resulting in a profitable trade than a tight trading range breakout. Only enter if the setup bar is a small bar near the top or bottom of the range, and only fade the move, for instance. Sell below the low of a small bar near the top of the trading range. In fact, it is usually better to focus on them than to wait for the breakout. By bar 4 in figure 5.2, it was clear that the market had entered a tight trading range. Both bars 5 and 6 failed to break out of the top, and the tight trading range evolved into a triangle, which is also usually a with-trend pattern. Since the last trend was up from the low of the day, an upside breakout was likely, especially since all of the bars are holding above the EMA. After 2 failed breakouts, the odds were much higher that a third breakout would succeed. Also, bar 7 was a high 2 pullback from the bar 5 high, which had some momentum. An aggressive trader would have bought the high 2. The next logical buy is a breakout above the high of bar 5, the first failed breakout. You could also buy at 1 or 2 cents above the high of the day. The highest probability entry was the first pullback at bar 9, which reversed up after taking out the bear reversal bar's low by only 1 tick, trapping shorts. Another high probability buy is the M2B at bar 10. Both of these high probability trades resulted in smaller gains, but with a much higher chance of success. LEH formed a tight trading range starting at bar 6 in figure 5.3, which could be part of a two-legged pullback, forming a higher low in a new bull. The bear trend line is broken, and the market is held up for a long time, about 30 bars. You could enter on a stop at the breakout of any prior swing high, such as bars 7, 5, or 4. Bar 3 reversed up from yesterday's low, and it was the third push down on the day, which often leads to a rally. The sideways move went well past the bear trend line, indicating that the bears had given up to the point that they were in balance with the bulls. Bar 6 formed a higher low after the trendline break. The odds were high that there would be a rally that would extend to at least the top of bar 2, the first bull signal bar in the bear leg. The first pullback after the breakout was the small bull inside bar at bar 9, so buying at 1 tick above its high was a high probability long. Bar 10 was a false breakout of a small flag that was also a 3-bar tight trading range and about a 65% retracement of the bear down from bar 1. The 65% is significant only because it means that the rally had retraced a lot of the sell-off from the bar 1 high, and if the rally extended much further, the market would likely be in a new bull phase. Fibonacci traders would call the rally to bar 10 a 61.8% pullback and say that it was close enough. But every pullback is close enough to some Fibonacci number, making the Fibonacci numbers essentially meaningless most of the time. By bar 3 in figure 5.4, Barb wire was present because of 3 sideways bars with at least one being a doji. This means that you should only look to fade failed trend bar breakouts or small bars near the top or bottom. Bar 6 was a bear trend bar breakout followed by an Roman 2 setup that led to a long scalp. Bar 7 was a failed bull trend bar breakout following the first failed breakout to the downside, and failed failures are second entries and therefore especially reliable. The short after bar 7 is also a small expanding triangle, as was bar 5, but it was too tight to expect much movement, which is a good reversal pattern. Barb wire. Read this carefully because it is the most important piece of information in this book. Helps you to avoid one of the biggest sources of losses in trading. An important version usually occurs in the middle of the day and in the middle of the day's range, almost always near the EMA. It is a type of a tight trading range called barb wire, where there are 3 or more bars that largely overlap and 1 or more of them have a tiny body doji. Don't touch barb wire, or you will be hurt. The small body indicates that the market moved away from the bar's open, but traders with an opposite opinion moved it back by the close of the bar. Also, sideways bars where one bar overlaps much of the prior bar mean that no one is in control of the bar. As with all trading ranges, the odds favor a with trend breakout, a breakout in the direction of the trend that led to the trading range. But barbed wire is notorious for sharp whipsaws and repeated losses for breakout traders. One good way to trade barbed wire is to wait for a trend bar to break out of the pattern. The trend bar is the first sign of conviction, but since the market has been two-sided, the odds are high that it will fail, so be ready to fade it. For example, if there is a bull trend bar that breaks out to the upside by more than a couple of ticks, as soon as the bull trend bar closes, place an order to go short at one tick below the low of that breakout bar. Sometimes this short entry will fail, so once short and once the entry bar closes, place an order to reverse to long at one tick above the high of the entry bar, which would become a breakout pullback entry. It is unusual for the second entry to fail. Once the market begins to form trend bars, either the bulls or bears will soon be in control. You can also fade small bars near the top and bottom of barbed wire if they're in an entry. For example, if there is a small bar near the high, look to scalp a short with an entry order to sell at one tick below the low of that bar on a stop. Finally, you can also look for 3-minute small bars to fade as well. You should rarely, if ever, fade off 1-minute bars because the 3 and 5-minute bars provide better winning percentages. Whenever you are not certain, the best course always is to wait, which is difficult to do when you feel like an entry is overdue. However, that is what a smart trader always does because it simply does not make sense to trade low probability setups. One very good rule is that if there is a trading range setting up and it is near the EMA, never look to buy if the bars are mostly below the EMA, and never look to sell if the bars are mostly above the EMA. This one rule will save you an enormous amount of money over the years. The move will most likely be some form of M2 entry in the direction of the EMA. If the pattern is below the EMA, an M2S is often a good trade, and if the pattern is above the EMA, consider buying an M2B setup, and the breakout from the M2 can run far. Bar 1 in figure 5.5 was a large outside bar followed by a doji inside bar. When there are 3 sideways bars and one or more of them is a doji, no one is in control, and the best trade is to wait for one side to gain control, as evidenced by a trend bar that clearly breaks out, and then look for a fade. Most trend bars coming out of these patterns fail and become setups in the opposite direction, but some breakouts lead to very strong trends, and there will not be a failure. This entry also frequently fails, which is a signal for a second trade. It is unusual for this second entry to fail. Bar 2 is a bull trend bar, but it did not break out of the pattern. It only extended one tick above the bar 1 outside bar, and a reliable breakout must extend about 3 or more ticks beyond the trading range. Also, this bar is too big to fade because you would be shorting in the lower half of a sideways pattern, which is never a good idea. Bar 3 is a large bear trend bar that broke out of the bottom of the outside bar by 2 ticks. Many traders would be short here, thinking that the market failed on its upside breakout attempt and is now breaking out of the bottom, running the stops on the last remaining longs who bought bar 2. Realistically, virtually none of even the weakest traders bought there, so no one is trapped. However, the rule is to fade the first clear breakout trend bar, and bar 2 was not a breakout. Clearly, bar 3 is also not a great downside breakout, but you have to assume that there are now shorts who think that they outsmarted the bar 2 longs. You could look to fade by buying bar 4, but when the market lacks clarity, it is always best to wait for a second entry. Bar 5 was a good long because it was a second entry and a high 2 above the EMA in a bull. So are these new longs the same as the bar 2 longs? Almost certainly not. The bar 2 longs were weak hands that could not move the market up, just like the bar 3 shorts who could not drive it down. The bar 5 longs were institutional traders who bought with conviction, as evidenced by the large bull trend bars that followed. Some of the bar 2 and bar 3 traders also became longs, but this was almost certainly an institutional move, and it is the move that made the most sense based on price action. When barbed wire forms in the middle of the day's range, almost invariably next to the 20-bar EMA, it is best to enter on a failed breakout. Here in figure 5.6, the market broke out of the top in a high 2 and immediately reversed to break out of the bottom in a failed high 2, where you would short at one tick below the low of the prior bar. Remember, this pattern is below the EMA, so the best entry will be some kind of short below the EMA, and it will usually be an M2S, preferably after a failed H2 long setup, which you should not buy. However, You have to be thinking about the possibility of a failed upside breakout to be able to place the sell order. Remember that upside breakout was a strong bull trend bar at some point in the first minute or two, and that bullish strength made lots of traders think exclusively about getting long. Those traders let themselves get trapped out of the short trade. You must constantly be thinking, especially when the market is starting to move. Not only must you look for a way to get in, you must also always think about what happens if the initial move fails and then quickly goes the other way. Otherwise, you will miss great trades, and traps are among the best. Barbed wire can also form at the high or low of the day after a breakout. These are usually with trend setups, so watch carefully for a with trend entry, like a high 2 in a bull, a low 2 in a bear, or a failed breakout or a failed failure, which is a breakout pullback and a strong setup. If a second entry also fails, it is best to wait for more clarity before entering again. The cardinal rule for trading in bar wire is never enter on a breakout. Instead, always be looking to fade, especially if there is a relatively small bar near the top or bottom of the trading range. Sell at one tick below the low of a small bar near the high of the range, especially if that bar broke out of the pattern by a tick or two. And look to buy at one tick above a small bar near the low of the range again, especially if it was a small breakout bar. A trader could actually sell on a limit order at one tick above the high of the prior bar if the prior bar is near the top of the range, and look to buy a downside breakout. Clearly, institutions do that all the time because that is why most breakouts fail. However, it is better to enter on stops so that the market's momentum is sweeping you along with it. It is simply against the nature of many traders and can cause too much stress to be trading in the opposite direction of the momentum, even if it is a sensible trade. It is preferable to miss a few signals than to experience the anxiety that comes from trading outside of your comfort zone. There will be plenty of other trades that will suit your personality, and it makes more sense to wait for those. When barbed wire or a protracted tight trading range forms at an extreme of the day after a breakout, it often becomes a continuation pattern. Look for a with trend entry, which often happens after a false breakout. Here in figure 5.7, there was a small bear reversal bar that was a failed B breakout of the top of the trading range, but this top failed on the bar after entry. A failed failure that results in a with trend entry is a perfect entry. Essentially is a resumed breakout, a breakout pullback, even though the breakout initially appeared to have failed. There were bar wire patterns in figure 5, that each fanned a low 2 providing a good entry in a strong bear. The second pattern is long enough to think of it more as a simple tight trading range rather than a barbed wire version, which usually is only about 5 to 10 bars long and contains relatively large bars and tails. Also, bar 2 was a small bear reversal bar at the top of the pattern near the EMA, making it a great setup with little risk. The height of the bar plus 2 ticks, one for the entry stop and the other for the exit stop. This was clearly a trend day, trending trading ranges at a minimum, but the minimal pullbacks make it even a stronger bear, so you should swing part of every short. Barbed wire fanned in figure 5.9 after a breakout to a new low of the day, but it is also the second leg down, and 2 legs commonly lead to a reversal. Also, it took out yesterday's low, so again there is an increased chance of a reversal upward. Bar 2 was the end of an upside breakout that reversed down from the EMA in a low 2. The low 1 was on bar 1, even though the low of bar 1 was at and not above the low of 3 bars earlier. The failed breakout failed on bar 3, meaning that the failed upside breakout was just setting up a breakout pullback, and not a reversal. Bar 3 was also a double bottom pullback by setup, a double bottom followed by a deep pullback that formed a higher low. Middle of the day, middle of the range. The middle third of the day, from around 8:30 a.m. until 1030 a.m. PST, can be difficult for traders on days that are not clearly trending. In other words, most days. If the market is trading in the approximate middle of the day's range, and it is now in the middle of the day's trading hours, the chance of barbed wire type of trading is significant, and most traders would be wise to trade sparingly. Most trading should be confined to barbed wire type of entries. It is usually better to forego any less than perfect entry under these circumstances, and instead wait for a test of the high or low of the day. A trader who is not yet successful should not trade when the market is in the middle of the day while it is also in the middle of the day's range. This change to her trading alone can be the difference between being a loser and a winner. Sometimes there will be an extremely great-looking pattern setting up in midday in the E-mini, and you will get one tick of slippage on the entry. If the market does not race to your profit target within seconds, the chances are high that you have been trapped. It is almost always better to place a limit order to get out at break-even. Whenever something looks too good to be true, so obvious that everyone will look to enter, the odds are high that it is exactly as it appears to be, not true. When the day is not a clear trend day, traders should be very careful during the middle third of the day when the market is around the middle third of the day's range. There are lots of overlapping bars in figure 5.10, small dojis and tiny failed breakouts, making the price action difficult to read. With experience, a trader can be successful trading under these circumstances, but the vast majority of traders would more likely give back most or all of the profit that they made in the first couple of hours. Goal is to make money, and sometimes your account is much better served by your not placing trades and instead waiting for strong setups. In the above chart, the sideways action lasted until 11:45, which is relatively late in the day. The time parameters are only guidelines. The overriding factor is the price action, and on trading range days, the best trades are fades of the highs and lows of the day, but this takes patience. Big up, big down. When the market has a big up move and then a big down move that retraces about the entire up move, it is likely forming a trading range, but it may be the beginning of a new trend. The key is whether or not there is a reversal pattern at the end of the second move. If there is, there should be at least a reversal scalp. If not, the second leg may just keep trending, and an approximate first target is twice the height of the first leg. Ellie's daily chart in figure 5.11 shows a sharp up move that ended at bar 2, a failed final flag, and 2 legs up to a new high of the day, and was followed by a sharp down move. There was no clear buy pattern on the way down, and instead there was a low 2 breakout pullback short entry at bar 4, below the EMA. R6 and 7 were short signal bars following brief bear micro trendline breaks. Bar 6 was an EMA gap bar. The bar 8 low of this spike and channel bear was not quite a measured move, and was followed by a test of the bar 4 start of the bear channel. The daily chart of VPHM in figure 5.12 had a strong breakout after the bar 1 low, presumably based on a news event. At some point, the momentum traders controlled the market and drove it much higher than the fundamentals warranted. There was then a sharp move down to bar 9, where there was a 3-push pattern, a wedge variant, that resulted in the up move to bar 13, effectively creating a large trading range. Bar 10 was a breakout pullback higher low second chance to get long. After many momentum players dumped their longs on the rally up from the bar 4 trendline break, the bulls were able to drive the market to a new high at bar 5. But this found aggressive sellers who were able to break the major bull trendline as they pushed the market down to the bar 6 low, setting up a large reversal down from the bar 7 lower high test of the bar 5 trend high. Reversal down came off of the 3 pushes up to bar 7. At this point, the momentum players were out and looking for another stock. The market continued to sell off until value traders thought that the fundamentals were strong enough to make the stock a bargain around bar 9. Bar 9 was also a 3 push down buy. It could also be near some Fibonacci retracement level, but that is irrelevant. You can just look and see that the pullback is deep, but not so deep that the force of the rally from bar 1 is totally erased. The bulls still have enough force left to rally the stock, especially since the value traders are back in play. They feel that the stock is cheap, based on fundamentals, and they will keep buying as the stock continues to drop, unless it drops too far. Incidentally, the bar 11 spike up led to a channel that ended at the bar 13 overshoot and reversal of the trend channel line. Spike and channel bulls, no matter how strong they appear, are usually followed by a test of the beginning of the channel, which was the bar 12 low. Trading ranges setting up trend reversals. These are common in trending trading range days, where there usually is a reversal of at least the final trading range in the final hour or two, and rarely even a reversal of the entire day. Sometimes the low of a bear trend day, especially a climactic one, can come from a small trading range that has large bars, often with large tails or large reversal bodies. These reversals are less common at tops, which may be less climactic than bottoms. If this is true, it is meaningless because it does not factor into decisions about trading. These trading ranges are often other signals as well, such as double bottom pullbacks or double top bear flags. Sideways price action after a sharp sell-off in Figure 5.13 with large trend bars and large tails often leads to a reversal. This is also a double bottom pullback bottom. The FOMC report was released at 11:15 a.m. PST, and the 5-minute E-mini in Figure 5.14 formed a large bull outside bar at bar 1, but its high was never exceeded. Even though reports can be volatile, the price action is reliable. Don't get caught in the emotion and just look for sensible entries. In general, when there are a pair of big range bars of opposite direction, or one or more big range dojis at an extreme of the day, it is usually better to look for a reversal entry because the big bars indicate two-sided trading, and when there is two-sided trading, it is not prudent to be buying at the high of the day or selling at the low. Bar 2 formed a bullish M2B, a high 2 at the EMA. But the bars were large, so the long entry would be at the high of a trading range, and the risk would be great because of the size of the bars. It is far wiser to wait for small bars or for a trap. Bar 3 was a failed high 2, so there are trapped bulls at the high of the day creating a great short entry. It was also a low 2, again near the high of the day, which is a good place to be looking for shorts. Finally, it was a double top bear flag after a large bear trend bar and a spike in trading range top. Bar 6 was a low 1 short. There was not a good reversal bar at the low, so the bulls had not gained control and traders should still be looking for with trend short entries. The inside bar after bar 5 was too big to be a bull setup, especially since the huge bar 4 outside down bar would probably be followed by 2 legs down. Instead, always look to fade small bars that occur after big bars, since a trading range is likely forming, and you should only be selling near the high or buying near low. After scalping out of the bar 6 short, traders would now be faced with a high 2 buy setup. However, the bars are too large and overlapping, that is, a trading range, and it is far better to be fading small bars at the high and low of the pattern and to be looking for trapped traders. Bar 8 trapped bulls into their longs, and they would exit on bar 9, 1 tick below bar 8. The smartest traders would have waited for the trap and shorted the low 2 breakout below the small bar 8 bar that was at the top of the trading range. It was a bonus to have bulls trapped. Bar 10 was another bull trap that was bought by weak bulls at the top of a big, tempting doji. Again, smart bears would look for a small setup bar for a short entry because the bulls would be forced to sell, and there would be no buyers left, making the market quickly reach the short scalp profit target. This is a trading range, so there is nothing for reversal patterns to reverse, and they all become traps. This trading range became a failed final flag that reversed up on the open of the next day with a high 2 entry on the 3rd bar of the day. This bar reversed the bear flag and the low of that day as well.